Today we live in a new world. A world where making the right choices has never been more important. Important for our families, our communities, and our planet. We need to make the right choices to help us build, grow, and thrive. Choices that allow us to invest in everybody's future. And today, finance isn't just about where you save or allocate your money. It's about commitment and continuity. It's about people and places, enterprise and ethics. Thinking beyond GDP and profit towards happiness, inclusiveness and well-being. It's about finance with purpose. The Global Ethical Finance Initiative believes in using finance for positive change, enabling transparency and choice that facilitates a more sustainable, responsible and stable financial system. A system that is both innovative and fair, that benefits the local and global community. We believe in the values of our environment and the worth of an individual's well-being, in enterprise that is ethical, in growing portfolios but not at any cost. We believe in profit with purpose and finance for positive change, and strive for system solutions to global problems. Founded in the historic city of Edinburgh, we draw inspiration from the Scottish Enlightenment figures who position Scotland as a leading centre of entrepreneurial spirit. Today, Scotland is home to accelerating startups and respected financial institutions. It is very much alive with innovators and creative thinkers, generating fresh ideas and new perspectives. At the Global Ethical Finance Initiative, we look outwardly to our partners from around the world, amplifying, collaborating and inspiring, enabling us to harness this combined knowledge for the benefit of our network. And how do we do this? Through our key pillars of advocacy and building ecosystems, which together encourages and facilitates the cross-pollination of ideas that helps grow and develop both individuals and institutions. The advocacy of ethical finance is achieved by bringing people together, achieved via a series of world-leading events, both virtually and in person. Every year, our Ethical Finance Summit is attended by the world's foremost financial, political and faith leaders. These experts dive into themes such as responsible investing, sustainable banking, inclusive growth, and rethinking capitalism, all aimed at ensuring that positive change is at the heart of our financial system. Change that supports targets such as the Paris Agreement and the UN Sustainable Development Goals. Our award-winning discussion series, the Edinburgh Ethical Finance Roundtable, established in 2010, attracts stakeholders and thinkers from all walks of life, including asset managers, asset owners, banks, regulators, charities, universities, governments and faith groups. People from across our network uniting to share perspectives committed to the development of a better world. We build ecosystems that encourage collaboration. Our pioneering work with the United Nations Development Programme helps drive private capital towards SDGs. And our 2-year programme is a journey focused on investment analysis and identifying market opportunities. The Edinburgh Declaration, the world's first interfaith collaboration on ethical finance, is a shared values framework that shines a light on common purposes and values, and can inform financial professionals and institutions on creating a values-based culture. And our Ethical Finance Hub campaigns for the positive influence that ethical finance can bring to Scotland through market campaigns and capacity building. At the Global Ethical Finance Initiative, we have an experienced team with an in-depth knowledge of finance, law, research, advisory, marketing and public relations, and event curation. Our journey has begun, and momentum is gathering. The case for ethical finance is beyond doubt, and with the help of our global network, we have developed award-winning initiatives, hosted world-class summits that have influenced policymakers and helped map the ethical finance landscape. We provide governments with research and advise banks and asset managers on how to invest responsibly and in line with the UN Sustainable Development Goals. We are a founding stakeholder endorser of UN principles for responsible banking, and we help provide a platform for ethical finance that delivers profits with purpose. Our global community is growing, and we want you to be a part of it. Join us and make a difference.
Always remember whose little coins these are that become the millions and the billions that pass through your hands. Whose hard-earned savings are these? Upon whose backs do streams of sweat flow? Whom do they look to for a better tomorrow? Who are the ones who make the daily sacrifices to develop entire communities, to build a business, to raise a child, to construct highways, to set up schools? Always remember the lives that depend on you. I am an AICB member, and I'll always remember whose money it is. Be a chartered banker.
The SDG's Financial Products Platform showcases commercial financial products that are directly aligned to the Sustainable Development Goals.
The platform's aim is to facilitate the development of innovative, SDG-aligned financial products across asset classes that ultimately build the ecosystem of SDG investing.
We know that private sector-led solutions are required to deliver the SDGs. But in a market of virtue signalling and champagne stewardship, it is difficult to discern which products are truly aligned with the SDGs.
The SDGs provide an opportunity for for financial institutions to embed people, planet, and profit in their products.
The world of ESG is full of jargon and fragmented approaches currently, and focusing on something that's been agreed and in place since 2015, sponsored by the UN, to direct our thinking and analysis around investment and to measure the outcomes of how that investment is performing, gives us a real strong platform to make progress and to enhance people's savings with some benefit to the world. We're incredibly pleased to be part of the Global Ethical Finance Initiative. We believe that the work we have done around sustainable sovereign bond investing merits a broad audience, and GEFI gives us that broader audience than that which we could achieve ourselves.
The platform is open to applications from new and existing financial products representing leading market practice across different asset classes.
Products listed on the platform must be of significant size, ideally in excess of 100 million, and scalable. Platform partners must demonstrate genuine commitment to the SDGs and be willing to share their experiences in the product development cycle.
The SDG Financial Products Platform is the result of a collaboration between the Global Ethical Finance Initiative, or GEFI, and the United Nations Development Programme.
The platform is open to applicants that can demonstrate an alignment with the SDGs. GEFI undertakes detailed, extensive sustainability-focused due diligence and only selects partners that demonstrate a genuine authenticity and dedication to the 2030 SDG agenda.
We work in collaboration with partners through the product lifecycle to share learnings and highlight leading market practice. This is done in 3 ways.
Showcasing. Partners have the opportunity to share insights on their products at our global flagship events and co-develop thought leadership shared across our international network of over 15,000 global financial professionals.
Enhanced authenticity. Partners benefit from additional product endorsement through the unique collaboration with an established NGO.
Technical expertise and knowledge. We meet quarterly with the partners to share insights on market developments that help refine the product strategy, and we use GEFI's proprietary SDG framework methodology that utilizes 160 plus targets and 300 plus indicators to intertwine them within the investment thesis.
GEFI and the UNDP launched the platform at COP26 with the platform's first core partner, Aegon, and its Global Sustainable Sovereign Bond Fund.
So I'm delighted that Aegon UK and Aegon Asset Management have partnered with GEFI in the launch of the new Aegon Global Sustainable Sovereign Bond Fund. And I'm proud that we've invested £100 million of one of our key default funds, the Universal Balance Collection, into this fund.
We try to invest in those countries that do show right now best practices in terms of sustainability when it comes to regulation, but also we try to identify those that are doing the best to improve in the future. So not only current leaders, but also future leaders. Well, the main attraction to invest in sustainable sovereign bonds is that you achieve long-term resilience. So you're able to protect capital, but as well find sources of yield and performance for the future. And also you will construct a portfolio that will be resilient under different scenarios, including extreme climate scenarios. We expect those countries to perform better just because they are today investing in solving these issues for the future.
If you are committed to achieving the SDGs and are interested in having your product promoted on the SDG platform, please get in touch with GEFI.
As Adam Smith said in his theory of moral sentiments, markets need to be underpinned by morals.
Let's ask the question, the person I disagree with, what is he right about? Not what is he wrong about, we can write volumes about that. What is he right about, so that we enter a conversation where we can move forward.
If we can come up with something, land it at the country level, be intentionally inclusive, we will actually raise these vast sums of money, because guess what? The money's there.
In most crises, is a dynamic phenomenon, and the key importance of this is to recognize where the crisis is going so that we can be anticipatory and have policies that deal with the next phase of the crisis.
At this global turning point, such efforts will help countries and communities to build forward better.
And the GEFI team are certainly to be credited for bringing us to this point. Their work has placed Scotland at the very heart of the revolution, of the green, sustainable and ethical finance revolution.
Good morning, ladies and gentlemen. I'd like to bid you a warm welcome to the Ethical Finance ASEAN 2022. Together with our partner, the Global Ethical Finance Initiative, we would like to thank all of you for joining us at this virtual event, which we hope will offer valuable insights and a deeper understanding of ESG, further augmenting the financial industry's capacity to contribute towards advancing sustainability, responsible banking, and the wider ESG agenda. Following a successful collaboration with the Global Ethical Finance Initiative on Ethical Finance 2021, I am delighted that through this valued partnership, we are able to work with the GEFI team on this event and continue the crucial conversations on climate action in the ASEAN region once again. This year's theme, ESG in a volatile world, profit, purpose, or politics, compels us to consider the impact of climate change on the world today and recognize the urgency in which reformative action is necessary. The adverse effects of climate change extend beyond environmental and ecological issues, creating negative impact on economies and system-wide financial risks, which, if left unchecked, could be potentially irreversible and a severe threat to the financial stability of a country. Achieving the goal of climate neutrality is a collective responsibility, and to this end, the financial sector has an enormous influence on the outcome of climate action. It is therefore imperative that we do our part to facilitate the provision of climate finance and accelerate the pace of adoption of responsible banking practices in the ASEAN region. AICB is committed to support our members and the broader banking community in this ESG journey through our professional qualifications and various thought leadership initiatives such as this conference. It is important for bankers to be technically competent and have a deep understanding of the ethical and social purpose of banking to make a positive difference in our communities and to our planet. With our stellar line of speakers, I trust that you will find the discussions beneficial to your role in financing a more equitable and sustainable future for all. With this, ladies and gentlemen, thank you once again for joining us. I'd like now to introduce Omar Sheikh, Managing Director of the Global Ethical Finance Initiative, to give his opening remarks. Over to you, Omar.
Thank you, Tan Sri Azman Hashim. It is a pleasure to have you all with us today. On behalf of the Global Ethical Finance Initiative, or GEFI for short, and our partner AICB, I would like to start off this morning by welcoming everyone and thanking each one of you for joining us for the Ethical Finance ASEAN Summit 2022. Today, we have come together to build upon the successes of last year's Ethical Finance Summit and discuss this year's theme, which is ESG in a volatile world, profit, purpose, or politics. This morning, we will hear from Mahmoud Mohieddin, the UN Special Envoy on financing the 2030 Agenda for Sustainable Development, followed by a leadership fireside and a presentation of the report into sustainable SME banking in Malaysia. The report will be followed by a short break prior to the commencement of the afternoon sessions. The first round of the afternoon sessions will include a presentation by Yuki Yasui, Regional Director of the GFAN's APAC Network, a climate finance panel, and a fireside chat featuring discussions of how to finance nature protection in the ASEAN region. After another break, the day will be rounded off by a panel session looking at the S in ESG from a regional perspective and leadership discussions on the corporate impact on the protection of nature and a high-profile keynote on ESG data. Over the past few decades, the ASEAN economies have been one of the major sources of growth for the world economy, developing in high-tech industries, finance, manufacturing, and commodity production. However, like everywhere else in the world, the ASEAN economies have felt the effect of the pandemic and the recent surge in commodity prices. Many businesses, particularly SMEs, struggling with credit and cash flow. This is not the only challenge facing the region, with much of the population concentrated in low-lying and coastal areas. The ASEAN countries are particularly vulnerable to the impact of rising sea levels, along with extreme weather events such as floods, while poverty and deforestation also loom large. Despite these common challenges, the ASEAN region is one of incredible diversity. There is economic diversity with some of the world's richest and the world's poorest countries. There is social diversity with many religions and peoples present in the region. And there is, of course, biodiversity with the tropical rainforests and the seas of the region being some of the most beautiful and species-dense areas in the world. Part of what this summit seeks to do is to celebrate that diversity and also reconcile differences where they exist. By bringing together views from across ASEAN, the wider Asia-Pacific region and beyond, we have a unique opportunity to learn from each other, share best practice, and enable the finance industry to support the development of an inclusive, low-carbon economy fit for the challenges of the future. So thank you to you and to all of our speakers and attendees for being part of this journey with us. And finally, I would like to conclude with a special thank you to our partners and sponsors, AICB, Aberdeen, UNEP-FI, DidiCap Group, SME Bank, and Space Intelligence. Without their commitment and leadership in this area, important dialogues like this would not be possible. So thank you to all of our partners, and thank you to all of our team at GEFI and AICB as well. And I would now like to pass over to Shireen, our host for today from our partners, AICB. Thank you.
Thank you, Omar, and good morning, everyone. I'm Shireen Kandaya, Director of Marketing and Communications at AICB, and I'm delighted to be your MC today for the inaugural Ethical Finance ASEAN Summit. On behalf of AICB and GEFI, I would like to warmly welcome and thank all of you for joining us today. We have with us today around 2,000 delegates across 90 countries, which is pretty impressive, and a diverse lineup of experts on sustainable and responsible finance who will share their global perspectives and insights on key issues and developments in the area of climate finance and responsible banking in the ASEAN region. As Omar mentioned, our theme for today, ESG in a volatile world, profit, purpose, or politics, aims to elevate the financial industry's role as a key player in advancing sustainability, responsible banking, and the wider ESG agenda, as well as looking at macroeconomic issues impacting global markets. The discussions today will focus on the mega trends of 2022 and their effect on ASEAN economies, core challenges for the ASEAN region in financing climate adaptation and mitigation, the role of finance in addressing nature-related financial risk in the region, the progress on financing the 2030 goals, the emergence of the S in ESG, and the importance, of course, of leadership and governance in transforming finance. Before we begin the sessions, allow me to share a few housekeeping details. If you want to provide comments, please use Twitter or LinkedIn with the hashtag EFASEAN 2022. If you need to leave at any time, simply navigate back to the page you are currently on. Kindly note that each block of sessions will take approximately 90 minutes with breaks in between. As we have a packed agenda today, we do apologize that we are unable to accommodate questions from the audience. However, do share your views and join in on the conversation via AICB and GEFI's social media pages with the hashtag EFASEAN22. Building on Tan Sri and Omar's introductions, the summit is indeed timely, considering that ASEAN is at risk of increasingly frequent and intense extreme weather events that threaten to undermine decades of economic progress. The ASEAN Secretariat has also called to attention the fact that member states are highly vulnerable to climate change, with significant climate change impacts already being experienced within the region. Responding to this challenge is a collective responsibility. And to that end, the finance sector must play its part by facilitating the provision of climate finance and accelerating the pace of adoption of responsible banking practices in the ASEAN region. To give us more insight into this, I would like to introduce you to our keynote speaker, Cecile Teoro Niang, Practice Manager, Finance, Competitiveness and Innovation, East Asia and Pacific of the World Bank Group. Cecile has over 20 years of experience in international private sector development, project management, strategy and policy. And since joining the bank in 2004, she has held various positions working on long-term infrastructure finance, climate finance, finance inclusion, markets and technology, and also has a wide-ranging operational experience in policy and regulatory reforms, as well as financing public-private partnerships. Additionally, she has written extensively on access to finance and productivity and inclusion. So a warm welcome to you, Cecile, and you may now begin your address.
Thank you, Shireen. Distinguished panelists and participants, greetings from Bangkok. I will speak today about financing systems for sustainability. And it's really my great honor, for the second time, in fact, to speak to financial market professionals in ASEAN and beyond about one of the most important development topics of today's age, and that's sustainability in financial markets. So I want to first thank GEFI and AICB for the invitation. And I will start my presentation now. So let us get started. Just a little bit of context setting, and I will pass relatively quickly on that. But just to remind all of us that the action is now, and countries will not be able to limit global warmings to 1.5 degrees or 2 degrees unless there is strong commitment toward curbing CO2 emissions. And so here, just to reiterate some of the critical aspects that have been highlighted by the IPCC 2022 report. The specific risks for our Asian countries, according to the report, are 1, urban infrastructure damage and the impacts on human well-being and health. Secondly, biodiversity loss and habitat shifts. Third, more frequent and extensive coral bleaching. Fourth, a decline in coastal fishery resources. And fifth, a risk to food and water security due to increased temperatures and increased weather events. So that's for the context setting. No need, I believe, to highlight one more time the physical impact that we're looking at for our Asian countries, but just to say that it's really across the board that countries in East Asia are exposed to climate and natural disasters. So those are the physical risks that we can think about, the actual climate and natural disasters. But there is also the economic impact that our countries will suffer. So these transition risks are really also important to highlight here. And they pertain to the economic adjustment process that will happen during the transition towards a greener and low carbon economy. Now, here's the proposed framework. On one hand, on the right-hand side, the opportunity, and that's mobilizing finance. On the other hand, the risks, and that's measuring and managing risks. Now, out of these two critical angles, there is also a cross-cutting element, which is looking at the enabling environment and the supporting policies for finance to play its role. So let's talk about the opportunity. And focusing on emerging East Asia, I wanted to share a few facts about where we are on the role of finance for sustainability. So first things first, the financing gap. The financing gap is huge, and I'm going to give a figure here. It will cost more than $1.5 trillion annually between now and 2030 to finance low carbon, climate resilient infrastructure in EMDEs. That is just infrastructure. Now, in comparison, the total amount raised through bonds and syndicated loans by middle-income countries for sustainable projects was $500 billion over 5 years between 2017 and 2021. So we see the gap between the role that the financial markets is playing now and the need in terms of the financing gap. Now, in ASEAN, the corresponding volume of financing corresponding to this 500 billion that I mentioned was actually 24 billion, and that's what you see on the left side. So we're looking at this moment at a small and nascent market, but that is also the opportunity. Now, last year, I spoke about business opportunities in this transformation towards low carbon. And I mentioned 5 key systems that actually have contributed to over 90% of global greenhouse gas emissions. Well, this slide is as relevant today as it was last year. So I thought I'd put it again on the table. So what are these sort of 5 key systems that are really holding most of the GHG emissions? Well, it's energy, it's agriculture, food and land use, it's cities and urban infrastructure, transport, and manufacturing. One thing that I want to leave you with today is the role of taxonomies. And in fact, taxonomies cut across both the opportunity, they help mobilize finance, but they also help manage the risks. So there's a lot of talk about taxonomies nowadays, especially since, in fact, the ASEAN taxonomy was issued recently. So why should policymakers focus on taxonomies? Well, it's about standard settings. So those taxonomies provide a common language for investors, for borrowers, for the real economy, the private sector, thus facilitating the alignment and supporting the scaling up of finance for sustainability. Now, as I mentioned, there's been major progress made recently in taxonomy development. And so I mentioned the ASEAN one, of course. There is also the EU taxonomy, which is a reference guide for many countries when it comes to regional taxonomies. Then there are national level taxonomies. Most taxonomies focus on the climate aspects, but also some cover the social aspects. So I wanted to bring this up here. And I'll give some examples. In fact, in Malaysia, the taxonomy in Malaysia is actually focusing on sustainable and responsible investment. Now, that said, we also need to talk about risks. And managing risks is going to be critical. And I wanted to spend some time talking about the risk side. So I'm going to highlight a few risks here when it comes to physical and transition risks. And I'm going to choose 5 of those. 1, credit risk. Credit risks that can arise for financial institutions because of the business disruption that can arise from climate events or transition activities, and that can potentially lead to higher probabilities of default and losses as exposure to climate increases. So that's number 1. The second risk for the financial system is the underwriting risk. So underwriting risk related to weather-related events and natural disasters can impact, for example, the liability of insurers. There are then liquidity risks and operational risks for banks after disasters. There are market risks, such as stranded assets. And then finally, there are reputational and liability risks. And we talk more and more about greenwashing. Basically, greenwashing being the sort of, carrying a reputational risk in case issuers fail to meet the market expectations that will be related to green financing. Now here I'd like to propose a framework for supervisory expectations that are related to risks in financial institutions. The key message is that we are still at early stage of developing supervisory frameworks for climate finance. And so it's really important for supervisors and financial institutions to actually consider these risks. So setting expectations early will be a really important driver to catalyze action in the financial sector. And I'm going to give some high-level examples of supervisory expectations. So 1, governance and strategies. So financial institutions will need to have in place some very clearly defined governance structures and arrangements. They'll need to adopt a strategic approach to consider the risks that we've been talking about and be aware of the potential impact on their business model. That's for governance and strategies. Risk management. Financial institutions should have policies and procedures in place to identify, assess, monitor, and report all material risks. So that's the second type of supervisory consideration. The third is stress testing and scenario analysis. And we've been doing a lot of that. In fact, we've been really embedding within our financial sector assessment programs support on stress testing to actually assess the soundness of the financial systems. And now let me finish with disclosures. Disclosures is really important element. Disclosure of information and metrics on the climate and the environmental risks to see how financial institutions are actually exposed to the potential impact of climate risks. And there are more and more guidelines that are actually arising in this area, including TCFD recommendations to the Financial Stability Board in this area. So that's the proposed framework for supervisors to consider. Now, I'm not going to go too much into detail, but I think what I want to say here is that, we're still looking at international standards that are being developed. And there's a big leadership for the International Sustainability Standards Board. And so MDBs such as the World Bank have a key role in ensuring that as these standards get developed, our emerging economies and member countries are actually able to leverage these standards to continue to grow. So we will continue to help implement, of course, those standards, but also implement them in a proportionate and appropriate way in our client countries. We've in fact been recommending the adoption of a phased approach for the implementation of these standards so that countries can adopt them at a pace that can allow their development. That was for the risks. Now let me conclude by highlighting a few of our initiatives. And for this, I've chosen to talk about our new country climate and development reports, which we actually call CCDRs. So we've been developing, actually, we're in our first year of developing flagship reports that are really country reports that are trying to look at climate smart development as a whole by focusing on the interplay across green, resilience, and inclusive development. These reports assess, one, how climate change and decarbonization may impact the country's development. They also look at potential areas for country action in resilience, adaptation, and mitigation to improve development outcomes. So it's about the nexus of climate and development. Ultimately, the CCDRs will identify opportunities for climate action by public and private sectors. And they will also determine how the World Bank's priorities can evolve in supporting countries meet their climate objectives as well as their development objectives. We have 30 or so CCDRs that will be launched this year. 4 of them are in East Asia: China, Indonesia, Philippines, and Vietnam. So to conclude, I will say that, we very much look forward to continuing to support our developing and emerging economies in embarking in these new climate goals. At the analytical level, supporting as World Bank Group in introducing new financial products that better match the financing of various stakeholders. We've been working for years on disaster risk management and disaster risk finance, including mobilizing private capital. We are fostering the participation in international fora of countries so that they can actually participate in the development of global standards. And we're also supporting financial institutions so that they can actually play a role in catalyzing private sector finance. And last but not least, promoting data transparency is an area which we support, and in fact, which the taxonomies that I've talked about support. So with that, I want to thank you very much for listening to my address, and I will pass the floor to Shirin. Thank you very much.
Thank you, Cecile, for the great insights and an impressive summary of the risks and opportunities associated with climate change for the ASEAN region. It has definitely given us much food for thought this morning, and that leads us to our first panel session of the day, the Leadership Fireside, featuring leaders of financial institutions who will be discussing the role of the banking sector in delivering sustainability in the ASEAN region and finding a balance between achieving growth, profits, and ensuring a sustainable future. To begin the Leadership Fireside session, allow me to introduce Yvonne Chia, fellow chartered banker, AICB Council member, and independent non-executive chairman of Standard Chartered Bank Malaysia, who will be moderating the session. Yvonne is a trailblazer for women in banking, being the first woman chief executive officer appointed to head a commercial bank in Malaysia and the region. An award-winning senior banker, she was named among 50 business women in the mix in 2013 by Forbes Asia and is a two-time finalist of the CNBC Asia Business Leaders Award. She has been in the trenches during the ASEAN-Asian financial crisis, and where she was the CEO of two banks concurrently, an exceptional occurrence in the history of Malaysian banking. She has been through several economic and financial cycles, including the 2008 global financial crisis, and has seized opportunities during these crises to lead via mergers and acquisitions, and along the way, help shape the Malaysian banking industry where it is today. Action-oriented, always anticipatory, strategic, and big picture, she's actively involved in emerging trends, including ESG, disruptive technology, and talent development. In many aspects of hard and soft issues, in AICB, she is our go-to person. To me, Yvonne has been inspirational to the youth and women in the financial sector, and she continues to inspire. I'm always amazed by her energy, her passion for people, and not to mention her wicked sense of humor. Join me in giving a warm welcome to an amazing woman leader, Yvonne Chia. Over to you, Yvonne.
Thank you, Shirin. You are very kind and generous indeed. Ladies and gentlemen, I'm delighted and honored to be moderating the first session of the inaugural Ethical Finance ASEAN 2022. A warm welcome to everyone across the globe who have taken time to join us. I am Yvonne Chia, speaking from Kuala Lumpur, Malaysia, the headquarters of the Asian Institute of Chartered Bankers, or AICB. As we gather this morning against the backdrop of conflict in Ukraine, supply chain disruptions, China's continuing COVID lockdowns, market volatilities, rising interest rate and cost escalation, it is clear the pace and scale of changes on numerous fronts confronting us will be very different from the past. On that note, ladies and gentlemen, let me now give an overview of ASEAN to set the context of this leadership fireside. ASEAN is the Association of Southeast Asian Nations. It brings together 10 nation states into one organization based on consensual decisioning and independent sovereignty. Originally started in 1967 with the aim of ensuring political stability and deterring communism, today the 10 states of Malaysia, Thailand, Singapore, Indonesia, Vietnam, Brunei, Cambodia, Laos, Philippines, and Myanmar is a formidable economic bloc. A diverse and intertwined cultures and religions with distinctive levels of human capital development, ranging from example, Singapore's highly educated population and the extreme of limited access to education in some member nations. Population of 650 million youth from 19 to 30 years comprise over 40% of the population, and in some nations it is even higher. They are very adaptable to the digital world. In fact, ASEAN has the fastest adoption of digitalization, accelerated with the recent pandemic. They are also getting into conspicuous consumption with increasing level of personal and household debt. ASEAN is also locked into an economic system of traditional resource industry. We have 1/3 of the global rainforest in ASEAN, a GDP of over US 3.6 trillion and growing. The growth rates has been high, averaging 5% for the past 10 years, though different nations are at different stages of growth. The benefits of economic growth, however, has been unevenly distributed. For example, in Singapore, per capita income is amongst the highest in the world, close to US 80,000, and we have the lowest, close to $2,500 US. There is strong intra-regional trade and tourism with an open sky policy among the member nations. ASEAN is also dependent on FDI flows and exports. Next to China, ASEAN is a center of supply chain and outsourcing for the developed economies. The record of human rights and treatment of low-end workers has much to improve. There is a very diverse picture from manufacturing of low-end labor-intensive industries for the majority member nations relative to the high-end technology sector in Singapore. 40% of businesses in ASEAN are family-owned. ASEAN has also over 90% of businesses registered as SMEs and is a major source of employment and jobs. Invariably, ASEAN country debt has increased, especially with the recent additional funding for subsidies and cash payout during the pandemic, now further exacerbated with weakening currencies and rising global interest rates. Some of the member nations fare low in the governance and corruption index. So, as I set the stage, there are some clear trends that I would summarize, as well as the current state of play on the climate impact in ASEAN. Uncertainty about economic growth just emerging from the pandemic. Geopolitical implications in our front yard, from the China-US trade sanctions to China's slowdown as major partner of ASEAN, the chain effects of the Ukraine conflict causing rising inflation and food security challenges. These weakening currencies and rising debts, increasing poverty and income inequality. Definitely there is a trust deficit amongst the community and societies on government and institutions. And then now there is a challenge of rewiring the economies to transition to net zero and addressing the UN ESG agreement. There is a fear of disorderly climate transition, as well as there is not enough skill sets and talent, and capacity building is way needed. The climate impact is very clear. CO2 emissions have been increasing. Energy consumption is on the rise. Most member nations have stated their commitment to net zero between 2050 to 2070, depending on the sectors. The region is among the most susceptible to climate change, in particular, with extreme conditions from flooding to urban heat, volcanoes, and rising sea levels. And in some member nations, they are the center of plastic waste imports from developed countries. IMF reports that GDP can be reduced by 11% by 2050 if we live as is today. And there are some other reports that's even more frightening, that GDP can be reduced as much as 35%. The S and G in ASEAN are perceived to be more immediate and urgent, as this affects their daily survival. Vulnerable communities, girls and women participation are seen as more pressing issues. All said, ASEAN has been proactive, setting up collaborations via multiple ASEAN platforms and frameworks across energy, agriculture, transport, and with both government and public institutions involved. There are also private networks and private collaborations like the ASEAN Climate Governance Network and the Joint Committee on Climate Change. Hopefully, I've shared with you all the context of opportunities and challenges for ASEAN. Achieving net zero globally will require the deployment of around $5 trillion annually by 2030. So what is ASEAN's deployment capital for transitioning? What will sustainable finance look like within the real economy, and how are banks handling it? How can the different perspectives and interests with the diversity of ASEAN member nations be brought together, and what role should finance play? As we speak, calls to water down ambition, compromises being discussed in EU countries like Germany and Denmark, reverting to coal, announced in the last few days. How would that impact developing economies like ASEAN? Intentions, commitments, declarations have been set across the globe, including ASEAN. And understanding the commercial and national implications, the what and the why. The speakers will now frame their experience and insights on the how, the core challenges for the ASEAN region in financing climate adaptation and mitigation, the action plans at local and national level at the respective banks, including Islamic banks and asset management institutions. How will they lead change and support the transition in ASEAN, as well as sharing some early successful responses from their global insights? Let me start with Renee Bowman. Renee is the CEO of Asia Pacific Investments at Aberdeen since 2021. He moved from UBS, where he was there for 29 years, including being head of asset management, Asia Pacific, and the regional UBS Group Executive Committee. He has been in Asia since 2005 in leadership roles in corporate and wholesale banking, wealth, and asset management. In the front line, leading and operating on the ground across Asia Pacific. He is currently based in Singapore. Over to you, Renee.
Thank you, Yvonne, for that introduction and the exercising also what you highlighted, the global macro challenge. As you highlight, for a regional asset manager, and certainly from our perspective, we do believe climate change or the decarbonization can unfortunately not wait. You know, the inflation is tamed or any of the other global macro challenges are so. The next couple of years are super critical. The world needs to decarbonize. Without Asia, there is no decarbonization in our perspective. Of the emitters, we have 5 of them here in Asia, which means we need to start teaching how we here can help and accelerate and finding a solution. However, is on a very different path economically, because we do have still more infrastructure, we have a faster growing population, so we actually need energy, more electricity, and hence we still have to do catch-ups. Whereas we need to find a way to do an energy transition that is just and not conflict from one day to the other, decarbonize, but really look at transition. From our side, from an asset management perspective, we are working very closely with investing in developing transition plans. So our is not one of exclusion, It's really around how can we help and engage with the countries in developing transition plans and thereby help facilitate the firms that really do have a plan to help in the transition. Now, even in your summary, there is a lack of expertise in the region. Certainly from our perspective in the asset management world, we have established in Singapore what we call the Institute. And our goal of the Institute is to bring together on one side our clients, understand how they can help us in this transition, regulators across the region so that we can harmonize and facilitate what we need from, and likewise also spend more time to educate more talent specialists across the region. So we have hosted just most recently our first sustain. It was very interesting to see the huge interest that we actually see from all stakeholders. So from our perspective, in summary, I would say asset managers have an important play in this process, not only by influencing the firms that we need to help educating the investors more on how they can involve the transition.
Thank you, Renee. We will now go to the second speaker, Raja Amir Shah Raja Aswar. He is the CEO of Islamic Bank in Malaysia, HSBC Amanah, an award-winning CEO, deeply entrenched in the debt capital markets on Sharia and sustainable finance. Islamic bonds, Sukuk, having won amongst them several awards of the Islamic ESG Bank and the Asset AAA Islamic Finance Award several times. He is a strong contributor to the Malaysian Islamic banking, and he's now on the journey to transform the bank he leads, HSBC Amanah, to be the group's first sustainable bank by the end of 2022. Over to you, Raja Amir.
Thank you, Yvonne. It's a pleasure to be here and to be speaking on this topic with such an esteemed panel, and also in respect of a topic which is very close to our heart. So, you know, in terms of the role that financial institutions need to be playing in, you know, ASEAN as well as globally is very important, given the fact that banks are key mobilizers of capital in the markets. So what we, you know, in terms of what the Islamic banks in Malaysia are vying to do, in line with what Bank Negara has created, which is value-based intermediation, is really to put at the center of our decision-making. Profit is obviously central and key, but there's also people as well as the planet. So in terms of the situation that we're seeing, you know, globally as well as regionally, it's very important for banks as source of funding for corporations, which really range from as diverse as eco-friendly renewable energy companies, all the way to billion-dollar oil companies. So what banks decide to give their loans helps determine the direction of the economy and, to an extent, the future of our societies. What is clear to us, Yvonne, is that public funding will not be enough to finance the sustainability transition. So what the banking sector can and should do is to stimulate private finance. And this can be conducted through various means, such as socially responsible investing, impact investing, social banking, as well as sustainable lending. We are very encouraged to see that in ASEAN, various countries have publicly declared that they are developing their own taxonomies, such as Malaysia, Singapore, Thailand, and Vietnam. And as mentioned, in Malaysia, financial institutions will be required to comply with what Bank Negara has termed the CCPT, which will become compulsory by the second half of this year. Now, the CCPT is a climate-based taxonomy, and under that particular framework, banks would need to report in terms of their exposure to environmentally sensitive industries. And as I mentioned earlier, Yvonne, in terms of value-based intermediation, which is spearheaded by Islamic banks in Malaysia, once again, this is a voluntary initiative with amongst Islamic banks as well as DFIs. and HSBC as being one of the community of practitioners which was founded VBI in 2017, are playing our part in terms of creating our own sustainable financing framework. So if I can talk about some of very quickly in terms of some of the developments which have been done in terms of mobilizing finance towards green, social, and sustainability. In the 6 largest economies in the region, green, social, and sustainability debt had hit $24 billion last year, which was up by about 13.6 billion in 2020, which represents a 76.5% year-on-year increment. In addition, sustainability-linked debt totaled 27.5 billion, which is a jump of about 220% from 8.6 billion in 2020. So in conclusion, in terms of what banks should and need to do is that we, given the central position that we face in mobilizing capital and providing financing to all layers of society, need to have sustainability at the forefront of what we do and embedded into our DNA.
Thank you, Raja Amir. That is a very good perspective from Islamic banking. And we will now turn on to Sheila Talak. Sheila, the third speaker. She is the Global Head of ESG Specialist in the Sustainability Center out of BNP Paribas Asset Management, based in France. Formerly an investment specialist for convertible bonds and European equities, and in client-facing and marketing roles. Sheila is now in charge of communicating with clients and externally on the center's research, policy, stewardship, and industry engagement activities, including supporting investments, teams in integrating and reporting on ESG factors. Sheila, I think this is going to be very interesting to hear from you. So over to you, Sheila.
Thank you very much, Yvonne. And I'm just to say I'm very happy to be on this panel this morning. So today I'm replacing our CEO and head of the region, Angelia Chin, who will be moving to Singapore from Malaysia. Angelia is part of the Joint Sustainable Finance Working Group, working with ASEAN regulators on the ASEAN taxonomy. So we really are fully on board with what our 2 previous panelists have been talking about, what's moving in ASEAN. It's pretty new to the region, but as you underlined, it's really of extreme importance because everything that's going on in climate change will affect the GDP of ASEAN countries. And from the BNP PAM point of view, we've seen an increase in the interest for ethical and sustainable finance, both from regulators, and Amir mentioned, the principle-based taxonomy of Malaysia, Indonesia with their green taxonomy. We also have, and I think that's really important, governments setting net zero target across ASEAN countries, with the earliest at 2050 and the latest at 2065. And finally, I think investors are really seeing sustainable finance as a new trend. Of course, Malaysia and Indonesia already are used to having Sharia compliance. So this is really the basis for sustainable investing, and it means that they're familiar with an exclusionary approach. And from our point of view, we have been committed to sustainability we are committed to sustainability on a global level. We're present in 10 of the ASEAN countries and of course all over the world. And we have been accompanying our clients on their journey to sustainability, engaging with portfolio clients, portfolio managers, and really telling, you mentioned that we do ESG integration, also sharing our experiences there. So we're trying to start make sure that the region goes forward in an organized way and using what already exists in the world. I think it's not worth starting everything over again when we already have the basis elsewhere in the world where things have been started.
Thank you, Sheila. I will now take the opportunity to have the conversation with the three of you. I will try to pose a question to maybe any one of you, but if you feel that you would also like to contribute, please feel free. I guess what we have heard quite clearly from Renee and from Sheila, the people from asset management, is that they are very clear that they do have a very strong role to play to impact positive investing. Now, the asset management are more investors, which they can easily, probably, much easier positions than, say, the banking institutions, who actually have a portfolio on their books that they will have to guide the transition to net zero. The asset managers have a situation of either we invest or we don't. We may take some time to exit or to increase our portfolio towards the green portfolios, but there is facilitation, there is engagement, but it's quite a different journey than from the banks. So, of course, the banks very much have to be involved with the real engagement and transition, understanding the materials, and really going through the very detailed, all the way to scope 1, 2, and 3 of net zero decarbonization to ensure that they can continue to land. So now there is this buzzword called just transition. So if I may put that question to all three of you, to feel free to comment on that. What do you mean in your context of asset manager, in the context of an Islamic bank or any bank in particular, do you mean by just transition, and how do you go about it and actually making that on the ground? Anyone would love to start off first?
Yep, happy to kick off with that question. So if I may come from a perspective of financial institution, and I think it's extremely important when we talk about the just and orderly transition, because as we all know, the last 2 years has really been a game changer for a lot of people, countries, individuals alike, right? So a lot of people are coming out of the pandemic now, and there's a lot of data to show that especially ASEAN economies are rebounding and are benefiting from the surge in commodity prices, of which a lot of ASEAN economies are benefactors to that. So what do we mean exactly by a just transition? And that's exactly what is the conversations that we are having across the portfolio with our clients. Now they are sort of between a rock and a hard place, because they are aware of the situation where there's increasingly becoming more focus on the E and the S and the G. And even down to the supply chain as well. A lot of Nestle has made public announcements that they won't buy from suppliers who do not meet certain criteria. So when we say a just transition, it really means that everybody needs to work hand in glove in order for us to move forward with this. And a lot of the conversations that we have with clients are basically, why do I need to do this right now? I'm trying to survive as a going concern. Other concerns which are understandable given the state of the global economy. But nevertheless, this is something that needs to be done now, whether you like it or not. You could call it, similar to something to the effect of digitalization. You don't see it as a cost, but see it as an investment. And if you don't, unfortunately, do it now or plan for this in the future, you're not future-proofing your business. Because as we move forward, and I'm sure my colleagues on the line will also tell you in terms of asset allocation, that this is increasingly becoming a point of focus and concern. So therefore, Yvonne, just to sort of conclude on that basis, this is that period of time where we're going through that change, and it's important for us as providers of capital from a financial institution basis, and also for our clients to move hand in glove in this trajectory. And if I can just conclude in terms of, whilst it's from a regulatory perspective, there's also increasing scrutiny coming onto the financial institutions. Some financial institutions are also voluntarily putting certain criteria of selection of how many % of their portfolio will be in alignment with, value-based intermediation, for example. So, what we are doing at HSBC Amanah is that we are on this trajectory to become a value-based aligned institution, inshallah. And with that means that we have an ambition that 51% of our financing and advances will be aligned with the triple bottom line principle. And that whether we can achieve that or not, or by when do we achieve that, really is is in respect of how can we do this together with our clients, because if they're not playing ball, then it's going to be difficult for us to grow those asset base.
Thank you. Anyone of you to comment on the asset management side?
I can comment if you want.
I think I saw Renee there. Between both of you, who can go first?
Ladies first.
Ladies.
Absolutely. You go.
Okay. So the just transition is something which is close to our hearts at BNP PAM. Why? Because we have a forward-looking perspective around three key issues, which are the energy transition, environmental sustainability, and equality and inclusive growth. So our idea is that those three themes really underpin more sustainable markets. And so we can't just go for the transition, just go for the environment, or just go for the social, but all three need to go together. So that is something which is visible in how we study companies, how we look at sectors, etc. And to go more deep down onto the just transition, it's important for companies to deal with this. But honestly, a just transition, everybody has to take part. So we have to also attack it from the stewardship angle, talking to public policy, politicians, regulators, because it takes a village to do a just transition. It can't only be done through private finance. We've seen examples of how coal mines were closed in Spain, for example, and there it was really a joint effort of the local governments, to the companies to help to retrain, to recreate other activities, because of course you have a basin of people who are working in those areas, so they can do another job. They are skilled, so you can retrain them. So I think that is also an important aspect to think of talking and encouraging governments and regulators, because privately it can't all be done through just private means.
I think Renee has something to add as well.
Yes, so I think everything that both Raja and Sheila just mentioned, I would start probably first with educating our investors what we do mean by, because sustainability still means very different things to different people. We need to educate our investors a lot around what in our case, that means particularly when it comes to ASEAN, that you absolutely should have companies, so companies who are still in the sectors that are affected, in your portfolio. Make sure that you have a process in place as an asset manager where you go system sustainability policies of these different companies. And I think there is a lot of teaching with the firms. We find a lot of companies that we engage, they want to learn around, so how are other firms doing it? And by helping them to have a plan for, for example, how do less waste, how can they over time have a better sustainability role? Engagement helps the transition. And we believe that over time, actually we find also company owners, they know that this is the path to go. It's just to use early on how fast they can get there. And I think there is where also regulation comes in, right? It needs to be a hand-in-hand process where there is some or pressure to some extent. Then also the investors need to put certain collaboration across, I think, investors, regulators, companies, blood.
Absolutely, Renee, because you've been in Asia for many years, And education and awareness can be tough, especially when it comes to the dealing with nature, the lack of belief in science, and belief that God caused all this can be quite challenging. But it's going there. We're all going there because the new generation of youth will help in some ways engage the older generation, their parents, as to what science means and what science can help in us adapting to the climate changes. Now, I hear that you are very clearly a proponent of education, getting awareness, and felicitating capacity building, I would say, to help us towards addressing these challenges. So I would like to ask that question, Renee, as to what extent, if you look at it from the perspective of the poorer nations, being in ASEAN or anywhere, where they will really need help, financial, in the adaptation process. So if you listen to many of the multilateral platforms today, there's a lot more requests now or conversations on the table as to how developed economies can fund and help fund the adaptation process for the poorer economic nations. What's your view on that, coming from global banks like where you are today and where BNP Paribas is today? Thank you.
So I think this is where I think events like become super critical, where we create the connectivity of forums, environmental groups, regulators come with the challenges and sort of like align the efforts, right? And I certainly, from a European perspective, there is a lot of efforts around reaching out also to a policy perspective on environmental policies. There is a lot of dialogue around it. It is by now understood that the cycles of the economy are different. Now, where the rubber hits the road is, to your point, how are these initiatives? How do we negotiate who should do how much by when, right? And as we all know, that's when politics comes also into the way.
Yeah. Yes. Sheila, do you have any comments there?
Well, I mean, I think it can, you know, of course, we can do things from maybe from a blended finance point of view with big development banks, encouraging private investments, because we know that it can't all be done with public money. If we're thinking of adaptation in particular, where, you know, countries are going to be affected, and when they're very poor, they maybe can't pay for that. So I think there's that kind of financing where private money can well, private, you know, not public, can come into it. And then of course there's the commitments of a number of developing nations that are not being respected as much as they should. They haven't been paying as much as they should. That's another place where, of course, financing will be coming from to help those countries. But I think that blended finance should also be a good a good road to go down, where an agency or a bank will support investors and on a good project.
Yeah. I think in view of time, we will have 2 more questions, right? I understand. So let me just thought that, Raja Amir, you know, the value-based intimidation is the so-called the good purpose of Islamic Bank. Why is it that we cannot bring it to the mainstream? In your view, are we converging sustainable finance now with the value-based intimidation philosophy? So invariably, when BNP Paribas, for example, or Aberdeen comes out with the new Sukuk bond, for example, or even a new green bond, a new sustainable bond, it would have qualified in many ways within the Islamic banking value system. Would then sustainable finance per se be converging with BVI? I'd like to hear your thoughts on that. Thank you.
Yeah, thanks, Yvonne. It's an interesting question. And in terms of the convergence of Islamic finance as well as sustainability and value-based intermediation. So, I mean, a lot of people argue, and I think, you know, Sheila was sort of mentioning it beforehand in terms of, you know, Sharia compliance and the exclusivity, or rather the Sharia screening methodology, which, you know, which from the start, even before ESG was even a word, and that's what a lot of people claim, you know, was already excluding certain sectors which are deemed as defense, you know, weaponry, alcohol and tobacco, so on and so forth. So therefore, you know, there is increasingly a convergence between sustainability as well as Islamic finance. But there's also some gaps that we must acknowledge as well. You know, you can raise Islamic financing for you know, in the past there's been coal-fired power plants which have been financed by project financing, Sukuk, and so on. But nevertheless, how in terms of, so there are some convergences and there's some gaps. That's to answer your second question. In terms of bringing it mainstream, now mainstream is something, again, it's, you know, it's when we say value-based intermediation, we are not forsaking profit. You know, profit is clearly, there's a responsibility to shareholders, there's a responsibility to stakeholders, but there's also an increased awareness of the role that you play as an institution in society in terms of the impact that your financing provides to the communities in which you serve. And, you know, so I feel that number one is that when you integrate value-based intermediation into your decision-making, number one, you are also, you know, you're not forsaking profit, that's clear. And number two is also that because of the impact that you're providing for, you know, society, you're actually creating a multiplier effect. Now, we've seen situations, you know, where there have been financial institutions in the globe, you know, just to name two of which, one is Triodos Bank, as well as Van City, which is sort of a funding entity, so Triodos Bank. And, you know, looking at their profitability, they've never forsaken profitability, they've never forsaken governance or risk, and they are clearly, you know, a value-based intermediator. So therefore, also, you know, that is a live case example of an institution which is brought that to the core of their funding methodology and not forsaken profit. And also when we talk about the kind of companies or the projects that you finance based on value-based intermediation, intuitively one would say that they would be much more sound and risk safe for the financial institution, because they pass certain matrix that you would have put in place to screen and only qualify for the best companies. So yeah, that's just the quick and dirty of it. But I mean, what we also have seen is that, you know, I mean, and I'm sure my colleagues Renee as well as Sheila can attest to that, you know, data has shown that investment in, you know, even from the fund management perspective, investment into companies which are socially, who have socially objectives have returned, you know, have returned investments performance which is higher, and also in terms of the volatility has also managed to, you know, withstand volatile situations.
Thank you. Renee, in your frontline activities with your clients, would you say today, because of the ESG considerations, they are prepared to have a lower rates of return on the performance of those portfolio that they have? Is that becoming an increasing trend, or is just some spurts now and then, especially when they see the recent announcement of some of the EU countries going back to coal, for example? How do you see that?
Very clear. Investors expect the same return or better through. You can go through every single survey. There is wishful thinking for us that we do sacrifice. It's absolutely not. And I think particularly in Asia, investors are very happy to go ESG compliant and sustainable returns, right? I mean, Absolutely, that's still the case. And I think that's a challenge for us as I do believe, and we have built a lot around climate scenario tools where we long run demonstrate that companies who have ESG framed risk, they have different plans, they will perform better because they have just a better ambition for through what you mentioned, flooding and all the risks that are out there. But on the short term, through the Ukraine event, not the case, right? And clients will not wait for us on this.
Yes, thank you. Sheila, one last question to you. Sitting where you are in the center of Europe, as well as in France, the headquarters of BNP Paribas, a global bank. What are the early success stories, or whether it's our policy or collaboration, or even technologies that have improved and have helped the climate change transition, that you think that can be shared with Asia? Is there any early success stories or that you think you can share?
Well, I think around collaboration between countries, everything that's happening and which has been pushed by the European Union around, the technical experts who, for example, set up a taxonomy, which we have seen that, countries in APAC are looking to see that taxonomy. It was set up by a group of, why not take advantage of that in ASEAN? We've seen that Singapore actually looked at the EU taxonomy to see how it could be adapted, and China has worked together with the EU on a common ground taxonomy, CGT, to make sure that there's consistency from one market to another. So I think that Europe has really shown the way on how we can collaborate between different nations all together by also setting up, the idea is to redirect finance, and I think that is the basis of it all, and that is done through the taxonomy, through fund regulation, and through ESG disclosure. What we need is consistency in standards in those three types of regulations. So I mentioned, the taxonomy and how Singapore is already, looking to apply it. But even if you look at fund regulation, today it's possible for asset managers to use SFDR disclosure to meet Hong Kong regulatory requirements. So, if that kind of thing can be multiplied, then we can really have, and if SFDR, so it's Sustainable Financial Disclosure Regulation, it's all about transparency, and I think that's what we're really looking to, not only for us to invest, but also to show to clients, and so that clients can then compare across the board what is comparable on the same terms. This is the same with MiFID, where we're going to ask clients about their preferences, their sustainable preferences, without convincing them, but just showing them, well, this is what there is on taxonomy, this is what there is on sustainable investment, this is what there is on the principal adverse impacts. What is it you want to see in your portfolio? I think that sort of brings the whole community together, because unfortunately, I can't remember if it was Renee or Amir who mentioned it. Not everybody looks at sustainability in the same way. So, so if we have to really put it on a level playing field, and that's what SFDR and MiFID are doing. And finally, around ESG disclosure, it's great to see more and more initiatives, but let's use international standards. So companies are disclosing ESG characteristics in the same way across the world, and we as asset managers and even banks looking at those clients can have the same information and to be able to judge across the board. And that, I don't think, should put countries that are emerging in a bad position, in the sense that, in any case, how we look at it is that we are going to compare companies that are in the same type of region. So we're not going to compare a developed nation a utility to a developing nation utility. So So we totally agree that we're not all at the same level of advancement, but we can also agree that developing nations should look to the type of thing we have established, because there's a kind of a blueprint, and there may be some local differences, okay, but the spirit has to be the same.
Thank you. It looks like we have to end the session shortly, but what I would probably do is very quick, some concluding remarks. We have heard very clearly that the new stakeholders of environment and society is now front and center of our conversations. So whether you're in a developed economy or a developing economy, or ASEAN for that matter, for the first time, I think the world is finally converging to knowing and acknowledging the fact where you need to rewire our own economy and nations to going forward. And as you said, whether developed or developing countries, over time we will converge. We obviously cannot ignore what's happening. The discourse has made it very clear, and therefore the changing nature of leadership and the preparedness of nations. It's a complex movement. The role of business, purpose in society, financial institutions, asset management companies, investing community, is called to solve together with regulation policymakers. In fact, what Renee said just now, mindsets and paradigm shifts, education, and the whole of leadership will need to change to deliver value and purpose, as well for us all to respond to the climate and the social crisis. So it's capacity building that we talked about, the confluence of science, academia, technology, collaborations, private-public relationships, and the whole of government to ensure that we have a consistent, transparent, and just transition. In the process, not to forget integrating the S and the G. We need to break from the past and take the opportunity to redefine business models. In fact, I always say it's actually the best time to redefine your own competitive advantage. Be it a company, be it a bank, be it a country, a nation. I think our competitive advantage can change if even the nations as a whole do not, and the government or the political leaders do not realize that it's those who are prepared, those who are willing to take the change and go to some short-term pain will be the long-term winners. With that, ladies and gentlemen, it's been wonderful to have my colleagues with me today, and I want to thank each and every one of them to have contributed to this leadership fireside. So have a good session in the afternoon and going forward. Thank you very much.
Thank you, Yvonne, firstly, for that excellent overview of the economic and environmental situation for ASEAN, and to the panel speakers for the great session. The discussion certainly raised several pertinent points on challenges of financing climate action and sustainability measures across ASEAN, and the role of financial institutions in the region in addressing those challenges. I think a comment from Renee that particularly stood out for me was when he said, without Asia, there is no decarbonization, succinctly highlighting the key role that Asian economies play in the global supply chain. Closer to home, we now bring your attention to small and medium-sized enterprises, SMEs, which have always been the lifeblood of the Malaysian economy. SMEs form an integral part of the Malaysian economy as they contribute over 500 billion, around 38% of our GDP. However, the negative effects of COVID-19 on the economy have been significant across all industries, and naturally, SMEs have not been spared the repercussions. So this year, Malaysian SMEs continue to be caught in a situation fraught with risks and challenges. But with every cloud, there is a silver lining, they say. And in the move towards economic recovery, SMEs have been presented with new opportunities for growth and transformation to the digital economy. This brings us to the next session in the lineup, where we will be launching the guide for Malaysian banks supporting SMEs in the sustainable recovery from COVID-19. Produced by GEFI for the United Nations Environment Programme Finance Initiative, UNEP-FI, the publication focuses on how financial institutions can better assist local SMEs to accelerate their business strategies sustainably, especially in the digital sphere. Taking us through the launch and presentation of the guide is Natalie Jackson, Executive Manager at the Global Ethical Finance Initiative. Natalie has over 10 years of experience working in finance and is passionate about how finance can be used to deliver social and environmental impact. A chartered accountant, she was one of the finalists in the One Young CA competition and was nominated as one of ICA's top accountants under 35 in the field of sustainability and corporate responsibility. Natalie has worked extensively with social enterprises and has spent the last 6 years working in project finance with a focus on education, infrastructure, and renewable energy projects. She currently sits on the Social Growth Fund Board at Social Investment Scotland, advising on the disbursement of £17 million of funding to Scottish social enterprises. Over to you, Natalie.
Thank you for the kind introduction, Shireen. So hello, everyone. It's great to welcome you here today to launch the guide for Malaysian banks supporting SMEs in the sustainable recovery from COVID. I know we're joined today by representatives from across the globe, so good morning, good afternoon, or good evening to you, depending on where in the world you are. As a point of introduction, I'm Natalie Jackson, Technical Lead at GEFI. The purpose of the session today is to provide an overview of the guide, which is being launched today, and also hear insights from a couple of Malaysian banks who were involved in its development. I've got the pleasure of being joined today by Zamima Arif, Head of Sustainability at AmBank Group, and Rizal Il Hizan, CEO of Alliance Islam Bank Bahad. So a warm welcome to you both. It's great to have you here. I will be your host today and will provide a 10-minute presentation on the guide itself, and this will be followed by approximately 30 minutes of dialogue with Zamima and Rizal. So let's get started. So GEFI was commissioned by the United Nations Environment Programme Finance Initiative to develop the guide and associated framework, which provides 19 practical actions that banks can take to assist SMEs on their sustainability journey. So first, a bit of scene setting. Support for SMEs on sustainability is of paramount importance, especially in Malaysia, where in 2020, SMEs represented 97% of total business establishments, 48% of total employment, and contributed 38% of GDP. Whilst many large corporates are making significant progress around sustainability, especially around initiatives such as net zero, there is a risk that SMEs get left behind. The recovery from the COVID pandemic provides an opportunity to align spending and priorities to a more sustainable future for all. In developing the guide and associated framework, we spoke to Malaysian and international banks on their approach to supporting SMEs in the sustainable recovery. Although this guide was primarily developed working with the Malaysian banks, its practical actions are applicable to banks worldwide. During these conversations with Malaysian banks, it's been great to see the enthusiasm from the banks, as well as hear more about some of the great initiatives that are already underway. This is an exciting time to build on the work that's already been done and explore ways in which banks can collectively further support SMEs in their sustainability journey. It feels like there's momentum building, and there is a great opportunity to think beyond what individual banks can do towards collective action. The findings from this guide can help grow the ecosystem, both in Malaysia and beyond. During discussions with Malaysian banks, we noted 4 key areas that are motivating them to act. Firstly, the global megatrend around sustainability, with more and more financial institutions engaging on the topic. Secondly, many banks have set internal targets around sustainability, such as net zero by 2050 or X billion of sustainable lending by a certain date. Thirdly, there's an increasing demand from customers for sustainability-linked products, aligned with the global megatrend. And finally, government policies and initiatives are encouraging action from banks. The Low Carbon Transition Facility and Climate Change Principle-Based Taxonomy from Bank Negara Malaysia specifically were noted. Engagement with SMEs with sustainability is low, both in Malaysia and worldwide. The guide aims to assist banks in their journey. So that provides some context. Now to come on to the guide itself. So it's split into 4 main sections. Part 1 is the framework itself, which includes the 19 suggested actions for bank to take within key focus areas, as well as practical steps for product development. The guide also includes practical examples, including deep dive case studies on CIMB and NatWest, as well as insights from actions taken by Malaysian banks, including AmBank and Alliance Islamic Bank. Part 2 is the foundations for the framework and provides insights on the international policy landscape and net zero, as well as Malaysian government initiatives, SMEs and the local banking sector. Part 3 looks at the differentiated approach offered by Islamic finance and how values-based intermediation is being used. Part 4 is the final section of the guide and focuses on next steps and additional support required. We'll now dig a bit deeper into the framework itself. The framework sits within the international and Malaysian context of sustainability, as well as the local banking sector and SME environment. The framework is intended to build on existing global and national initiatives rather than replace or duplicate them. The framework covers 3 key areas where banks can act, namely through a bank-wide approach, supporting SMEs, and product development. So in terms of the bank-wide approach, the importance of formalizing a bank's approach to sustainability through guiding sustainability principles, governance, and frameworks are key. These codify the bank's approach to sustainability and ensure focus. Reporting and disclosure around sustainability is also important, with several Malaysian banks using international reporting approaches, such as the Task Force on Climate-Related Financial Disclosures and the Global Reporting Initiative. The value of working with stakeholders is also fundamental to understand the market, communicate the importance of sustainability to staff members, and increase knowledge. Collaboration with stakeholders on sustainability through staff training, customer research and surveys, guidance from industry experts is also noted as helping increase awareness and focus on sustainability within the bank. A couple of banks we spoke to have also set up one-stop shops for sustainability solutions, providing customers with end-to-end support on certain products such as solar, from the feasibility study through to the after-sales support and warranties. This makes it as easy as possible for customers to access products and the associated support. So it's noted that SMEs need a lot of support and hand-holding, as many have limited knowledge and awareness, and they have little time or capacity to think about sustainability. Many Malaysian banks have focused on capacity building, seeing this as a key area where they can assist SMEs. Banks can help raise awareness on how other customers are approaching sustainability through shared insights from larger corporate customers with SMEs, as well as demystifying some of the aspects of sustainability by facilitating collaborations. Banks can also help SME customers understand where they currently are in their sustainability journey and where they want to get to. This can be done by embedding sustainability aspects in standard credit assessment processes, as well as completing baseline assessments for new customers. This can help SMEs think about next steps and transition plans. Many SMEs may not engage with sustainability as they can't see the benefits. Therefore, reporting SME sustainability success stories is also key, and organising roadshows to promote SME sustainability products helps to raise awareness amongst SMEs of what is available. Banks can also take a proactive approach in supporting sustainability by accelerating sustainable solutions in important sectors, such as low carbon transport or agriculture. During the COVID pandemic, many banks focused on digitalisation to ensure the long-term survival and sustainability of SMEs. The final aspect of the framework is on product development. These products need to be available for a more sustainable approach. It seems that to date, a lot of Malaysian banks have focused on solar products for sustainable SME lending, but many are starting to think beyond this to other products, including transition facilities. In product development, the banks we spoke to use different frameworks, either international, national, or developed ones in-house. This provided a clear structure and criteria for product development. The development of new products was grounded in customer research, understanding what the challenges customers were facing and how these could be overcome. A lot of banks also referred to the importance of working with industry partners, especially in complex areas or where technology was involved. Following product release, education of relationship managers to understand why sustainability is important and how it's incorporated into the product was noted as being valuable, as well as continuous product improvement as the sustainability landscape evolves. The next steps for Malaysian banks to support SMEs were noted as being further capacity building for SMEs on sustainability, including key focus areas such as measuring greenhouse gas emissions, the continued education of relationship managers, and the development of more complex sustainability-linked products. Malaysian banks, however, should not be solely responsible for assisting SMEs in their sustainability journey. Collaboration and support from other parties, such as the government and industry groups, should also play a role in providing financial support, capacity building, and developing a standardised approach. So that brings me to the end of the quick overview of the guide, and we'd like to thank the following banks for their participation in interviews which helped in the guide's development. So thank you for listening, and please get in touch if you want to find out more about the guide, and a copy of the guide will be available for download from the GEFI website. So now we'll hear more from Zamima and Rizal on their experiences. So to start with, a question to both of you. So why do you think it is important for Malaysian banks to support SMEs in their sustainability journey? And please, can you provide an overview of the main ways in which your bank is supporting SMEs on sustainability? So over to you first, Zamima.
Good morning, good afternoon, good evening to everyone who's joining us at this launch. And Assalamu alaikum for those who are from all parts of the world. For this launch by GEFI on how to support SMEs from the perspective of Malaysian banks. Now, the first question that you asked us was actually about the why Malaysian banks should think about supporting SMEs in their journey towards sustainability. Now, you already mentioned the key element, which was the part on the fact that they account for 90%, 45% of the labor force, as well as 38% of the GDP. So that's one of the key areas why we should also concentrate on them. Now, one of the key areas which SMEs are also increasingly facing pressures from is to measure and manage their impact on the environment. So that's kind of like the shareholder perspective and the people, the customers' perspective who's looking at the SMEs. The second part is actually they form an integral part of the supply chain for a lot of people in the market. And some of these contracts, when you're trying to secure contracts, be it with governments, GLCs, big, large corporations, now these corporations and these people are demanding that the SMEs also play a part in making sure they are also on the sustainability journey. For example, if you take a global company like Nestle, they have committed to look through their supply journey up to the little farmer, where they get single origin coffee from or milk products from, to also join the sustainability journey. Therefore, this is one of the key reasons why we as banks need to support them on the sustainability journey, because that is to ensure their long-term survival. And that's also to make sure we safeguard our balance sheets in that way when we are also lending to the SMEs. We also have to ensure that the resources that the SMEs are going to get from, they would then be able to continue to offer their products and services in the future. Natalie, I hope that answers your question or with regards to why we support SME. Now, just to check on the next question was actually on how MBank is actually supporting SMEs on sustainability journey. Now, this is a very interesting question, and this is a question that I actually had to grapple with, because currently, as you may know, that Bank Negara has come out with the climate change principle-based taxonomy, which means that we have to grade our corporates, our companies, all the non-individual accounts, to give them a rating from a climate change perspective. What's interesting is the questions that we get from our RMs. How are we going to ask these questions when we ourselves don't understand these questions? So the first thing we did was actually to educate our RMs so they can then speak to the SMEs. So how we support them right now, what is going on right now is having that conversation with the SMEs. How do you do the math with GHG calculations? How do we then use that calculation to map out your journey? And then we're also educating them through our RMs. It's not been formalized. Later on, I'll share a little bit more on how that process is getting formalized. But right now, what we've done is, as I said earlier, we've actually sort of engaged with our own RMs, our relationship managers, so that they understand the kind of question that they have to ask the companies. And now the dialogue is ongoing with the companies. Okay, so these are the questions you're asking me. How do I then, if I'm graded at a certain level, how do I then move my rating to a certain level? And that conversation is what is proving to be powerful, because the kind of engagement that I'm having with the RMs is very interesting, because the SMEs are actually asking us the question, so does this mean it's going to increase the cost of operating? How are we going to manage the cost of, including all these new elements from ESG perspective? Does that cost increase my costs? And how can I then support myself, especially right now, as rightfully you mentioned, post-COVID era, a lot of the SMEs are actually very focused on survival and pushing forward, growing from where they've started post-COVID. So we've, this is exactly why you need to educate the SMEs to say, this is exactly why at this time, business continuity plans post-COVID, this is why you need to think about making yourself more ESG compliant, thinking about sustainability, thinking what you can do to save costs. So that's one of the ways that we are actually supporting the SMEs.
Fantastic. That's great to hear, and especially around that kind of education capacity building. And now over to you, Rizal. It'd be great to hear, same questions of why you think it's important for Malaysian banks to support SMEs and some of the work that you're doing at Alliance Islamic Bank. So over to you.
Sure. Thanks, Natalie. So SME's importance to the economy, we don't need to belabor this. We know the stats for this. They're a third of the economy. They're at least half of the employers of the workforce population in Malaysia. They're 90% of registered enterprises, right, and 20% of exports. And yet when you look at the dimensions of this, you compare that against the readiness and ability to address risks associated with ESG, the story might be slightly different, but there's a huge contrast here. There's an economic summit that was held here a couple of days ago where I think one of the things discussed, or one of the findings that they've had, is that SMEs do not necessarily see ESG as a priority currently, and they're still trying to grasp the benefits and significance of ESG adoption. A study done by a local institution before this found that SMEs cited increased costs as a disincentive for ESG adoption. And it's not compelling proposition for them, considering that many of the SMEs are still reeling from the impact of the COVID-19 pandemic still, right? So what you have here is huge impact on the economy, perhaps not so ready and not so able to address ESG risk. So you're looking at a segment that's actually quite vulnerable to ESG risks, right? And even so, as instances of natural hazards become more frequent and more intense, that vulnerability increases. In 2015, for example, we had a huge, in Malaysia, basically we have flood risk, which is the predominant natural risk that we have here, or physical risk. In 2015, we had floods in Kelantan, for example, 13,000 SMEs were affected with about 1 billion ringgit in estimated losses. In the more recent floods in December 2021, the estimated losses were more around to the tune of about 6 billion ringgit. And 35% of SMEs affected were in the economically critical Klang Valley area. And these disruptions have caused disruptions in supply chain and business continuity, and is exacerbated even further by the lack of take-up of natural disaster insurance. The coverage, I think, was estimated at only 10% of the December 2021 flood losses. And we know of farms which have been destroyed, factories and businesses devastated, and stocks spoiled due to the floods, right? Why do we have this state of vulnerability? One is lack of knowledge on the part of SMEs. That awareness perhaps is still at the nascent stage and probably needs to be addressed. Second, in terms of resources and capability to address ESG risks, and on the flip side, tap on opportunities is also at that nascency. Thirdly, there's lack of available solutions and tools in this particular area. Even as corporates struggle in this particular space, that challenge is multiplied or magnified even further in the SME space itself. So from the perspective of Alliance Bank, our focus has always been in the SME space. So we're here to help SMEs with sustainability risk, as well as frame it from an opportunity perspective as well, by providing financial and non-financial assistance to ensure the longer-term business viability, which I think Zamima alluded to earlier as well. We clearly take a more nurturing approach for SMEs and business owners to transition towards sustainable practices as well. As I mentioned, we've long been an advocate for and supported SMEs. Our mantra is to be the most important relationship in business owners' pursuit of success. So that relationship encompasses a more holistic view of support to the business owner, be it from a financial or non-financial, i.e. advisory perspective. For sustainability, we support SMEs in two ways. One is we provide funding support for investments into renewable energy technology and investments to transition to a low carbon business. And secondly, we provide sustainability assistance program for businesses. On funding, we have a goal of supporting at least 10 billion ringgit in funding and investment into new sustainable businesses, projects and assets. Last year, we've already achieved 2 billion ringgit in new sustainable loans and investments. Now, out of that, 20%, or about 410 million, was directed towards SMEs. On sustainability assistance, we've entered into two strategic partnerships. First is with Bursa Malaysia, and the other is with the Malaysian Green Technology and Climate Change Corporation, otherwise known as MGTC. Our collaboration with Bursa Malaysia is on their #financing for ESG program, which aims to improve ESG adoption practices amongst PLCs. Under this program, PLCs undergo a FTSE4Good gap analysis conducted by Bursa. Subsequently, we provide funding to help these PLCs transform their operations to address the specific gaps identified and match them with green solution providers, which we have under our BizSmart solution portal, which is sort of like a one-stop online business community portal where we provide business owners relevant solutions and resources for their sustainability journey. Apart from that, we help business owners improve their ESG practices with advisory and training under the Green SME Nurturing and Development Program. Our partner MGTC assists ESG solution providers to obtain the My Hijau certificate and be listed on the My Hijau directory. And that's an online resource for certified green products and services. The My Hijau mark is actually the official green recognition endorsed by the Malaysian government. So that's, in a nutshell, how we're helping SMEs.
Fantastic. It's great to hear of the amazing work being completed by both banks. So now over to you, Zamima, to just dig a little bit more into it. So I know AmBank have been doing a lot around greenhouse gas emissions specifically. Please, can you share a little bit more about your experiences, both the kind of successes you've had and the challenges that you've had to overcome?
All right, thank you for that, Natalie. That was a very interesting introduction by Rizal as well. So the GHG emissions, maybe I'll talk about the challenges first. Because we've kind of mapped out our own, which is the scope 1, scope 2, scope 3. The scope 3 under the financed emissions, the GHG emissions, that's something that we are all, I think it's a journey that we're all going to be embarking on when Bank Negara comes out with its policy document on climate risk management. But internally, the greenhouse gases emission, we've got lots of different initiatives around that. We've got targets that we have to achieve internally. And then we've also got single-use plastic education, know your carbon footprint education going on. The solar PV panels at our Damansara Fairway 3, which is the building or office building, they continue to generate about 86,000 kilowatt of clean energy, and they offset about 50.32 metric tons of carbon emissions for financial year 2022. And then in financial year 2022 as well, we significantly reduced our overall carbon emissions by 1,500 tons from financial 2021. Through several energy management initiatives, such as the LED lighting, subscription to green and renewable energy source, as well as lesser traveling. Now, the lesser traveling part, of course, is because of the COVID restrictions as well during the pandemic. So that's a word of caution. I think that's also a form of a challenge that we're looking at, because we cannot map out a GHG using just the during COVID emissions. So that's something that we're also looking at. How is it, now that everything is opening up, how will that add traveling time, car usage? So all of those are actually being calculated as well. Now, we also were issued by SEB, which is the energy plant, renewable energy certificates, to certify that all our energy consumption for operation in Sarawak was supplied by hydroelectricity source, resulting in a carbon offset about 970 metric tons of CO2 emissions for financial year 2022. And the main thing is we've also subscribed to a green electricity tariff by TNB for its energy consumption from its operations in Peninsular Malaysia in February 2022, which has resulted in a carbon offset of 133 metric ton of CO2 emission for financial year 2022. We've also reduced other things. So I told you about the single plastic use. We've also done the A3 and A4 paper consumption by 31% in financial year 2022, exceeding some of the targets. Now, for all of this, the energy consumption itself, and also getting ISO certification. So we have a lot of targets that we have set for ourselves. Now, and each of it is measured on a quarterly basis, and that's measured not just by the department that's responsible for it, but we also report it as part of KPI for management, and then it is also part of KPI that is sent out to the board as well. Now, what is the challenge? The biggest challenge, of course, is making sure that we don't become complacent, because of the fact that some of the math was done during COVID. So I always like to ask the question, okay, now that we are back traveling, back in office, the lights are on a lot longer, how are the calculation right now, and what is the math, and I want to know how we can actually reduce those GHG emissions as well. Now, we've also done something else because we did a ESG Investor Day this year, beginning of January 2022. We also started a collaboration with Yayasan Hijau, which is mapping out 100 million planting of trees in Malaysia. So we did a collab with them to plant trees for, instead of giving out any sort of like, for each of our participants, for each of our people who came for the conference, and as well as the speakers, we planted trees on their behalf as well. So that's a collaboration that we think that will become even more deeper as we go along. And that will also be part of how we do the math for our GHG emissions in the building, as well as part of the group as well. I hope that answers your question.
Thank you. And it's that focus as well with greenhouse gas emissions and considering the portfolio and SMEs as well.
Yeah.
And when we last spoke, you'd mentioned that Anbank have been developing training on sustainability.
Yep.
Please, could you talk a little bit more about the program, and also, what you think the essential topics are for SMEs specifically?
All right. Okay. So that's actually, we're doing it with an external training provider. So we're going to we've already formulated some sort of a course outline for that. So one of the key things is actually mapping out for the SMEs what ESG and sustainability means for them, as just mentioned earlier by Rizal as well, that, they are having issues and understanding and grappling how this works for them as SMEs, and is it cost effective for them? Does it mean they have to spend more money? How important is it for me? So I think that is the first thing we need to lay the foundation. Why is it important? And I think a lot of them are also beginning to understand that if I'm going to trade with another bigger MNC, GLC, government, or any other organization, this is going to be a big point. So that's the first core foundation that we want to impart. The next thing we want to do is actually, around GHG emissions itself. A lot of people are finding it difficult understanding, how do I do this for my business? There are a lot of resources out there. So as long as you can actually teach them sort of to go to those resources and to calculate, I think that will be one of the key areas. Now, we internally have also done something called Know Your Carbon Footprint for our own people. Now, this is how we get our RMs to learn intuitively what it means, what greenhouse means for me as an individual, and what it would mean for the SMEs as well, specifically. So the other part of the syllabus is going to be GHG calculations. Now, we also understand that different industries have different ways of doing the math, and we can't sit down and teach everybody in every industry. So for starters, we actually are just going to point them to certain resources where they can actually go to get more education on it. There's only one way of doing this, which is knowledge transfer and capacity building and upskilling. There's only one way to kind of engage them. Now, I also think that the financial aspects of it, doing, sort of like mapping out in their own minds, why is it very important to be on this journey? And the other part, which I think, which is the last part of the syllabus, is actually opportunities. Just now, Rizal mentioned all the resources that are available for SMEs. So the opportunities when you transition from going to a lower carbon economy, going greener, identifying, Mbank has also tied up with some people who do solar panels, and then we finance that. So how do factories who want to become greener can actually engage with some of these companies and also fit their plants with solar panels? So the education on those parts, that's one of the key areas that we're looking at. So the opportunity piece, what is it in it for me to be on this journey? Why do I need to be on this journey? How come I should be on this journey? So from a perspective of financing, from a perspective of emissions, from a perspective of engaging with your customers, from a perspective of dealing with the people that you are going to be your suppliers, in every aspect of it, it becomes important. So we're kind of like taking in a syllabus. Now, although it sounds like a lot of things, we also need to kind of run it down to smaller pieces so that they can actually engage properly. So I think that one of the laying the foundation and then giving them the education on the GHG emissions is going to be very, very crucial. Now, one of the things I think what's in it for you is actually something called carbon tax, right? Singapore already has a carbon tax and they already have the math for it, and they have the carbon pricing as well. Right now, I think it's Sing 5, which is expected to go higher and higher. Now, if that is going to be coming to town, everybody needs to know the math. So what's in it for you is some of these things that we have to explain to the SME. So that's where our training is kind of how we mapped out the whole training program for the SMEs. So that's hopefully that will be launched sometime this year very quickly, and then we can onboard those training, and then we can also tie up for future trainings. The SMEs actually can engage directly with the trainers to sort of train them further and deepen their understanding on that specific subject.
Fantastic, that's great. And I think it's key, you say, Zamira, about highlighting the opportunities for SMEs so they can really get on board with sustainability. So yeah. Thank you. Now over to you, Rizal. We understand that Alliance Islamic Bank works with partners to conduct gap analysis and develop sustainability roadmaps for customers, as well as offering sustainability solutions and financing. Please, can you talk a little bit more about what you've done in this area and share some success stories? Over to you.
Exactly. So I mentioned about the sustainability assistance program we have for businesses. The goal of this program is to offer a comprehensive value proposition around sustainability that helps business owners adopt sustainable practices for their businesses. I mentioned earlier about the issue of costs. So one of the things we want to ensure is that in this assistance, it helps to reduce the business owners' operating costs on energy, waste, water, and as much as possible, utilize renewable sources. We want to help them enjoy any green tax or capital incentives that come with these actions. We mentioned earlier about how if they interact or engage with MNCs, and with that comes sustainability requirements, we want to help them meet those supply chain requirements and become much more competitive. We want to improve the branding of these companies and or their products, and prepare them to have a green-friendly IPO profile and enhance their prospectus to investors. So there's 3 parts to this sustainability assistance program. One is on the advisory and outreach piece. Second is on the transition enablers. And the third piece is around financing support. Under advisory and outreach, what we offer is an ESG gap analysis or a screener to help these SMEs identify potential focus areas for SMEs to improve. Like mBank, we have also operationalized using the CCPP, the climate change and principle-based taxonomy, into the screeners we apply with our customers at the point of onboarding, as well as during annual reviews. And yes, they're great icebreakers when it comes to understanding ESG gaps within the business. But at the same time, also, it helps define some potential action areas, and we could help point towards solutions within our own program to help our customers address those gaps. Second is we do workshops and trainings to enable the SMEs to understand the specific topic of ESG and understand the risks and opportunities that come with paying attention to the ESG aspects of their businesses. We help them with advisory services to build roadmaps towards sustainable business adoption. And we help to profile successful projects and improvements done by these SMEs. So that's the bit under the advisory and outreach. On the second pillar around transition enabling, via the BizSmart solution portal that I mentioned earlier, and with the MGTC partnership that we have, we provide the widest range of ESG solutions for our clients. So this can come in the form of advice or consultancy by folks in terms of how do they reduce their energy usage, or it can come down to understanding perhaps how they can reduce their greenhouse gas emissions through more efficient processes. We also include solution providers. So this may include solar PV providers, other types of renewable energy technology providers, and so on and so forth. Secondly, we want to be able to match the right solutions to the customers to improve their ESG gaps. There are, of course, price points considerations for SMEs, and it will be upon us to ensure that we have different levels of providers to ensure that it kind of fits into whatever the price appetite levels would be for these SMEs. We also want to ensure that the solutions that we provide focus on the highest cost efficiency and environmental impact. So it can come from technologies ranging from solar, biogas, water, waste, and circular type of solutions. The third piece is on financing support. So the financing for ESG program, which we do with Bursa, we finance green tech providers, we finance green projects, we provide sustainability-linked loans, or rather that's something that we're working on, sustainability-linked loans as well as sukuks. And we will also finance residential as well as business premises, rooftops for solar panels as well. We tap on the Low Carbon Transition Facility Fund, which Bank Negara provides to offer solar PV rooftop financing for SMEs. Apart from that, as I mentioned, we're looking into green as well as sustainability-linked loans and sukuks as well. Now, through this program, we have assisted more than 20 customers, and so far, in terms of financing support, it's about 48 million. And this feeds into that 300. The number that we had earlier, about 300 million in financing that we directed towards SMEs. So that's pretty much in a nutshell, what we provide to our customers, Natalie.
Yeah, fantastic. That's great. And it's great to see that kind of holistic approach and also helping SME customers on that transition of where they are, where they need to get to. So the final question to you, Rizal, is, how has being an Islamic finance institution and initiatives like value-based intermediation shaped your approach to sustainability and work with SMEs?
Yes, so as we know, sustainability is actually quite congruent with the whole value-based intermediation or VBI movement in Islamic banking. The VBI focuses on upholding social justice and developing a values-based economy as part of the Islamic banking business model. This has had a huge impact on Alliance Islamic Bank. Our VBI/sustainability journey began in about 2017 when we pioneered the development of a program to assist SMEs to succeed in the halal economy. We also developed a social crowdfunding program for social enterprises and at-risk communities to help them elevate themselves economically through entrepreneurship. This was all done under a mission to promote financial inclusion and businesses and projects that impact positively on communities as well as the ecology. A couple of years ago, in about 2020, 2021, we paired the experience we had in Islamic banking side with the group's focus, or the larger Alliance Bank group's focus on helping business owners succeed to establish our approach to sustainability, which is premised on 5 main areas. One is we offer products and services to promote transition to sustainable business models. 2 is we encourage businesses to embrace digitization to be more sustainable. Our folks here have kind of coined this term called digitainable, which is a mix between digitization and sustainability. 3rd is we work with partners to provide advisory on sustainability roadmaps, which I mentioned earlier, implement sustainable solutions within that roadmap. Fourthly, we integrate sustainability considerations into our own policies and practices. And fifthly, we promote the financial empowerment of SMEs through education, upskilling, as well as financing. Now, all of these above are consistent with the 5 purposes of Sharia, which are the protection of life, lineage, wealth, intellect, as well as faith. Apart from that, the VBI movement has also focused on developing tools, practical tools that can be used by Islamic banks when it comes to assessing ESG risks in different sectors. So there have been around 6 sectoral guides that have been published by the Islamic banking industry, which we call the VBI Impact Assessment Framework Sectoral Guides. Now, these guides provide an assessment of the key ESG risks within specific sectors, how to manage and measure them, and basically the specific things that we look for in terms of mitigation when we're assessing ESG risks in our customers. Now, these VBI sectoral guides have actually been quite useful for us in Alliance Bank Group as a whole, not just on the Islamic banking side. In fact, we've incorporated the elements in the VBI sectoral guides into the overall bank's risk acceptance criteria. So we apply this to our customers currently as we onboard them and as we review them on an annual basis. Okay.
Fantastic, that's great. So now I'm aware of time, and it'd be great to speak to you both for much longer, but unfortunately time is tight. So I think just to finish with one final question to you both, which is if you had 3 pieces of advice for other banks wanting to support SMEs on their sustainability journey, what would they be? So over to you first, Samima.
I think the first thing is education. So let's all educate the market. So let's get everybody on board. The second thing is actually, I like the piece just which Rizal pointed out, which is the financing part and the advisory part. So the 3 things that I think are great is the knowledge, advisory, and financing.
Fantastic. And over to you, Rizal.
I echo the same thing. I think number 1, advocacy and awareness would be the first wave of efforts. Banks need to invest in outreach programs like what Zamima mentioned and what Alliance Bank is also doing as well. We need to enlighten SMEs on the ESG dimensions of their businesses, frame this not just from a compliance or risk subject matter perspective, but more as an opportunity to ensure the longevity and growth of their business. Second, we need to embed ESG due diligence into credit and investment onboarding and annual reviews. This forms a basis to have conversations with customers on ESG risks and identify opportunities they can pursue arising out of ESG factors. Here it's best to nurture rather than exclude. Thirdly, SMEs are a wide demographic with different levels of readiness and motivation for ESG matters. Segment accordingly and dedicate efforts to low-hanging fruits before moving on to other more challenging segments. I know it's 3, I'll give you one more bonus advice. Banks need to focus on their own conduct. Need to ensure that we walk the talk as well, ensure that we're doing the right things when it comes to sustainable business models.
Fantastic. I love a bonus top tip as well. So just leaves to me to say a huge thank you to both Rizal and Zamima for your contributions. It's great to speak to you on the day that we launch the guide, which will be useful for banks worldwide. And then also to say thank you to the audience for listening and enjoy the rest of your day. Now back to you, Shireen.
Thank you, Natalie, for the interesting insights on the new guide for SME banking in Malaysia from GEFI and UNEP-FI, along with speakers Zamima and Rizal from AmBank and Alliance Islamic Bank, respectively, for sharing your journey. This guide is surely a step in the right direction for financial institutions to do more in supporting this very important sector. So to find out more about the guide, you can actually click the banner below for more details. Ladies and gentlemen, the next session in the lineup is a presentation on the climate challenge in ASEAN by Yuki Yasui, Regional Director, Glasgow Financial Alliance for Net Zero APAC Network. But before that, more importantly, let's take a break to refresh, have a quick bite, and we'll see you back online at 12:30. See you shortly.
always remember whose little coins these are that become the millions and the billions that pass through your hands. Whose hard-earned savings are these? Upon whose backs do streams of sweat flow? Whom do they look to for a better tomorrow? Who are the ones who make the daily sacrifices to develop entire communities, to build a business, to raise a child, to construct highways, to set up schools? Always remember the lives that depend on you. I am an AICB member, and I'll always remember whose money it is. Be a chartered banker.
The SDG's Financial Products Platform showcases commercial financial products that are directly aligned to the Sustainable Development Goals.
The platform's aim is to facilitate the development of innovative, SDG-aligned financial products across asset classes that ultimately build the ecosystem of SDG investing.
We know that private sector-led solutions are required to deliver the SDGs. But in a market of virtue signalling and champagne stewardship, it is difficult to discern which products are truly aligned with the SDGs.
The SDGs provide an opportunity for financial institutions to embed people, planet, and profit in their products.
The world of ESG is full of jargon and fragmented approaches currently. And focusing on something that's been agreed and in place since 2015, sponsored by the UN, to direct our thinking and analysis around investment and to measure the outcomes of how that investment is performing, gives us a real strong platform to make progress and to enhance people's savings with some benefit to the world. We're incredibly pleased to be part of the Global Ethical Finance Initiative. We believe that the work we have done around sustainable sovereign bond investing merits a broad audience, and GEFI gives us that broader audience than that which we could achieve ourselves.
The platform is open to applications from new and existing financial products representing leading market practice across different asset classes.
Products listed on the platform must be of significant size, ideally in excess of 100 million, and scalable. Platform partners must demonstrate genuine commitment to the SDGs and be willing to share their experiences in the product development cycle.
The SDG Financial Products Platform is the result of a collaboration between the Global Ethical Finance Initiative, or GEFI, and the United Nations Development Programme.
The platform is open to applicants that can demonstrate an alignment with the SDGs. GEFI undertakes detailed, extensive sustainability-focused due diligence and only selects partners that demonstrate a genuine authenticity and dedication to the 2030 SDG agenda.
We work in collaboration with partners through the product lifecycle to share learnings and highlight leading market practice. This is done in 3 ways.
Showcasing. Partners have the opportunity to share insights on their products at our global flagship events and co-develop thought leadership shared across our international network of over 15,000 global financial professionals.
Enhanced authenticity. Partners benefit from additional product endorsement through the unique collaboration with an established NGO.
Technical expertise and knowledge. We meet quarterly with the partners to share insights on market developments that help refine the product strategy, and we use GEFI's proprietary SDG framework methodology that utilizes the 160 plus targets and 300 plus indicators to intertwine them within the investment thesis.
GEFI and the UNDP launched the platform at COP26 with the platform's first core partner, Aegon, and its Global Sustainable Sovereign Bond Fund.
So I'm delighted that Aegon UK and Aegon Asset Management have partnered with GEFI in the launch of the new Aegon Global Sustainable Sovereign Bond Fund. And I'm proud that we've invested £100 million of one of our key default funds, the Universal Balance Collection, into this fund.
We try to invest in those countries that do show right now best practices in terms of sustainability when it comes to regulation, but also we try to identify those that are doing the best to improve in the future. So not only current leaders, but also future leaders. Well, the main attraction to invest in sustainable sovereign bonds is that you achieve long-term resilience. So you're able to protect capital, but as well find sources of yield and performance for the future. And also you will construct a portfolio that will be resilient under different scenarios, including extreme climate scenarios. We expect those countries to perform better just because they are today investing in solving these issues for the future.
If you are committed to achieving the SDGs and are interested in having your product promoted on the SDG platform, please get in touch with GEFI.
As Adam Smith said in his theory of moral sentiments, markets need to be underpinned by morals.
Let's ask the question, the person I disagree with, what is he right about? Not what is he wrong about, we can write volumes about that. What is he right about so that we enter a conversation where we can move forward?
If we can come up with something, land it at the country level, be intentionally inclusive, we will actually raise these vast sums of money, because guess what? The money's there.
In most crises, is a dynamic phenomenon, and the key importance of this is to recognize where the crisis is going so that we can be anticipatory and have policies that deal with the next phase of the crisis.
At this global turning point, such efforts will help countries and communities to build forward better.
And the GEFI team are certainly to be credited for bringing us to this point. Their work has placed Scotland at the very heart of the revolution, of the green, sustainable and ethical finance revolution.
Welcome back, ladies and gentlemen. Kicking off our next session is Yuki Yasui, who, as mentioned, in her capacity as Regional Director of the Glasgow Financial Alliance for Net Zero APAC Network, will be sharing her insights on some of the core challenges around climate and climate finance in the ASEAN region. Yuki has been in the sustainable finance sphere for over 2 decades, and in her previous role at the UN Environment Program's Asia Pacific, she worked to expand the UNEP Finance Initiative activities in the region and accelerate the development of financial institutions that integrate sustainability as a value creation driver and which contribute to the UN Sustainable Development Goals. She is a qualified UK Chartered Accountant and has a degree in economics from the London School of Economics and a master's in environmental change and management from the University of Oxford. Welcome, Yuki. Over to you.
The kind introduction, Shireen. I'm going to be talking about the Glasgow Financial Alliance for Net Zero and the climate target setting for financial institutions. Although the Paris Agreement agreed on 2 degrees or well below 2 degrees, actually the scientists are saying that we really have to limit our temperature increase to 1.5 degrees. And for that, it requires a 50% decarbonization of our economy by 2030. Otherwise, there will be irreversible damage to our planet, meaning that as human beings, we are quite fragile, and it will be very hard for us to keep on living the way we are living. So although all of that sounds really bad news, it is also a great opportunity for us to readjust our economy. Like we moved on to the big industrial revolution, this is our revolution of our economy for our generation. So specifically, the GFANZ is about the mobilization of financial commitment to net zero. So you can see here that there are political commitments by countries and by different companies, and the last one is the financial commitment that you are seeing. And you can see that there is a 26 times interest or commitment by financial institutions around the world to say that they understand that in order for their survival, the financial industry's survival, they need the economy to survive and the planet to survive as well. So GFANZ has been the umbrella institution that pulls together this commitment from around the world in the finance industry. So this is the net zero alliances that the GFANZ coordinates. So you can see that there is a net zero asset owner alliance, the net zero asset managers alliance, the banking alliance, the insurance alliance, and other alliances that fall under the GFANZ, the Glasgow Financial Alliance for Net Zero. And all of them are under the UNFCCC's Race to Zero initiative. And the GFANZ itself is the umbrella organization that unites the financial alliances. And what it aims to do is to change the international financial architecture to be aligned to the net zero agenda. They have to be part of the solution and to be actively engaging with their clients and financing them in their transition. And so what the GFANZ does is that it coordinates those commitments and actions across the financial sector and make sure that they really support the real economy, as it were, and that these commitments translate to real action and change on the ground. And GFANZ is committed to being the catalyst to ensure that we have deep transition already by 2030, so that we are well on the way to achieving net zero by 2050. So just to give you a little bit more insight into the actual products that GFANZ has been releasing this month in June. So this is the overall work plan of GFANZ for this year. The main core element is about the financial institutions' net zero transition plan. So not just about phase out of assets, but also about supporting the real economy transition plans and the sectoral pathways, and making sure that at the end of the day, there is portfolio alignment to net zero. The other big pillar of our work plan is around the mobilization of capital. So here, since GFANZ is a pan-sectorial alliance of the financial sector, we have investors, banks, insurance providers, and financial service providers all in one alliance, meaning that we have a very good platform for different actors within the financial space to collaborate in mobilizing finance towards net zero, including a lot of blended financing opportunities with public finance like MDBs, the multilateral development banks as well. And also the other important element is the enabling environment, meaning that GFANZ, although it is predominantly a private sector finance initiative, needs to engage actively with public policy to ensure that the voices of the private finance sector is heard, and that we form a constructive dialogue with public policy makers and regulators around creating an enabling environment to make sure that finance flows from out of the brown economy into the green economy. And then I won't go into details, but there are a lot of other building blocks that is required for the net zero financial system that GFANZ is also looking at as well. So in June, mid-June, the GFANZ has set out 3 key guidance on this work that was just shown. And in particular, I want to give a quick introduction about the FI Net Zero Transition Plan guidance. Now, this is just out for draft for consultation, and the consultation will go on throughout the end of July. So I will invite you to take a look at the guide, the draft for consultation, and to respond to it so that your voice and your expertise, your insight is also integrated into the final document. So the Net Zero Transition Plan has 10 components. First, around the foundations of the objectives and priorities, and secondly, about the implementation strategy, which are about your products and services, activities, policies, and then engagement strategy, which is how do you talk with your clients, the industry, your governments, to ensure that you can play, the financial sector can play an effective role in the net zero transition. And then metrics and targets. This is really important, both from managing your commitments to the net zero transition, but also in ensuring transparency and credibility of what you are committed to. And then lastly, the governance, which is around roles, responsibility, remuneration, and skills and culture. Just quickly run you through the GFANZ APEC network and just introduce what it is supposed to be doing, what its success looks like, and what are the blueprints of the work plan. So the purpose of the Asia Pacific network, which is actually going to be the first of other networks, other regional networks that GFANZ is preparing to set up, is to strengthen GFANZ's purpose to be a global organization that brings together the financial sector to accelerate the transition to a net zero economy by 2050. So Asia is the first, but there's already the Africa network, and then later on the Latin American network that will follow the launch as well. And the purpose of these regional networks is to bring your expertise and perspectives from the region and embedded it into the global sustainable finance community. So for Asia Pacific, what success looks like in my region is that we want to ultimately see all financial institutions setting climate targets and developing and implementing its net zero transition plans. So what that really means, though, is that we want to enhance and accelerate the financing of the net zero transition in the Asia Pacific. And in terms of our work plan, there are 4 pillars. The first one is outreach to those who have yet to set climate targets. And in parallel to that, the capacity building and peer-to-peer exchange. So we will actually be doing the capacity building as we do the outreach so that potential institutions understand what it means to make climate target commitments and how to implement them before they sign up. And we will continue the capacity building once they are on board as well. So it is post signing up and a pre and post activities around capacity building. And then the third one is around looking at whether any regional considerations, contextualizations are required in any of the GFANZ outputs. As mentioned, there is the transition plan for financial institutions guide that is set out at the global level. And then there are sectoral pathway guides as well, whether and how regional variations can be considered on top of those is another area of work for us. And then lastly, at the global level, GFANZ is organizing discussions around mobilization of finance, especially around blended financing. So this is something that we are thinking of doing at the Asia Pacific level as well. And then this is my last slide. We are looking, during the launch event in early June, we had a lot of discussions with various leaders in the region around the net zero transition. And we collected some of the voices and some of the opinions that we heard and want to share this with you here. So the challenges faced in the APEC region on net zero for financial institutions that we have heard is, for example, the need for enabling policy and regulatory environments, need for more GFANZ presence in this region, especially in emerging markets, the need for FI transition plans and sectoral pathways that are adjusted to the regional and country context, and more credible guidance and standards on transition financing, more blended financing, and carbon credits addressing avoided emissions, especially such as early retirement of carbon-intensive technologies, as well as avoided deforestation. And then lastly, data, and more data. So that has always been a popular issue as well. So with that, I would like to wrap this presentation by saying that if you are in Asia and you are part of the finance industry, the GFANZ Asia Pacific Network would love to engage with you to think about climate target setting and to support you in that journey of financing for the net zero economy. So thank you very much, and I hand it back over to Shireen.
Thank you very much, Yuki. The Glasgow Financial Alliance for Net Zero is going to be a crucial part of how the finance sector responds to the climate challenge. But as Yuki has highlighted, more global perspectives must be brought in, especially from Asia, to ensure that there is a cohesive strategy that works for everyone. So in the next session, we have an interesting panel featuring speakers from the Central Bank of Malaysia, the financial institutions from around ASEAN, who will be discussing the transformation journey to net zero from the perspective of their respective roles in the financial sector and how they complement each other. And who better to moderate this session other than Keith Lee of CICERO, Shades of Green, Norway. As the Senior Analyst for Sustainable Finance and ESG, Keith works on second-party opinions for green and sustainability-linked bond issuance, as well as other sustainability assessments, research, and methodology development. He has over 10 years of experience in sustainability and finance across academia, NGO, and private sector settings. Before joining CICERO Shades of Green, Keith co-led the Asia Sustainable Finance team at the Worldwide Fund for Nature, WWF, where he conducted research and engaged with financial institutions and regulators in ASEAN markets, including Singapore, Malaysia, Japan, and South Korea, to accelerate the uptake of sustainable finance best practice. He started his career in investment banking and holds a PhD in city and regional planning from the University of California, Berkeley. He also has a Master's of Environmental Management from Yale University and a Bachelor of Economics from the University of Chicago. So without further ado, please join me in welcoming Keith. Over to you, Keith.
Thank you very much, Shireen, for the kind introduction. And it's a pleasure to be with everyone here today. Thank you so much for taking time out of your busy schedules to join us on this, what I'm sure will be a very fascinating panel discussion. I'm pleased to introduce our panelists. Today we have Suraya Sani, who is Senior Supervisor at Bank Negara Malaysia. She has more than 12 years of experience in financial sector supervision with the bank and is currently responsible for the supervision of financial conglomerates in Malaysia. We also have with us Ms. Lee Jim Leng. She has been the Group Managing Director and CEO of Hong Leong Investment Bank since 2009 and has over 30 years of experience in the financial sector, specializing mainly in investment banking. And last but not least, we have Mr. Eric Lim. He's the Chief Sustainability Officer at UOB, and he leads a dedicated corporate sustainability office that is focused on achieving the bank's sustainability objectives of helping businesses to advance responsibly. So to kick things off, we'll just come straight into the discussion. We have some opening questions for each of the panelists. So if we can invite Suraya to kind of answer this opening question first with some opening remarks. Specifically, what role do regulators play in promoting green finance? Suraya, please.
Thank you, Keith. Thank you so much for the introduction. Good day and good afternoon to all. It's really my pleasure to join the panel discussion today to discuss a topic that has gained significant momentum over the recent years. As a regulator, Bank Negara Malaysia is making efforts to manage climate risk, as it will have significant impact to the life and livelihoods, as well as the impact to the financial sector, financial and monetary stability. So our strategies aim to maximize transition benefits and minimize downside risk. Inclusive strategy is key for Malaysia as a developing country and economy to avoid macroeconomic and social dislocations as we transition to a low carbon economy. So it's very important for us to adopt an inclusive strategy. Unlike the advanced economies, transitioning to a sustainable economy for Malaysia and other developing ASEAN countries actually involves a delicate balancing act and presents a complex set of governance as well as practical challenges for policymakers like Bank Negara Malaysia. There is a need for us to balance economic development and social implications against sustainability priorities to prevent premature exclusion or sunsetting of specific economic segments or industry and displacement of society, especially those in the vulnerable segments. So adopting advanced economic approaches and frameworks on developing countries will result in destabilizing consequences with damaging effects. In Malaysia, what we observe is that there's varying degrees of maturity and understanding among financial institutions. Practices in the financial institutions are still evolving. In view of this, we have not issued specific regulatory requirements or standards. This is mainly to give room for financial institutions to progressively develop. Nevertheless, to ensure financial institutions take concrete actions and support the transition, as well as take concrete actions in managing climate-related risks, despite no specific regulatory requirements set by the Bank Negara Malaysia, we actually leverage on our supervisory processes. Specifically our annual supervisory review process, in which we issue supervisory letters to financial institutions on the outcomes of our supervisory review. And in communicating our expectations on climate risk management, particularly our expectation on board and senior management, we also encourage the financial institutions to support their clients' customers' transition. This built a strong momentum within the financial institutions and gave us a better understanding. Through our engagements and conversations with the financial institutions, we can reflect then our expectations. We were also able to build a level of convergence around what sound practices would look like. As the bank developed greater understanding on the climate risk management, we start to develop the policy. So last year, we actually issued the climate risk management and scenario analysis exposure draft. We also issued the climate change and principle-based taxonomy. To support effective implementation of policy actions, Bank Negara Malaysia continue to collaborate with Securities Commission Malaysia and the financial industry through the JC3 to ensure a cohesive response in managing climate-related risk in the financial sector. 3 priority areas in 2022 and 2023 include ensuring effective implementation of the climate change and principle-based taxonomy, the paper that we issued last year, an industry-wide climate change stress test by 2024, as well as preparation for TCF, the adoption of the TCFD recommendations. So we are working very closely with the JC3 on all these areas. At the regional level, ASEAN regulators have also responded with measures that signify the financial sector's catalytic role in supporting the transition to a low carbon and socially resilient economy. The ASEAN Green, Social and Sustainability Bond Standards have been around since 2017 to facilitate sustainability-linked bond issuances and support development of the sustainable asset classes in line with the growing importance of sustainable finance. ASEAN has also developed the ASEAN Sustainable Banking Principles that guide the development of sustainable banking guidelines and tools at national levels. The most recent development is the release of the ASEAN Taxonomy on Sustainable Finance version 1 in November last year by the ASEAN Taxonomy Board. This actually marks a major milestone in promoting harmonious standards for classifying sustainable economic activities within the region. The ASEAN taxonomy was developed based on the ASEAN narrative, taking into consideration the diversity in the level of development and economic structure among the ASEAN member states, as well as differences in transition paths. So when we develop that taxonomy, we do take all this into considerations. So the ASEAN taxonomy is unique in the sense that it consists of a multi-tiered framework comprising foundation framework that serves to meet all ASEAN member states. All economies can adopt the foundation framework, and the second level is called the plus standards, which is an advanced framework that is based on specific criteria and science-based thresholds. So the tiered approach is really intended to cater to the uniqueness of each ASEAN member state's financial system and transition path. While ASEAN's approach is unique, the ASEAN taxonomy is designed to be interoperable with other international taxonomies. This is expected to minimize the regulatory costs for businesses with multiple footprints regionally and globally. For example, in Malaysia, we have the climate change and principle-based taxonomy, which is aligned with the ASEAN Taxonomy Foundation framework. This is really to minimize regulatory burden to our financial institutions with regional presence. On top of that, Bank Negara Malaysia, together with CSAN, is also working very closely in developing training programs for the ASEAN regulators. In addition, ASEAN central banks and supervisors are also working very closely with their respective governments to develop a nationally coherent policies and strategies. I shall pause here and pass back to Keith. Thank you.
Thank you very much, Soraya, for that wonderful overview of what Bank Negara Malaysia has been doing in terms of climate risk management and green finance. I'm sure we'll return to you and to come back to some of the themes you mentioned. But for now, let's move on to Jim Ling. And for you, can you please tell us a bit about the role that investment banking can play in assisting corporations to embed sustainability into their strategies and businesses?
Good morning, ladies and gentlemen, and good morning, Keith. Thank you for giving me the opportunity to speak here and share a little bit about the role investment banking can play indeed in the sustainability financing side. Now, just to give a little bit of perspective, I think sustainable financing in the ASEAN markets have actually certainly grown by leaps and bounds. Right, and just to give some numbers in perspective, I think the total issuance in terms of the sustainable bonds as of November 2021 actually touches 29.8 billion, And on that front, another $7 billion was actually specifically linked to the Sharia-based sustainability team Sukuk issuances. And where does the role of investment bank play? I think if we look at the ACMF framework, which is the Asian Capital Markets framework, I think for sustainability, there were 4 priority areas that were being emphasized. And of course, one of it is really consistency of reporting and disclosures, which is what really that drives, because in investment banking part, right, investment banks are mainly facilitators for debt issuances and for Sukuk issuances. So the key then is that how do we actually create an ecosystem that would be good enough for the investors and all the stakeholders bring about into the same place, right, to actually grow this part of the finance. Therefore, in one of the priority areas, there is actually the emphasis on developing the sustainable finance ecosystem, right, bringing through all the stakeholders, and investment banks, I believe, can play a big role in building that ecosystem and bringing together the right kind of issuances to the investors itself. Now, of course, on the other side of the coin, where the investors are looking at is really some of the key areas are really looking at disclosures, because unless disclosures are harmonized, consistent in approach, it's very difficult for investors to really extract the kind of data they want to make informed decisions, to make the right kind of sustainability investments. So that's one of the areas that I think we should work towards in terms of the roles that investment banks can play in terms of developing that. And then, of course, we talk about raising awareness in some kind of new products that the investment banks can play, working alongside to look at building new product initiatives to look at financial inclusion. And I think that's also one of the initiatives that Ben Angara has actually stated in our financial blueprint, to look at really improving inclusion in our financial system. And of course, the other parts is really building capacity. I think that's also one of the most important area in the earlier sessions that Dr. Yvonne Chia has also mentioned, that there is this pressing need to actually build talent and capacity in this industry, because as everyone is moving towards that agenda, I think there's definitely a need for capacity building and talent in this industry as well. So these are some of the key priority areas. And of course, I think what is important is that investors, of course, towards the growth and sustainability of this market in terms of green financing, it's important for investors, like we earlier mentioned, to be able to actually measure the degree of impact objectives, right? So Hong Leong, as an example, Hong Leong Bank, we recently issued 900 million AT1 green bonds. And just to give some color to that, how we actually run this bond transaction, we actually have a bond that actually caters to the ACMF standards together with the ICMA standards. So that again is also pre-reviewed by our rating agencies to ensure that our framework complies with it, and that sort of gives the initial confidence to the investors that this bond actually fits within the ACMF framework as well as the ICMA framework. And then in terms of the actual utilization of proceeds itself, there is a direct percentages applied to some of the sectors of the sustainability sectors that we want to develop. So it meets really the green bond standards that has been developed for ASEAN. Right. So definitely there will be percentages allocated to green financing, green building financing, renewable energy financing. And so these are the kind of impact measurements that we put into the financing. Of course, in Malaysia, we have not gone to that stage yet. I mean, ideally, that the continuing monitoring. I mean, these are all done at the prelim stage, before issuance. So the question then is that, do we then have a continuous monitoring for investors' confidence in the fact that the subsequent utilization? But then, of course, for Hong Leong, we've actually engaged a third party to actually review that as well. So in a way, it gives investors the confidence that really what we set out to do in sustainability in terms of the financing actually complies with the framework itself in the ACMF and ICMA frameworks. So these are some of the key parts. And I think in terms of the drive, I think increasingly you can see a lot more, like CIMB also recently issued about 201 million US green bonds that's aimed towards the UN SDG goals, right? So all these are part and parcel of where the market is going. And I think what is important is that the ecosystem needs to be started. And from our investment bank perspective, it's just like how we started the Sharia markets many years ago. It has to start, we believe, from all parts, right? The regulators to create a common system for everyone to look at in terms of Bank Negara, as mentioned earlier, the CCPTs, and also from the investor standpoint that they need to also embrace sustainability into their investment concept. I think we believe that the products will come to the market, but currently we are not seeing price discovery as of now. But we are actually moving towards that. Demand-wise, we are seeing a lot of demand and interest in green bonds. Yeah. So from that perspective, we believe really that investment bank can really shape the growth of this industry, just like how investment banking has actually grown the sukuk markets globally. And that is something that definitely, you know, as far as the ASEAN region is concerned, we will commit to grow that together with the international finance community. With that, I'll pass over the mic back to Keith.
Thank you very much, Jim Ling. And absolutely, investment banks have this critical role to play, sitting in between issuers and investors, and helping issuers really understand investor expectations, in particular when it comes to green, social, and sustainability debt. But for now, let's turn to Eric. Jim Ling talked about some of this, the importance of green financing and products. So in your experience, has green finance been driven more by the institutions or by the customers?
Thanks, Keith, and thanks for having me here. Hi, everyone. I think both Soraya as well as Jim Ling have touched on very good areas. So let me kind of share the perspective from that of a commercial bank financing the main economy, right? And one of the big things that we need to first and foremost realize is we have a modern economy that has been perfected over the last 100 years using fossil fuels, right? And therefore, when we talk about getting to decarbonization or net zero by 2050, with some of the estimates on needing to reduce carbon emissions by nearly 50% in the next 8 years, what we're essentially talking about is retransforming all the technologies, business models, infrastructure that we've taken 100 years to build and perfect over the next 20, 30 years. So it's a big piece of work at hand. And so when we talk about who's driving this, we're really seeing stakeholders from all around. I think national governments, obviously through the Paris Accord, have come together to try to bring a level of global and regional ambition on how to do this. And one of the things that I think Soraya mentioned that's so important as we move on this pathway is this concept of not just having global pathways, but having regional sectoral pathways that support developing markets in delivering to our sustainability commitments and transformation while being able to deliver to a just transition, creating employment and delivering on economic growth, right? So I think that was a very important concept that Soraya talked about that we can explore again a little bit more later. Now, in terms of green financing and sustainable financing, a bank like UOB were in a very privileged position because the financing we offer to our clients directly go into working capital, project finance, trade finance, whatever it may be, in supporting the direct business models or infrastructure build that our clients are executing too, right? And the way we go about this is obviously through sustainable finance frameworks, where we've got 6 of them now supporting green real estate, renewable energy capacity, water waste management, circular economy, green trade finance, right? And this is the way in which we execute to some of the client demand as they themselves come under some level of pressure, both from
we seem to have lost Eric. Is it just me or okay? Great. So I think maybe we will have to return to Eric once he is able to.
I think I lost him too.
Okay, great. Thanks for confirming. That's not just me. Let's return to Eric when he is able to come back. But in the meantime, maybe we can progress with the discussion a little bit by coming back to Jim Leng. Jim Leng, you were telling us a little bit about the kind of investor interest in green, sustainable, and social debt issuance, and also increasing sustainability-linked bonds. Can you tell us a little bit about what you're hearing from Asian investors and what you're seeing in the capital markets? You said there's a lot of demand, but are Asian investors becoming more discerning when it comes to investing in green bonds, or is it still the case that maybe they're just going for anything with label, and going for anything that complies with the ASEAN Green Bond Principles? I think you are muted there, Jim Leng. Oh dear, don't tell me we've lost Jim Leng as well. Okay, it looks like that might be the case. Let's see. Okay. Okay, in which case let's then go to Soraya and hope that Jim Leng and Eric respond, come back to us pretty quickly. Sure. Soraya, you talked about the climate change and principles-based taxonomy, or CCPT. Can you tell us a little bit about, we're about 1 year and 1.25 years on from the publication of that paper. Can you tell us a little bit about how FIs, financial institutions in Malaysia, have responded? How are they preparing to report?
Sure. Okay. Thank you so much for the question, Keith. Let me start by saying that we've seen great progress. For your information, in November last year, to ensure effective implementation of the CCPT, we've actually under the Joint Committee Climate Change, Subcommittee 1, we have a subgroup called CCPTIG, which is Climate Change and Principle-Based Taxonomy Implementation Group. So this group consists of banks and insurance companies where they work together in making sure the implementation goes smoothly. So they share the challenges that they are facing and try their best to develop or come up with solutions to the challenges that they're facing. The reason why we have this CCPTIG is mainly because starting from July 2022, the financial institutions in Malaysia will need to report their exposure, their loan exposure, as well as investment exposure as per this CCPT classification. So to some extent, we've seen great development, we've seen great progress. In fact, they have actually developed a draft FAQ to assist the financial institutions in implementing the CCPT. I stop here and pass back to you, Keith.
Great, thank you very much. And obviously, it's obviously very interesting to hear you mention the need for interoperability, right, between the national taxonomies and the ASEAN taxonomies. When we talk about the ASEAN taxonomy, obviously also very interesting to see the two-tier approach with the plus standard being layered on top of the foundation standard. And you talked a little bit about the plus standard, that they're exploring developing specific technical criteria. Is that something that is also potentially relevant for Bank Negara and also SC to explore developing technical criteria at the national level for Malaysia? How will that interface with the development of technical criteria at the ASEAN level?
Okay, on that, as I mentioned earlier, it should be interoperable, and the thresholds, for example, that we plan to set at ASEAN level must be something acceptable at the country level as well. Maybe I can just briefly share with you on the overall framework of the ASEAN taxonomy, as well as how it's interoperability with other taxonomies in ASEAN. As you're aware, not just Malaysia, Indonesia, Singapore, and few other ASEAN countries have also developed their national level taxonomy. And during our discussion, we are quite clear in terms of the interoperability of the ASEAN taxonomy and how it's being applied together with the national level taxonomy. So like I mentioned earlier, when it comes to Malaysia taxonomy, the climate change and principle-based taxonomy, to some extent the SRI taxonomy developed by the Securities Commission that is aligned to the ASEAN Taxonomy Foundation Framework. For your information, under the ATB, there are 3 sub-working groups. Working group 1 looks at the foundation framework that work actually led by Negara Malaysia. Working group 2 is actually looks at the plus standard. That working group is currently led by Monetary Authority Singapore, and working group 3 is looking at customer facing, market facing. So that is currently led by Securities Commission Malaysia. So we work very closely with other ASEAN member states, and we want to develop the thresholds. We will make sure the thresholds are something that can be adopted by all ASEAN member states. Again, if the ASEAN member state is not ready to adopt the plus standard, they can use the foundation framework first while they are developing or enhancing the environment or ecosystem in their respective countries. I pause and pass back to you, Keith.
Great, thank you, Soraya. So everyone, I've just been informed by the organizers that we will be taking a quick break while we resolve some of these technical issues. So we will be right back. Yeah, hang tight, and hopefully we'll be back soon. Thank you. And we are back. Welcome back, everyone, and sorry for that interruption. I obviously, it's Murphy's Law. What can go wrong will go wrong, but we're back. That's what matters. So we were just hearing from Eric, and it would be great to perhaps let Eric finish discussing his views on what is driving green finance. So Eric, I'll hand back to you. That's okay. Thank you.
Keith, and very happy we're all back. Apologies for that little technical difficulty. So I think I was just starting to talk about, the sustainable finance capabilities that the bank we were building in order to be able to support our customers on their main economy journeys, right? And so we've built 6 sustainable finance frameworks focused around building capacity on renewable energy, green real estate, green trade finance, circular economy, etc. And we're really starting to see 2 different speeds of capabilities within the client base. For large customers who they themselves are coming under some level of expectations from their institutional investors and their regulators, they have the capacity as well as the motivation to build their own sustainability journeys and are much more proactive in terms of figuring out what capacity, what infrastructure they're trying to build. And working with them, we're seeing a lot of demand there. At the same time, because we also take care of the small and medium enterprise companies, we find that with the SMEs, it's very important to provide seamless solutions in order to help them partake in the sustainability journey. And so from that standpoint, one of the things we found works very well for our SME customers is building these ecosystem plays. So for example, we've got 3 of them. U Solar for solar energy, U Energy for energy efficiency, as well as U Dry for the electrification of the transportation grid. And what we try to do within these solutions is bring together the various companies that will provide these solutions, kind of package them with the financing that the bank can already provide, and then bring that to an end customer or company so that it makes it really easy for them to just adopt these solutions rather than have to run around and construct their own ecosystem as well, right? Now, one of the things Jim Ling mentioned was the increasing demand, and we definitely see that. Just for our own book, the green and sustainable finance portfolio has tripled in the last 2 years. And if you compare that to conventional loan book, the conventional loan book has grown, slightly under 10%. So you can really see that there's a lot of demand for this. One of the things I'll just quickly share before I hand it back over to you, Keith, is even on the investor side, in terms of sustainability theme investors, you can see a lot of demand there as well. At the beginning of last year, we issued our inaugural sustainability bond, and we tapped the European as well as American markets for $1.5 billion, right? And number one, it was oversubscribed, so there was a lot of demand. Number 2, we saw that 60% of the investors who finally got allocation were sustainability theme investors. And I think that's a very important trend for us to recognize, is that within the developed markets, there is a lot of capital and liquidity that is trying to find their way towards the right type of green assets, sustainable finance assets, and increasingly transition finance assets. So, as we progress on our work, either as regulators, as investment banks, or as commercial banks, one of the critical roles we play is how to connect East and West, or developed to developing markets, to be able to unlock a lot of that capital from where it exists to where it needs to go. And so, a lot of what Soraya as well as Jim Ling had mentioned resonate with me as well. Back to you, Keith.
Thank you so much, Eric, and great that you can pick back up so seamlessly from dropping off just now. Maybe just since you're talking about the investor demand, maybe let's just come back to Jim Ling. And Jim Ling, this was a question I wanted to pose to you earlier on. When we're seeing investors with interest in this sustainability labeled debt, are you seeing, is it a similar kind of view to what Eric expressed in terms of potentially a lot of that demand coming from sustainability-focused investors internationally? How much is coming from Asian investors? And are Asian investors also getting more sophisticated and discerning when it comes to investing in these type of instruments?
I think definitely the observation is, I think investors, I think whether it's Asian or globally, is working towards that. I think there has been whether it is global and ASEAN, I think the commitment to actually increase sustainability financing is there. And then definitely from the investor side, when we talk to investors, the first thing that come to hand is that they want to rebalance their portfolio. Like currently, you talk to most asset managers, their portfolio are all mainly driven towards non-sustainable investments, right? So everyone else then said that if you look at their own portfolio, what they would like to add is add sustainability and over time increase the percentage of their sustainability investments among their total portfolio. And with that, you can see that there will be a lot more capital increase in terms of investing into these green bonds, right? So that's why even in Malaysia, when we launch sustainability linked bonds, the demand is very strong, because most of the asset managers would actually want to add that to their portfolio so that they can over time decrease the non-sustainability compliance ones and increase that percentage. Of course, to completely eliminate that is impossible overnight, right? Because for example, we talk about even clean energy, we can't say completely switch out to clean, because currently Malaysia still need that transition. And so it has to be a goal to reduce it and increase the clean energy side rather than completely remove that. So but most investment banks are trying to achieve that balance as well. That means increasingly helping the fund managers move towards that direction to increase the sustainability percentage into their asset allocation. Yeah. Back to you, Keith.
Thank you, Jim Ling. So coming back to you, Eric, that the process of issuing a sustainability bond, on my end as a second party opinion provider, when we engage with issuers, it's almost like helping them to prepare them for a conversation with investors. And many issuers find that going through the SPO process is obviously part of the pre-issuance process, and a lot of preparation needs to be done in order to be able to issue that first sustainability or green bond. So perhaps, Eric, you could share from UOB's perspective, what were the kind of internal investments in resources that needed to be made? How were you preparing for instance, to report on impacts from the sustainability bond issuance? Do you have any lessons to share there?
Yeah, sure, Keith. So when we thought about setting up our sustainable bond framework, we wanted to be as aspirational and as authentic as possible to the impact we wanted to create. So I think you touched on the right word, impact, right? And it was really interesting that when we were debating this internally with our board as well as our management, one of the big things we said was, hey guys, let's not go and hunt the big sustainable finance numbers, because anyone can run out there and just generate big headline numbers for the sake of big headline numbers. But let's keep our sustainability program, financing program, authentic to the impact we wanted to create, right? And so from that perspective, when we stood up our sustainability bond framework, first and foremost, we had to have very strong sustainable finance frameworks already on the business side, that were very clear on the kind of new economy assets we were trying to build, what kind of impact we were trying to achieve among various asset classes or industries of power generation, circular economy, green real estate, smart cities, right? And I think that pre-work is very important as you prepare to go through the SPO process and prepare to put yourself in front of sustainability themed investors, because that's what they're going to be asking about, right? Is what kind of impact, if we were to invest in your green or sustainable bond, can we then say we are participating into, right? So that's one piece I think that's really important. It also then leads to a second conversation that Soraya mentioned a little bit, which is when we think of taxonomies that therefore guide the use of proceeds of these issuances, those taxonomies need to be able to withstand, number one, a high quality bar first, and second, need to increasingly gain global acceptance, right? And one of the difficult pieces of work that is important that we need to focus on over the next couple of years is how do we take something like the ASEAN taxonomy how do we take something like the regional pathways for ASEAN and make sure that the institutional investors in the developed markets are able to understand as well as invest into them as well. Because the predominant taxonomy that the world is working with right now, as well as where the developed world institutional investors are focused on right now, is the EU taxonomy, right? And if we're not able to bridge, the CCPT or the ASEAN taxonomy with the EU taxonomy and be able to come to this harmonized global recognition of the different speeds that are required, then one of the things we're going to end up with are taxonomies that move liquidity only within a region that recognizes its own taxonomies. And that will be subscale, right? And so I think that's an important lesson that as we went through the process, we realized our European and American investors, they have taxonomies they recognize, and we need to expand those taxonomies that they can recognize and use to invest. A second thing that we realize with our investors is green or climate is very well understood at this point in time. So anything that uses the language of scope 1, scope 2, scope 3, in line with the EU taxonomy that they're very familiar with, no problem, right? But because we wanted to make our sustainability bond broad-based in its impact, we also had social aspects in there. And one of the things as a lesson learned is with some of the social aspects, institutional investors may not be as confident or as skilled in a set of social metrics that they're comfortable putting their money against, right? And so there is work that needs to be done to continue to develop beyond climate metrics, social metrics, or nature-based type metrics. And that's where, work like the TNFD or, social loan frameworks become critically important. So these were a couple of the interesting lessons that we learned as part of our sustainable bond issuance that, we'll continue to bring with us that I'd love to share. Thanks, Keith.
Thanks, Eric, and very glad you touched upon social. I think it will be great to return to that theme at a later point in this conversation. But before we go there, coming back to you, Soraya, clearly, I think when you talked about what Bank Negara is doing, a lot of it is focused on climate risk management, and rightly so. Obviously, investors and financial institutions should be very much paying attention to climate risks. And we see the climate change and principles-based taxonomy being, because of the kind of the reporting focused requirement there, it seems to be positioned as a risk management instrument as well. But I'm curious, to what extent does Bank Negara also see the taxonomy as an instrument that can help to support additional green finance issuance? And, to what extent do you kind of see this as a tool to protect against greenwashing?
Okay, thanks, Keith. On that, why we start with climate change, because climate change is the critical issue that we need to address as soon as possible. But to some extent, if you go through our CCPT, under the do no significant harm, we do have a part where we say the activity must not cause significant harm to the broader environment. So to some extent, we do cover the broader environment as well, not just climate change, but reducing GHG emissions and increasing resilience adaptation is something that we feel is an area that we must focus on while we develop the other parts, which is the biodiversity, for example. So with regard to your question on greenwashing, so greenwashing is actually a big word for us. We do not want anyone to do greenwashing, hence the reason why we have the transitioning category. So to some extent, based on our observation, companies or FIs, they are not greenwashing, but they are amber washing or even brown washing, because majority of the economic activities are now classified under the transitioning and watch list. So what we really like about it is that when these activities are classified as transitioning, FIs are expected to assist their clients to transition to green. So that conversation will start, and we expect after a few years, it will transition not just from climate supporting or transitioning, from climate transitioning, but it must meet the climate supporting to some extent. So when the conversation start, when the validation start, I guess that's where we can reduce the greenwashing risk. I pause there and pass back to you, Keith.
Thank you, Soraya. So, the discussion around taxonomies is obviously very pertinent to use of proceeds instruments, right? In terms of helping develop this common language around what kind of use of proceeds are green or amber or in transitioning. Obviously, there's a lot of ways to kind of position use of proceeds and the kind of objectives that they're driving towards. But we're also seeing, in the last 2 or 3 years, massive exponential growth in sustainability-linked instruments. And obviously, sustainability-linked instruments are quite different in terms of not requiring that use of proceeds. And so, Jim Ling, I wanted to come to you and ask, your perspective on this new format. What do you see as the outlook for sustainability-linked debt? Do you think there's potential even for this to take over from use of proceeds in the future?
I think definitely there would be, but I think as a role that investment banks can play is really to guide our clients towards that. I think a lot of times, like even for Hong Leong, where we try to encourage our clients to issue sustainability-linked bonds, right? And when we tell them some of the preparation work that they need to do, the first thing they say, oh no, there's so much work. So a lot of them are shying away from doing that because obviously, just as when we started our Sharia-based financing, most of them ask what are the benefits, right? The key thing investors, the issuers always ask is, if we do sustainability, what are the benefits that's obvious to us? And of course, in the capital markets, it's all been driven by pricing, whether there is any pricing advantage for us to issue sustainability-linked bonds. But then again, this is something quite subjective at the moment because we have been advising our clients that, at the end of the day, when you look at the 3 Ps for sustainability, you are not really looking at just pricing alone. Your commitment to the planet, your commitment to the people. So I think it's an educational process, and I think more and more of our issuers are coming through with that efforts. Initially, we saw some a measure of trying not to avoid that statement because a lot of them said, we are not ready, our businesses are not even there yet, we don't know how to measure. So a lot of them actually felt that they are not ready. But I think increasingly, with the regulators' push and the fact that the investors are pushing very much for these things to happen, and I think there will be a growing portion of sustainability-linked bonds. Like now, in fact, we are doing one in the Malaysian market for the toll roads. Basically, we are actually pushing sustainability-linked factors into that, even though the utilization of proceeds is not to actually extend to the green sector. But yes, we are adding solar panels to the toll booths. So, these are some of the things that collectively the industry can go about to improve energy efficiency. Yeah. So I think definitely the path is there, and definitely with the help of investment banks in guiding customers and issuers towards that path, I think the growth in this particular sector will definitely be there. Yeah, does that answer your question?
Thank you, Jim Ling. Yeah. Yes, indeed, and great to hear that you have a potential sustainability-linked issuance in the pipeline. Yeah. So maybe just to kind of one last question on when we're thinking about green and sustainability financing before we turn to social. We see in the EU, in Europe, that there's a lot of regulatory drives and initiative around promotion of standardization and kind of efforts to address greenwashing. Certainly the EU taxonomy, but also the EU Green Bond Standard, which is being linked to the taxonomy. But then also now we also have some, the industry associations also trying to release additional guidance for green bond and sustainability-linked bond issuers with ICMA's new announcements and guidelines yesterday. So Eric, just briefly, what are your thoughts on the need for updated standards in ASEAN? Should the ASEAN Capital Markets Forum be looking at perhaps updating the green bond standard?
Yeah, so I think when we think about standards, there are 2 major things we're trying to address, right? So the first thing you want to do is set the minimum hygiene standards such that there's no risk of arbitrage, no risk of bad players, because that would obviously detract from the effort. So, one of the things that we were just talking about was the development and the the increase in demand of things like sustainability-linked bonds or sustainability-linked loans, right? And this is an innovation that I think is pretty good because it allows folks that are not pure green, right, to still participate in the sustainability journey. But at the same time, you can see that with SLLs or SLBs, you need to be able to set the right standards such that there's no abuse as well, right? If we take a reference from what's happened with the ESG AUM space or sustainable investing space, that was clearly an area that ran very far ahead in terms of sales, market development, distribution, and then got kind of pulled back when SFDR Article 8 and 9 came to market. And there was a lot of then concerns on mislabeling, on greenwashing and stuff like that. So I think as we think about benchmarks and guidelines and standards, it is important to be able to update them as the maturity of the markets, as the increased expectations of our investors continue to go up, right, to close out that arbitrage back bit. The second bit comes back to something we talked about before, which is greater interoperability and connectivity and acceptance of these standards by global players, right? And as different parts of the world continue to progress on the NDCs, net zero pathways, commitments, national development plans, right? As well as financial services capabilities, it is important that we keep updating these guidelines to be able to connect, like I said, capital market players from developed world into the developing world so that we can continue to unlock as seamlessly as possible massive amounts of capital and liquidity between the various markets that need it. Because if we don't, we end up with trapped pools of capital and liquidity just playing among those economies themselves. And we know the size of the challenge in front of us, where a lot of the money is and where a lot of the money is required are not necessarily sitting within the same national jurisdictions. Thanks, Keith.
Great. Thank you, Eric. So let's pivot, come to social. Obviously it will be great to spend more time on this. It is a key aspect of climate change. A lot of people don't realize that climate change has an inherent social justice component in terms of the most vulnerable populations also being those most exposed to climate risks. And then as we transition, as Soraya, Eric have already touched upon, there is a need to ensure that we're not leaving behind, a lot of the economy. So Soraya, what is the role of regulators in the just transition and promoting social objectives as well? Do we see a need for a social taxonomy? Is that on the cards?
Okay, thanks, Keith. For Bank Negara Malaysia, we have issued the value-based impact assessment framework. So to some extent, that already covers social part. So the CCPT can be a component or have to look together with the VBIAF framework. With regards to whether ASEAN taxonomy, for example, whether we cover social, this is something that we've been currently being discussed. We are exploring, as you rightly mentioned, social is a big thing. We do need to consider social as well. It's just that how do we want to bring in the social component into the taxonomy? But again, just to also mention here, social is not something new. It's been there. In Malaysia, we started way back in 2017, if I recall correctly. It's just that now enhancing it and making it, I would say, clearer. Yeah.
Thank you, Soraya. And Eric, what kind of innovations in financing do we need to be able to more effectively finance the just transition? And I have to ask you to kind of keep it brief because I also do want to ask Jim Ling about, where investors, what is investor appetite for these kind of investments?
Yeah, 2 words. For just transition, we need clear transition finance that's acceptable, right? And that's how we can take the existing economy assets, be able to figure out how to finance the decommissioning of them and finance the recommissioning of new world assets that are net zero. So I think when we think about just transition, that's one piece that's very important. When we talk about the social aspect of just transition, we have to focus very heavily on employment because we know, right, at an economic level, if you can generate employment, then a lot of social issues begin to address themselves. And then the last bit is just similar to what Soraya mentioned just now. As we work on various pieces of financing, whether it's green, sustainable, or conventional, this whole concept of do no harm, right? We've got to build it into our framework so that we don't inadvertently cause harm, even as we try to do good.
Great, thank you, Eric. And Jim Ling, last word. What are we hearing from investors currently? What do we need to get more investor appetite in terms of financing just transition and social objectives?
I think social impact bonds, in fact, Malaysia actually was one of the key pioneers as well. I remember Kasana did one as well. I think the key to social impact is that the measurement standards, right? I think a lot of people ask, if I invest in the social impact bond, how do I see the KPIs? What KPIs do you set? I mean, a lot of people think of social impact as just charities. I mean, the key was that, because a lot of times when it channels down there, the question is really the measurability of the impact, right? So currently, I think what we really need to do is really from the investor's perspective, how measurable are these standards? And when they invest, like some of the things that Eric had asked, also answered during his session, is that investors really just need to know really that did that have an impact, right? Because again, social impact is even different from the green, because in a way, easier to say when you have a green building, you know exactly what you're targeting. You finance a green car, it's easier to see than a social impact, for example. So in that sense, that performance benchmark needs to be set so that investors can clearly see what benefits has been ascribed by investing in that bond itself. Yeah, but currently, a lot of them had this feel that they may not be able to visualize that performance measurement as clear as those in the sustainability ones. Yeah.
Great, thank you. And with that, we'll have to close the panel. It's amazing how fast time flies by, even with the technical interruption in between, and definitely a lot of themes that we've kind of left on the table and haven't been able to explore further. But I would like to thank Soraya, Eric, Jim Ling for joining us, and thank you very much to the audience for tuning in and for sticking with us during our technical interruption. But thank you very much, and back to you, Shireen.
Thank you, Keith. Well, despite the slight technical difficulties, you and the speakers managed a great discussion there on the growing role of green finance and how a concerted effort by all parties, regulators and financial institutions collectively is needed to set us firmly on the path towards net zero and a just transition. Once again, we do apologize for the slight technical disruption, and we thank you for your kind understanding. Moving on, we have Romy Gojek, Project and Technical Manager in Nature at UNEP-FI. She is an experienced Senior Program Manager with a demonstrated history in sustainable finance. Romy is the founder of The Hive, which catalyzes changing the nature of finance. Assignments include ABN AMRO, WWFNL, IUCNNL, and World Animal Protection. Ladies and gentlemen, please welcome Romy.
Thank you, Shireen, and welcome to this fireside discussion on financing nature and biodiversity. A fireside chat refers to a series of evening addresses by the former US President Roosevelt in the wake of the Great Depression in the US in the 1930s. Today, nature is in depression. Since 1970, which is a lifetime for many of us, our population has doubled. Our economies have quadrupled, but nature has bared the brunt. According to WWF's Living Planet report, the population of vertebrates has dropped by nearly 70% since the 1970s. According to research by the World Economic Forum, over half of the world's GDP depends on nature and the services it provides. And in such a way, as a result, it's exposed to the risk from nature loss. But it's no longer only conservation organizations that are speaking about protection of nature. The Network for Greening the Financial System, which is a group of central banks and supervisors, earlier this year put out a statement acknowledging that nature-related risk could have significant macroeconomic and financial implications. Before I walk you through the program, I briefly want to introduce you to UNEP-FI's work in the nature space. So UNEP-FI, and you've guessed this, is a partnership between the UN Environmental Programme and the global financial sector, with the objective to mobilize private finance for sustainable development goals. UNEP-FI's growing nature team works to embed nature in mainstream finance to support a shift from nature negative towards nature positive. We do this via research and guidance, capacity building and innovation, by building industry-wide tools that bring nature into the heart of financial decisions. Today, we work on 4 topics: alignment of financial flows, risk and disclosure, which is linked to the Task Force on Nature-related Financial Disclosures, policy environment, including tool development, such as the Encore tool, and we work on thematic topics, such as foods and oceans. Today, we will kick off our session with an opening address by Dr. Teresa Mundita Lim on the overall challenge of financing nature and biodiversity in the Asian region. And then we will continue with a panel of excellent speakers who I will introduce later on the call. So thank you, Teresa, for joining us. Dr. Teresa Mundita Lim, you are the Executive Director of the Asian Center for Biodiversity, and you lead the center in facilitating regional cooperation and coordination on biodiversity conservation, with the purpose of it to be sustainably managed and used and equitably shared for the well-being of all people. We're looking forward to your opening address, Teresa.
Thank you very much, Romy. And good day, everyone. Thank you for having me today in this fireside chat on nature financing. I'm pleased to share with you all today about ASEAN biodiversity and how vital it is for the region's economic and socio-cultural development. The ASEAN region is home to around 18% of the world's known biodiversity, despite only possessing 3% of the land area. 3 of the world's 17 mega-diverse countries and 5 countries are in the Indo-Burma region. All are considered among the most biologically important regions on the planet. The region has a high number of endemic species of both flora and fauna, and more are waiting to be discovered. This rich natural heritage provides valuable ecosystem services to more than 650 million people and serves as a vital resource base for the region's economy. The total economic value of ecosystem services is estimated at tens of trillions of dollars every year, far larger than the global gross domestic product. This is in accordance with the ASEAN Biodiversity Outlook too. The World Economic Forum in 2021 estimates that $44 trillion of value generation comes from natural assets, accounting for more than half the world's GDP. Closer to home, a recent paper by the Academy of Sciences Malaysia states that 30% of Asia's GDP is generated from natural capital alone. The Asian Development Bank, for instance, estimates about 23,000 to $270,000 are earned per square kilometers of healthy coral reefs. Nature or ecotourism is another area where the nexus between healthy and thriving environment and the economic development of a community is apparent. According to the UN World Tourism Organization, international inbound visitors to the Asia-Pacific region spent as much as $443 billion in 2019, trickling down to the various tourism-related activities such as transportation, hotels, and other services. More than its valuable contribution to a community or the country's economy, the region's biodiversity also makes up an important part of the ASEAN people's culture and identity. Conserving and sustainably using these natural resources are therefore paramount if we are to preserve the rich cultural heritage of the region. However, the rate of biodiversity loss in the region and in the rest of the world has become so alarming that the 2020 World Economic Forum ranked it as one of the top 5 predicted risks to the global economy over the coming decade, even ahead of risks such as geophysical disasters and terrorist attacks. More than $2 trillion per year of food provision services will be lost with the business as usual approach, according to the World Bank. Such impact on food security and other ecosystem services will be felt the hardest by low and lower middle income countries, most of which are dependent on biodiversity as natural assets. Reversing biodiversity loss entails a whole of society approach that mobilizes support from various stakeholders and sectors within and even outside of our region in the ASEAN. The ASEAN Center for Biodiversity believes that biodiversity is everyone's business. Thus, we endeavor to forge partnerships and cooperation to scale up mainstreaming biodiversity, particularly in the business and finance sector. Nature loss and biodiversity risks represent a financial risk because everything is largely linked with nature, from harvesting or extraction to processing to the end of the supply chain. Recognizing this dependency, it is high time to put nature and biodiversity at the core of our sectoral development and business planning. This would mean considering nature as an integral part of managing business risks and strengthening accountabilities. Businesses need healthy biodiversity for their long-term sustainability. This is something that industries in the ASEAN is beginning to understand. For instance, the sustainable means of producing oil palm is already being sought, particularly through certification, complemented by good agricultural practice and strong governance. The pandemic has also catalyzed greater awareness in the ASEAN on the implications of biodiversity loss. The ASEAN Comprehensive Recovery Framework, or the ACRF, was adopted by the leaders in 2020, and it guides the region to accelerate actions to mainstream biodiversity considerations into relevant national plans and into sectors such as agriculture and fisheries, tourism and health, mining, energy, infrastructure, manufacturing and processing, and even education, and in cross-sectoral issues such as climate change. Under broad strategy 5, nature-based solutions are highlighted to increase the region's resilience against future pandemics and support long-term economic recovery. It calls for thinking of supply and value chains and making sure there is a balance between resilience, sustainability, and efficiency in production. The challenge, of course, is still in the implementation of the ASEAN Comprehensive Recovery Framework. And this is where the ASEAN Center for Biodiversity calls for more partnerships with governments and non-government organizations, as well as the private sector, to be able to implement the ACRF more effectively. Understanding and appreciating the true value of nature services in our economic activities is a necessary step to effectively manage the wealth and resources essential to the economy's sustainable growth. Given that nature underpins economic and business activities, the creation of a nature-positive economic sector that values the interlinkages of nature and ecosystem services are of utmost importance. Thank you very much, and I wish you all a successful fireside chat. My colleague, Mr. Amiel Sarne, will be joining all of you in the panel. Thank you very much. Thank you, Romy.
Great. Thank you so much for your opening address, Teresa. This was very insightful, and I think it's very important that you underline that, everything is connected and we all depend on the services that nature provides us with. So we'll move to our panelist of 3 guests who I'll introduce first, and then I'll ask them a opening question. So I'm going to start with Ian Henderson. You are a former UN colleague and the current managing director of ADM Capital, based out of Singapore, and you have over 20 years experience in the finance sector. Past experiences include WWF, the UN, and now ADM Capital. Then I'll move to Jean-Marc Champagne. You are the head of Bankable Nature Solutions for Asia Pacific at WWF, working to build scalable bankable projects, as the title implies. As part of your role, you have, among others, co-established the Climate Impact Asia Fund. And before working at WWF, and I think that's something you share with Ian, you have worked for a number of years in the financial sector. And then our third speaker is Nathan Amiel D. Sarn, and he joined the Asian Center for Biodiversity in 2007 as a program specialist, as the program and project coordinator, and he's responsible for the overall coordination of the Asian Heritage Park programs and the implementation of the B-Camp project. Well, Nathan, I think you have to explain to me what the B-Camp project is, but let's start off with a first question for Ian. So Ian, can you give a picture in the particular role of private versus public finance, and you also have a new fund that you're launching. So we're very excited to hear about that. So over to Ian.
Thanks, Romy, and hi, everyone. I think the first thing I should do is probably apologize for my backdrop. I definitely win the most boring backdrop award, so I'll try and improve that next time I'm on one of these panels. So maybe I'll try and open up with a few sort of high-level comments and touch on this public versus private question. So I think the first observation I'd make about public finance is often when we say we're talking about environmental finance or environmental risk for that matter, I think it's fair to say that we're not really often talking about the environment. We're generally not actually even talking about climate. We're often talking about carbon or greenhouse gases. We're talking about a subset of a subset. And I think that's very important, when it comes on to sort of public finance flows, just to reframe what we're really talking about, because I think too often we go down a bit of a rabbit warren. I also think that even though it feels like we're at a place with biodiversity that we were with climate change 2 or 3 years ago, I think people are starting to acknowledge that this is an issue and it needs to be broadened. I think it's completely artificial to think we can solve climate change without biodiversity, and also to reverse biodiversity loss if greenhouse gas emissions continue to rise. So I put my money on the fact that the high level or sort of meta narrative will change from net zero to one of net zero nature positive this decade. And I think there's such an increasing and rapidly improving realization that nature is such a significant driver of climate change and such a sort of critical and cost-effective part of the solution space that it can't be sidelined. And I think that really needs to make its way into the sort of the public finance debate. In terms of public finance, I think we're also making great strides on environmental disclosure, and there's a whole bunch of initiatives, and the TNFD, to get the first acronym out of the way, is one of the really encouraging initiatives that you could broadly bucket under the sort of the high level label of efficiency measures. But sitting on the private side, looking at the public side that I was once in, I think it's really important not to lose sight of the fact that disclosure is a necessary but not sufficient condition. Ultimately, if we want to harness capital markets and the financial system, we need to make an impact on company valuations and cash flows through instruments beyond disclosure. And I think there's some quite interesting stats came out of the World Bank on this. So I increasingly think that huge swathes of the economy are covered by various carbon pricing schemes in some shape or form. But World Bank estimates are that only 4% of the global economy is covered by an adequate carbon price. So, many of the profits that we see in annual financial statements aren't fully costed, to use a sort of an economist's expression. I think another sort of big picture observation that touches on this nexus between public and private is that how we communicate it. It seems a very quaint point, but I've been lucky enough to work in the private sector, the public sector, and also for NGOs. And I think my two biggest observations would be that the incentive systems that are in play in each of my three stints are completely different. And that's something I think we radically need to think about and don't often enough. And I think how we communicate with each other about the same problems is also radically different. And I think there needs to be a whole lot of investment in that space. Just in the spirit of being slightly controversial, I'll try and throw out a last high-level observation about public finance. And I'm increasingly of the opinion that there's not much value in talking about investment gaps, which we often do. I've done it myself for many years. I've written reports for the UN on the investment gap. But I'm increasingly of the view that the most important thing is just to ensure that what rewards investors also rewards nature and climate change. I think focusing on a gap takes you down a bit of a dead end that isn't a marker of success. And just to put this in perspective, often we celebrate $10 billion going to the Green Climate Fund, for example. But if you read the IMF data, there's $500 to $700 billion of direct subsidies incentivizing private sector companies to invest in part of the fossil fuel chain. So I think, taking a step back and just more broadly understanding what the perverse incentives are that are driving nature destruction is key for me. That went on a bit longer than expected. Do you want me to talk about my fund, or shall I come back to that later, or our fund?
Please continue, Ian. It's very insightful.
Okay, great stuff. So by way of a sort of slightly backward introduction, ADM is a private markets investment manager. We're based in Hong Kong, and we generally run a sector and country agnostic private credit strategy, which basically means lending to companies that the banks don't want to. And we run a second strategy, which is a private equity strategy. So we invest in companies rather than lend the money out of London. The third leg of the group is a foundation, which was set up in 2006. So it makes us a bit of a rare beast in the investment management world. And we're in the process of launching an Indonesia-focused private credit impact fund focused on agricultural commodities. I know that was a bit of a mouthful. But to try and make sense of a vast space and bring this back to biodiversity, we think initially, or certainly we are thinking initially, of biodiversity through the lens of the food and agriculture sector. And the reason for this is it's one of the single largest chunks of the global economy. It's sort of $8 to $10 trillion, which is a meaningless number, but it's probably about 10% of the global economy. It has this very high dependence on nature. So the equivalent of physical risk in climate change, if you're more familiar than that. And it's also exposed to considerable transition risk. There's a dependency on nature. And then the third part is it has a substantial impact on nature. And our view is that much in the same way that if you look at the last decade, climate change was the big sort of banner under which the sustainable finance world revolved. And under that banner or heading, there were two clear investment verticals. They were clean energy and clean mobility. And we think going forward, we're already seeing that biodiversity is one of the big themes that will dominate this decade. And we think that the food and ag sector is a sort of a tangible investment vertical that resonates with the private finance sector, but which also encapsulates a lot of the issues we're dealing with in the biodiversity arena. At the moment, we also think we're dealing with significant uncertainty, and I distinguish this from risk. Risk you can measure probabilistically, whereas uncertainty you can't. And for us, we invest in companies and we hold them for longer periods than a public market investor would generally do. And this highlights to us the importance of future-proofed companies. We can't sell out of a position quickly. So often to rely on us getting our money back, we need another firm who might come in 3 or 4 or 5 years' time and buy at offers. And that firm in question might have an investment holding period of 3, 4, 5, 6 years. So we're therefore having to make investment decisions today and trying to understand what the policy environment might be in potentially up to 10 years. And we have a relatively high degree of confidence that biodiversity will be more rather than less financially material in the future than it is now. So even though our thinking is quite generic, we feel that bringing biodiversity into play in our investment decision-making helps create an attractive return on risk. Maybe just quickly on the opportunity side, there's a lot of sort of doom and gloom and focus on the risk side, but we've got a private equity strategy, and I think we're probably all aware of the amazing advances in the alternative protein sector and the positive benefits that could generate for biodiversity, I think is quite profound. Another really interesting but niche area is, I think, generated by the fact that biodiversity has historically had a bit of a measurement problem. I mean, there's, I think, an anecdote that gets wheeled out from time to time that we didn't realize we were in the middle of a mass extinction until we realized that insects weren't appearing on our windscreens. 70% of insect populations, I think, in Germany had disappeared. There isn't this single simple metric like we have in climate change with carbon dioxide. And to many, biodiversity is a classic big data problem. And what's quite exciting and what creates a whole new opportunity set is that we've got new technologies that allow us to create big data sets and then apply big data analytical techniques to understand the complexity of biodiversity, but hopefully to boil that complexity down into helpful and meaningful metrics without ignoring the complexity that underpins it. So I'll stop there, Romy, back to you.
Super, thank you, Ian. And I agree with you on the last point that there are exciting developments in the metric space, both looking at, the big picture, so satellite imagery, but also looking at eDNA that, especially from an aquatic environment, can give you great samples where you used to have to go into the field and explore. So I think there's big improvements there. So I want to move to our next speaker, which is Jean-Marc, and dive a bit deeper into that opportunity side, because indeed it's often about risk and disclosure, but that's only the first step into moving towards a nature positive economy. So Jean-Marc, I want to ask you, how can financial institutions be more involved in positively contributing to the biodiversity challenge? And if possible, it would be great if you can give a few examples from your bankable nature solutions work that can people relate to. So over to you, Jean-Marc.
Sure, thanks, Romy. And yeah, I think what Ian talked about, I mean, I agree with almost everything he had mentioned in his points. And one thing I'd like to point out, though, is before I go into your question, is that when Ian mentioned on the 10, like about, example, 10 billion going to the GCF, one other thing I'd like to say to that, though, is you hear all these pledges of money, being made, and it sounds great on the, on the top line and the headlines. But then the question is, where is this money going? Like, what is it going to go to? Are we building more bridges, dams? What are we doing with this? So it's a lot of money, and where is it going? The problem is we don't have enough projects to feed into this. And what we need to do is develop projects. And that's what we're trying to do at WWF, and I think Ian as well. And what we want to do is generate projects to have, this type of money channeled into. And so that brings me to the point of, this is where financial institutions can get involved. But the one thing to keep in mind, and I think this was brought up in the initial opening statement, but also through what Ian had said as well, but that, if you look at, if we just take a look at where the environmental risks and what people perceive as the highest risk to on a global scale, the environment tops all of that. And then you also have societal concerns that are just behind that. And those are indirectly related to environmental issues. So we have, major environmental problems to solve here, and we have to start getting money going into this. So the other point that I would say that Ian had made on the basically on investment gaps. Well, yes, that's true. There are investment gaps, but what we need to do is get some of that money that we currently need going into projects, and this is where we can get the financial institutions involved. Now, there's a lot of work being done, globally. I would say the majority of it that I see is more, it's advocacy driven, or it's greening the finance sector, right? And that's very important work that needs to be done. And we need more of everything. We need carbon prices. We need more regulations. Yes, we have to have all of that in place, or else it's never going to happen. We can't just rely on the private sector to do this. But the one thing that we do need is more investment into the actual projects that we're doing, the actual dirt being moved type projects on the ground. It's one thing to hear, a particular asset manager is going to stop investing in this or stop doing that, but we need money actually going into the work that we're trying to do, right? Which is on the ground, trying to build projects. So that's where I want to see more investment or more attention to from financial institutions, both on the early stage incubation side, but also on the investment side. Now, I realize that sometimes the projects that we're developing aren't necessarily investment ready for all banks to get involved with, but they need to start looking at this, and somehow we need to figure out how to start funding the early stage type projects. And so, in particular, the type of projects that what we're talking about in our bankable world, bankable nature solutions world, are projects that they're nature based in a lot of ways. They don't have to be, but most of the time they are nature based. A very good example of one that we're working on, and we showcase this one a lot because it brings in a lot of different kinds of both impact and financial success, or financial metrics, I guess you can say. So it's our rice and aquaculture project that we look at in Vietnam. Now, what that does in that particular project is, if you look at the way, in the lower Mekong, in the Delta, where there was basically a command economy type structure, where it was, let's have farmers produce certain kind of rice, and that's what they did. And it wasn't really successful at all, even when they started in the 80s and the 90s, but it's been exacerbated to be worse because of climate change, and also because of the sea level rise from climate change, and also what you have in the Mekong Delta is land subsidence, where you have land sinking because of various reasons. One is the pumping of water out of aquifers, so what we're trying to do with this particular project is that it's called rice and aquaculture. It's integrated, where we're trying to basically say, okay, well, we know rice is not going to work anymore because in certain periods the sea level is too high and it's too saline for this kind of rice to grow. So what we want to do is replace that rice, continue for them to grow rice, but then integrate that process with shrimp farming. And we'll do that all year round, but in particular seasons where you can't grow rice, it'll be the shrimp farming. So you give the farmers two income streams. But what's really important, though, is the resilience, the land resilience or climate resilience that's built into this, is that what we're trying to do is bring in natural irrigation methods. And through that, the natural irrigation methods from rivers flowing downwards into that will then flood the farms where this is all being grown. It'll bring land sediments or river sediments back into, which will help build the land back up. So there's a huge conservation or huge climate and environmental impact angle, and there's also a very high potential return on these projects. So that's how we look to get the private sector involved in our projects. Another example is one that we're looking at in India, and actually this could be replicated all over Southeast Asia. It's really, I would say that the entry barriers are fairly low, but it's a little bit complex in terms of building your supply chains. But the idea is taking agricultural waste, whether that be in a case that we're looking at right now is rice paddy straw waste, putting that through an anaerobic digester and turning that into energy or food grade CO2 or other type of products. So there's many things that we can do with that. And what that does, for example, in India, the contribution to that is obviously lowering CO2, lowering pollution levels, and also providing more jobs. So there's a lot of impact that we have there. So there's many other projects I can discuss, but I just want to highlight those two, for example. But that's what we really need to do. We really need to get the private sector or financial institutions involved by actually getting into these type of things, instead of just saying, okay, we're not going to invest in this, or we're going to take away our certain investments here and there and exclude carbon or carbon-based type investments. We need more of that going into the projects.
Great. Thank you so much, Jean-Marc. And I think, as you said, it's about greening the financial sector, but also financing green. And, I've seen earlier research, among others, by the IIED on their Money Where It Matters framework, where they say, only about 10% of climate pledges reach the local level where it matters most. So it's great to hear about how WWF is building bankable nature solutions that have an impact on nature and people locally. So I want to move to Nathan to ask you if you can give an example what the Asian Center for Biodiversity is doing to support biodiversity, and if you can link that to your collaborations with the financial sector, that would be wonderful. So over to you, Nathan.
Thank you, Romy. Basically, the ASEAN Center for Biodiversity, or ACB, was established in 2005 by the 10 ASEAN member states. So we are basically a intergovernmental organization under the ASEAN Charter. The works of ACB basically has two main thrusts: biodiversity conservation. This will be looking into protected area management and species conservation. And the other one is mainstreaming biodiversity, which looks into the different development processes and sectors such as tourism, agriculture, business, education, including banking and finance. So for the first one, biodiversity conservation, ACB is implementing a flagship program of the ASEAN. We call it the ASEAN Heritage Parks Program. This is a network of protected areas that represents the different ecosystems in the region. That aims to have to generate greater collaboration between the ASEAN member states in preserving their shared natural heritage. So we currently have 50 ASEAN heritage parks across the region. This comprise 12% of the total area of all protected areas in ASEAN. Okay? While these protected areas are recognized for their essential role in maintaining biodiversity and the ecosystem services that is attached to them, the sustainable management of these critical areas has always been hindered by insufficient financing. I mean, I think in most part of the world, sustainable financing has always been an issue. So despite the growth of government financial support in the previous years, there still remains a massive gap in financing the optimal needs to manage existing protected areas effectively and the biodiversity that comes with it, as well as the ecosystem services that comes with it. So what we did in the center, during the pandemic, as we go into more an online mode, we try to organize various dialogues, workshops, and webinars to reach out to the finance sector and the business sector as well, in terms of looking into how we can move ahead and somehow forge future partnerships with these sectors for the conduct of biodiversity sound projects and activities. So one of our recent discussions is on conservation and sustainable financing, where we tried to come up with an inventory of the different efforts in the region that is related to sustainable financing of protected areas. So to name a few, we look into some mechanisms such as payment for ecosystem services, which is currently being done by Vietnam through their payment for forest environmental services mechanisms. This has been established way back in 2008. Also for the Philippines, that we have the Philippines have the Integrated Protected Area Fund, which is also a form of the PES. And then other innovative financing that that is directly linked to the banking and the finance sector is the Green Sukuk. This is a sort of a bond, a type of bond that is being issued in Malaysia and Indonesia, where they look into green investments as well. In the past 3 decades, there have been a mobilization of various conservation trust funds within the region. And among these trust funds include the Central Cardamoms Conservation Endowment in Cambodia, the Indonesian Biodiversity Foundation, for the Harapan Forest or the Kehati. We have also the Environmental Protection Fund and Forest Protection Fund in Lao, PDR, the National Conservation Trust Fund for Natural Resources in Malaysia, Myanmar Biodiversity Fund of Myanmar. Of course, we have some foundations like the Foundation for the Philippine Environment in the Philippines and the Forest Foundation of the Philippines and the Vietnam Environmental Protection Fund, as well as the Vietnam Conservation Fund. But these are basically trust funds that are not very much related into how we relate with the banking and the finance sector. But there are already some developments that are where banking and the finance sector in the ASEAN are already looking into financing for biodiversity and also trying to veer away from financing programs and projects that are somehow have negative impacts on biodiversity. Like for example, I think in Singapore, they are already trying to minimize financing for coal-related projects, while in the Philippines, the Bangko Sentral or the Central Bank of the Philippines has already issued a sustainable financing guidelines for all the banks in the Philippines. In particular, one of the Philippine-owned bank, the Development Bank of the Philippines, has already made a financing window that would cater to more, let's say, nature-friendly investments.
Thank you so much, Nathan. And I'll come back to you with a follow-up question, but I first want to go back to Ian and Jean-Marc and speak a bit more about the integration side. So to the both of you, how to successfully integrate nature and biodiversity within the work of financial institutions. And Ian, if you can explore a bit more about the role of blended finance, and Jean-Marc, we know that you are, among others, working on the Dutch Fund for Climate and Development. So it would be great to hear an example from you from that space. So Ian, if you want to start with the role of blended finance.
Sure, thanks, Romy. I suppose one of the ways that blended finance is really helpful, especially with something like biodiversity, which is arguably at quite a nascent stage in the kind of evolution or the sort of the investment innovation curve. We're launching a fund, and we spent quite a lot of time and effort trying to get access to grant funding, which is one of several blended finance instruments. And part of the reason we're doing this is so that we can help develop the baselines on which we can then measure performance. A second attribute of biodiversity is it is something that's relatively new to the financial sector. It's also something that's relatively localized, which is one of the features that often distinguishes it from climate change. And so one of the ways we're getting around this in our fund is we've set up an external impact advisory committee, an IAC for those that like acronyms. And this will be staffed with 4 external members. We'll have one focus on biodiversity, one on supply chains, one on IFC performance standards, and another on conservation. And what we're doing in terms of your question about integrating biodiversity into the fund is normally with a fund like ours, there's a sort of performance-related income stream called carry, which is effectively the profits the fund makes once you strip out all the costs. And normally this is given to the investment manager based on the financial performance of the fund. What we're doing in this case is we're actually splitting that in half, and we're putting half of it into what we're calling a conditional carry pool. And for each transaction, this impact advisory committee will look at the baseline biodiversity data, as well as climate change and social data, and they'll set targets. And effectively, those targets can be rolled up into a fund level target, and ultimately we'll have a fund level score, which describes how well we've done against that target. And the reason that's important is the amount of this conditional carry, the 50% that went into this sort of escrow account that gets released back to us, is going to be dependent on how well the fund does on this impact score. And what that does is it creates a financial incentive for the fund manager to think about biodiversity and other impacts right through to the end of the fund. So that's just one example without boring you with the details of how we're integrating it, and also drawing in this external expertise, because we're under no illusion that it's a very complex area, and also localized knowledge is highly important in the biodiversity domain.
Super, thank you so much, Ian. And then over to you, Jean-Marc, with maybe an example from the DFCD.
Yeah, I mean, if we're talking on the, I guess, the structural side of how it works, as opposed to a particular project, some feedback. So what we want to do, I mean, what basically what the DFCD is, it is a form of, too much echo. It's a form of blended finance, really what it does. It's taking, in this case, the DFCD is it's all public capital that's supplied by the foreign ministry, the Ministry of Foreign Affairs in the Netherlands. It's 160 million, and a portion of that goes into 30 million goes into project incubation, and that's grant capital, and that's basically what we would say is you can say it's first loss, but it's basically risk capital to kind of help de-risk projects and get them off the ground. Then at the next stage, we have capital that's actually investment capital, and that is either debt or equity financing that's provided by either FMO or climate fund managers who are part of this consortium. So basically it's really a unique model in the sense that this is really the first. It's very pioneering in the sense that they're actually committed to putting capital to work so we can actually develop and find projects, as opposed, because what you find a lot in this space is that everyone wants projects, but when they're already sort of developed. And at that point, I say, get in line, because everyone else wants to have those projects too. But where we need the work is at the very early stage to get these things off the ground. So that's what the DFCD is doing. And what we want to do, and what we're trying to do, is actually replicate that model as well beyond just DFCD, because as we know, we need a lot more. While 160 million is good, we need much more than that. So the idea is to replicate that similar model. And then also, there's many other type of instruments that we're looking at to capture capital. But that's really what that's really what the model is, and that's how we want to continue to do it, because most of this is I think you'll find a lot of this project type work is supplied, it's mainly through, or finance, I should say, not supplied, but financed through debt financing. So I think that a lot of that is where we want to go.
Great, thank you so much, Jean-Marc. And being Dutch, the DFCD is certainly something to be proud of, I think. So I want to come back to you, Nathan, with a question which is a bit related to what Jean-Marc said about this scaling of work. So you explained to us a number of past schemes that you're working on in the region. How do you think you can scale these models and attract more mainstream investments into the work that you're doing?
Well, basically, what we are trying to do now is to have more cross-sectoral cooperation. In the ASEAN language, it's more cross-pillar cooperation. Because in the ASEAN structure, we work on 3 pillars: the economic pillar, the security pillar, and the socio-cultural pillar. ACB falls under the socio-cultural pillar. I think establishing more dialogues cross-sectorally will somehow give more attraction in terms of providing more support to biodiversity. Because traditionally we treat this kind of issues on biodiversity and nature conservation from a very sectoral point of view. And though there have been ongoing discussions already on multi-sectoral approach, I think it's really more in terms of how we operationalize it on the ground, because there are still policies within respective countries in the ASEAN member states that are still somehow not complementary. I would not say really that are conflicting with each other. Like example, investment policies vis-a-vis tourism policy, vis-a-vis protected area management policies. I would not say that there are conflicts, but I think there needs to be more harmonization. because for us to really attract investments, let's say the banking and finance sector to invest more in terms of biodiversity conservation, I think it should also be put into a language that the banking and the finance would be more familiar with. Like, for example, right now, I think everyone is becoming more familiar with the concept of natural capital, where we view nature and biodiversity also as a capital, and it has a corresponding value to it. So I think that's how we can further upscale all these efforts and attract more support from the banking and the finance sector.
Thank you so much, Nathan. So I think before we wrap up, I want to go to each speaker with a 30-second snip. So we have the listeners to the Ethical Finance ASEAN Summit 2022. What can they do tomorrow to invest in nature? So maybe stay with you first, Nathan, for 30 seconds, last words of wisdom from your side.
Okay, thank you very much, Romy, for that question. I think we should, everyone should think about biodiversity as really something important in the way how we live our lives. I think I cannot think of anything that we do that is not embedded on nature and biodiversity, like
Perfect.
the food we eat, the air we breathe, the water we drink. This all comes from nature and biodiversity. So I think if we invest more into it, I mean, providing more investment to biodiversity and nature conservation will somehow makes our life more sustainable, even the economies that depend on
Let's
it.
go to the next speaker, Ian. Your 30 seconds. What can people do tomorrow?
Sure, I would say change the narrative, move from net zero to net zero nature positive. I think about the opportunity side of the equation. I think we dwell on the risk side too much. Think about communication a lot more. And I suppose this would be a message to the kind of inquiries I get. I'm sure Jean-Marc gets the whole time. People want to get into sustainable finance. And if you're thinking about it and you're comfortable operating at that slightly early stage of the innovation curve, just get involved in biodiversity. As we've just heard, literally 100% of the economy depends on it. It is going to define this decade. So get involved.
Great, just do it. And then the last speaker, Jean-Marc.
Yeah, thanks. What we need, brought to my attention by my ex-colleague, Dr. Lawrence McCook, is we need to have more environmental related people on boards of major corporations at the highest levels. We always have it the reverse. We got plenty of finance people, business people on our boards. We need to reverse that trend and get more people at the top that are representing what we want into those companies.
Super. Thank you all so much for your statements. And I also want to thank Dr. Teresa for her opening statement. So thank you so much, Nathan, Ian, and Jean-Marc. And I think it's over to you again, Shireen, with the next session. Thank you so much.
Thank you, Romy, Dr. Teresa, and the panel for providing a very insightful session into the significance of safeguarding biodiversity in the ASEAN region and how public, private, and blended finance can contribute to its protection and restoration, as well as address some of the challenges faced along the way. Ladies and gentlemen, there has been some great knowledge and insights shared by our speakers over the past few hours. And I'm sure at this point, you will need some time to reflect on these discussions. So this would be a great time to take a short break. We will be back with more insightful discussions in the upcoming session that focuses on the social issues impacting the region. In other words, the S in ESG. So we'll see you after the break in 10 minutes. Thank you.
Always remember whose little coins these are that become the millions and the billions that pass through your hands. Whose hard-earned savings are these? Upon whose backs do streams of sweat flow? Whom do they look to for a better tomorrow? Who are the ones who make the daily sacrifices to develop entire communities, to build a business, to raise a child, to construct highways, to set up schools? Always remember the lives that depend on you. I am an AICB member, and I'll always remember whose money it is. Be a chartered banker.
The SDG's Financial Products Platform showcases commercial financial products that are directly aligned to the Sustainable Development Goals.
The platform's aim is to facilitate the development of innovative, SDG-aligned financial products across asset classes that ultimately build the ecosystem of SDG investing.
We know that private sector-led solutions are required to deliver the SDGs. But in a market of virtue signalling and champagne stewardship, it is difficult to discern which products are truly aligned with the SDGs.
The SDGs provide an opportunity for financial institutions to embed people, planet, and profit in their products.
The world of ESG is full of jargon and fragmented approaches currently. And focusing on something that's been agreed and in place since 2015, sponsored by the UN, to direct our thinking and analysis around investment and to measure the outcomes of how that investment is performing gives us a real strong platform to make progress and to enhance people's savings with some benefit to the world. We're incredibly pleased to be part of the Global Ethical Finance Initiative. We believe that the work we have done around sustainable sovereign bond investing merits a broad audience, and GEFI gives us that broader audience than that which we could achieve ourselves.
The platform is open to applications from new and existing financial products representing leading market practice across different asset classes.
Products listed on the platform must be of significant size, ideally in excess of 100 million, and scalable. Platform partners must demonstrate genuine commitment to the SDGs and be willing to share their experiences in the product development cycle.
The SDG Financial Products Platform is the result of a collaboration between the Global Ethical Finance Initiative, or GEFI, and the United Nations Development Programme.
The platform is open to applicants that can demonstrate an alignment with the SDGs. GEFI undertakes detailed, extensive sustainability-focused due diligence and only selects partners that demonstrate a genuine authenticity and dedication to the 2030 SDG agenda.
We work in collaboration with partners through the product lifecycle to share learnings and highlight leading market practice. This is done in 3 ways.
Showcasing. Partners have the opportunity to share insights on their products at our global flagship events and co-develop thought leadership shared across our international network of over 15,000 global financial professionals.
Enhanced authenticity. Partners benefit from additional product endorsement through the unique collaboration with an established NGO.
Technical expertise and knowledge. We meet quarterly with the partners to share insights on market developments that help refine the product strategy, and we use GEFI's proprietary SDG framework methodology that utilizes 160 plus targets and 300 plus indicators to intertwine them within the investment thesis.
GEFI and the UNDP launched the platform at COP26 with the platform's first core partner, Aegon, and its Global Sustainable Sovereign Bond Fund.
So I'm delighted that Aegon UK and Aegon Asset Management have partnered with GEFI in the launch of the new Aegon Global Sustainable Sovereign Bond Fund. And I'm proud that we've invested £100 million of one of our key default funds, the Universal Balance Collection, into this fund.
We try to invest in those countries that do show right now best practices in terms of sustainability when it comes to regulation, but also we try to identify those that are doing the best to improve in the future. So not only current leaders, but also future leaders. Well, the main attraction to invest in sustainable sovereign bonds is that you achieve long-term resilience. So you're able to protect capital, but as well find sources of yield and performance for the future. And also you will construct a portfolio that will be resilient under different scenarios, including extreme climate scenarios. We expect those countries to perform better just because they are today investing in solving these issues for the future.
If you are committed to achieving the SDGs and are interested in having your product promoted on the SDG platform, please get in touch with GEFI.
As Adam Smith said in his theory of moral sentiments, markets need to be underpinned by morals.
Let's ask the question, the person I disagree with, what is he right about? Not what is he wrong about, we can write volumes about that. What is he right about so that we enter a conversation where we can move forward?
If we can come up with something, land it at the country level, be intentionally inclusive, we will actually raise these vast sums of money, because guess what? The money's there.
In most crises, it's a dynamic phenomenon, and the key importance of this is to recognize where the crisis is going so that we can be anticipatory and have policies that deal with the next phase of the crisis.
At this global turning point, such efforts will help countries and communities to build forward better.
And the GEFI team are certainly to be credited for bringing us to this point. Their work has placed Scotland at the very heart of the revolution, of the green, sustainable and ethical finance revolution.
Welcome back, ladies and gentlemen. I hope you had the opportunity to digest the takeaways from the earlier sessions and are ready for more insights from the upcoming discussions. We will now take a look at the social component of ESG in sustainable investing, which inevitably puts relationships in the spotlight. In particular, it addresses the relationship between organizations and their employees, financial stakeholders, the communities in which it operates, and the broader environment. Allow me to introduce the moderator for this session, Datuk Sri Dr. Muhammad Zabidi Ahmad, who is the Senior Strategic Advisor at financial tech solutions provider DDCAP Group. An industry veteran with over 38 years of experience in the banking industry, he has amassed 19 years experience in group treasury product and functions, both in the conventional side and Islamic. He previously served as the Senior Managing Director and Regional Head, Islamic Treasury, Treasury and Markets, Group Wholesale Banking for CIMB Group, during which he was responsible for development of CIMB's Group Regional Islamic Treasury franchises, managing over 100 billion ringgit of Islamic assets for CIMB Group Islamic Banking. A qualified chartered accountant, Datuk Sri Dr. Zabidi is an AICB member, a certified senior financial market practitioner by ACI Financial Markets Association of Malaysia, and a practicing member of the Malaysian Institute of Accountants. He also holds an associate qualification in Islamic finance from Islamic Banking and Finance Institute Malaysia, and is a senior associate from the Chartered Institute of Islamic Finance. Recently, he was appointed as an industry distinguished research fellow for the Institute of Sustainable Growth and Urban Development of UUM, and a member of the Investment Committee for the International Institute of Advanced Islamic Studies, Malaysia. He also serves as an adjunct professor at Perdana University. Please welcome Datuk Sri Dr. Zabidi.
Thank you, Shirin, for the introduction. First, I would like to thank the GEFI who are inviting me to the Ethical Finance ASEAN 2022. Co-hosting with AICB. With me today, we have the three esteemed panel speakers, which I will introduce all of them. First panel speaker is Mr. Shahril Azwar Jimin. He was appointed as Maybank first sustainable officer on 1st March 2021. He led Maybank group effort on sustainability with focusing on environmental, social, and governance. So we have the second panel for this conference, which very famous in ASEAN and also in the world, which is Tan Sri Azman Mokhtar. Welcome, Tan Sri. Tan Sri Azman Mokhtar is currently the chairman of Lembaga Tabung Haji Malaysia, Hajj Pilgrim Fund Board, the chairman of Board of Director of University Technology Malaysia, or UTM, and the chairman of INSAFE, the International Center for Education in Islamic Finance in Malaysia. Between June 2004 and July 2018, he was the managing director of Khazanah National Berhad, or Khazanah, Malaysia Strategic Investment Fund. So our third panel for this conference is Mrs. Komi Rajdev. Yeah, as a head business development, ASEAN in Moody ESG solution, Komi is responsible for client in the region for sustainable finance, ESG, and climate data. She has over 20 years of experience in international banking and credit rating in the region. So to start with, I think this panel session will look at the social issue, which is the S in SG from regional perspective. What is social finance? In actual fact, is a finance that is some consider social issue that could mean addressing poverty, respecting labor rights. It could mean not engaging in sin sectors. It could mean trying to avoid causing harm and division in the way that many social media companies have been accused of. So now we come to my first question to our first panel, in Mr. Shahril here, which is how much of a concern of social issue such as poverty and financial inclusion in the approach to sustainable finance in Asia?
Thank you, Dato' Sri. Yeah, thank you, Dato' Sri Zabudi. I'd be more than happy to give the honor to Tan Sri Azman first, but since you asked me, well, say when we talk about sustainability issues or leading towards sustainable finance and so on, I would like to paraphrase first what is therefore the sustainability challenge actually that we're looking at. So I would say that the sustainability challenge, or at least how we look at it in Maybank, is the pursuit of economic progress whilst doing well in the areas of environmental, social, and governance. So it's one of the things that we really need to address if we were to look at sustainability and the pursuit of economic progress as part of the larger sustainability challenge. So yes, when we look at it from the capital markets and financial institution perspective, we look at it from the lens of ESG. So the social pillar is a huge imperative. So how much of the concerns of social issues such as poverty and financial inclusion, as you say, I would like to look at it from the precursors to financial inclusion. I would like to look at financial literacy, and I would like to look at financial access before we even look at financial inclusion and how we can attempt to alleviate or eradicate poverty. So financial literacy, we like to say, is the precursor to financial inclusion. And by raising financial literacy, we will be able to empower individuals with the knowledge and skills necessary to make responsible financial decisions and improve their financial well-being. It's easier said than done. You'll be surprised at the levels of financial literacy within the ASEAN region, which is quite low actually. So a recent World Bank survey on the financial literacy of adults indicated that the financial literacy lags behind in many ASEAN countries, with Philippines at only 25%, compared to 59% in Singapore, 52% Myanmar, and 36% in Malaysia, among others. And this is something that we really need to address in terms of financial literacy. And then we go on to the issue of financial access. And this is where, as a bank, we have a large role to play. And I'm often asked, what would you do as a bank in this regard? So we are cognizant of the fact that as a bank, we have the power to move capital in the right direction, away from harm to social and environmental degradation towards social development. So access to financial services, therefore, is important in every household. Provision of financial services such as savings, payments, and even credit that can make a substantial positive difference to lives. Again, we often take it lightly. We talk about access to financial services, but we talk about the ASEAN region. I'll give you an example. In the Philippines, 70% of the adult population is unbanked. So 70% of the Philippine population is unbanked, and that's a huge number, which provides a huge opportunity for organizations like Maybank to make a difference. Again, in the Philippines, there's 1,600 municipalities, and 610 of them are without any banking office. So there's a large role that we need to play, that we need to address before we even talk about the issue of financial inclusion. We need to address financial literacy. We need to address financial access. So that's how I would start this discussion, at least from a viewpoint of a bank.
Thank you, Mr. Sharif. Since that the Asian countries still, in terms of the financial services, still low, right? And also we can see in terms of financial services that you mentioned just now is about 70%, unbanked, like in the Philippines. Continuous from this, from your answer, I want to go to Tan Sri Azman to get some question that I wanted to ask Tan Sri over here, Tan Sri. To what extent religious values are important part of social finance? To you, Tan Sri
Azman. Yeah, thank you, Datuk Sri, moderator, fellow panelists, Shahril and Komi, and thank you to GEFI for the invitation. I suppose the issue of values, religious values, as what was posed within the topic of the S in ESG. I think it's appropriate that we are on a panel about ASEAN, convened by GEFI. I'm not sure, is it GEFI or GEFI? GEFI lah kot, GEFI, the Global Ethical Finance Initiative. I happen to be on the steering board of GEFI, and you may know that the Ethical Finance Initiative, if I were to relate that to religious values as you posed, started and still is, it's based in Scotland. In fact, it's based in Edinburgh, which is of course the home of Adam Smith, as we know, who is the, I suppose, well, apart from being the author of The Wealth of Nations, he also wrote something called the Theory of Moral Sentiments, as you know. In fact, he wrote the Theory of Moral Sentiments first, and then The Wealth of Nations. The Wealth of Nations became a bestseller. He went back and rewrote the Theory of Moral Sentiments. Why is this relevant? Is Adam Smith grew out of the so-called Scottish Enlightenment, which in itself was out of the European Enlightenment. So this one, we have to track back to how this thing evolved, finance, in the context of the religious framework of a Europe that was changing. So the so-called Descartes, I know that I don't intend to get the thing. Descartes, etc., etc. Now, the relevance of this, of course, values are relevant, whether religious or ethical or morality, as you put it. The reason being, no amount of governance systems, ESG standards, taxonomies, rating agencies, investors that we can put, that you can fully govern the actions and the outcome, in any process, including the investment and the financing process. That's my first point. So therefore, some have said, you know, you have corporate governance, national governance, there's something called human governance, I suppose. So to relate an anecdote, I believe GEFI and Chris and Christine from GEFI can confirm this. We declared something called the Edinburgh Declaration. If you go into the GEFI website, which I believe was joint work between the UK Islamic Finance Council, the Church of Scotland and the Church of England. So the various faith communities addressing finance punya principles, somewhat even before the whole ESG, SDG movement. So this was relatively early. So the likes of Dr. Rowan Williams, for example, was the Archbishop of Canterbury, participated in this. Along the way, we found that quite large chunks of the UK public actually basically profess to be of non-faith punya affiliation. And therefore, the language of this declaration was also, what do you call it, it accommodated non-faith into ethical and moral frameworks. I like to think, in a nutshell, therefore, the second point is there are a lot of common positive things from the various religions, both the Abrahamic faith as well as the Dharmic faith, which include Buddhism, etc., as well as the so-called non-faith, the segi values and from values and ethics. So I would say it plays actually the underlying philosophical base to have any meaningful discussion on ESG, whether the S in ESG or ESG itself. Because you know, one of the major challenges of the ESG movement, good as it is the issue of greenwashing. To really overcome greenwashing, you really need to go back to some very basic first principles. And finally, some of our discussions so far on this, we said we must go back to the real Adam Smith, who wrote The Wealth of Nations in the context of the moral economy. But actually, the faith community will tell you, you've got to go back not just to Adam Smith, but to Adam himself. Because Adam is the first human being and the first prophet. For us Muslims, we believe, of course, the last prophet is our Prophet Muhammad sallallahu alaihi wasallam, and all the faiths in between. So slightly long, but I hope that helps to contextualize.
Thank you. Thanks, everyone. I think I agree with you in terms of the all religions. You know, they have value, good value. You know, consider the important part of the social finance, which is, I think, in any religious, you know, you mentioned that all religions, whether Christian or Muslim, I mean Islam, that kind of thing, there must be a good things that can, create a value to make sure the real social finance is established and also having practices. So in terms of all this important of all this issue to address, right? Now I came to Komi on one question that, you know, how able are investors to use rating and data to make decisions based on social factors? To you, Komi.
Thank you, Dr. Muhammad. Thank you for your introduction of myself as well earlier. And I want to say that I'm really delighted to be part of this inaugural ASEAN Ethical Finance event, as well as I feel privileged to be part of a panelist with Mr. Shahril and Tan Sri Azman, very esteemed panelists along with me. So with that, thank you for that question. I think it's very interesting to actually get started back again on a little bit of a definition on the S here. So S in terms of social factors, mainly why it's interesting to the investors is that it poses a risk to the company's financial performance. So some of the issues that can come up with the social part are labor standards, for example, human rights, racial justice, that Tan Sri Azman mentioned earlier as well, or supply chain issues. And the more major mega trends today, like automation and innovative and also disruptions, as well as AI, artificial intelligence. All of these are also the mega trends today for the social part. I just want to also share from the lens of ESG, customers are increasingly coming towards us for a holistic view for associated risk and opportunities that are also related to the S social part. Then it is very important to also discuss about the relevance of the ESG ratings and data for investors. So mainly there are like four main types of investors. Investors that are looking for a quick risk flags, for example, red flags in their investment portfolio in terms of S or E and G. And there's another group of investors who are passive investors who may use the data to screen or weigh portfolios to, for example, include, exclude, overweight or underweight sectors and stocks. Then next, we have the sustainable investment novice. These are the active space who may use data and ratings to adjust weightings in their portfolios and do an ESG integration box. And the next type of investors are the shallow approach engagement-oriented investors who use companies' disclosures and ESG ratings more like a proxy for management commitment. These are mainly the type of investors that we are looking at. And then the next one will be on the we're looking at the relevance, for example, of the ESG ratings and data. In this case, we are looking at two types. For example, top-down screening of portfolios or creating indexes. And also, more specifically, on company peer analysis. So I can give you an example, for example, carbon footprint for the top-down screening portfolios. And also, for example, to create a low carbon index. These are the kind of things that the investors will look at. Other factors are like, for example, when they are looking at relative sugar content, for example, in soft drinks for the corporates, they want to use this as a social shift to healthy foods, for example. So overall, for asset managers, generally disclosure of policy-based engagement is really, really important. And that's the main factors for using ESG data and ESG ratings. There are also, it's important for us to talk about the challenges that come up because of enabling the investors. So similar concept to the E pillar, S also has common challenges. For example, definition of the S, standards, measurement approaches that the industry is still maturing around. And also it's a little bit more difficult to quantify the social impact, and that remains a challenge. With that, I just want to highlight 2021 ESG survey by BNP Paribas, which revealed that 51% of the investors found the S to be the most difficult to analyze and embed into their investment strategies. In that findings also, that data acutely lacked in terms of standardization around social metrics. So this is one of the reasons why accepting data and assessing social performance by companies they invest can become difficult. The other factors are also for investors, S becomes merely a checkbox exercise, while the growing demand and the risk expectations from market participants and investors for transparency, the decision useful ESG and social data becomes important. I'll just move on a little bit more towards other challenges as well. And I would like to also share with you that BlackRock had a proxy voting guideline that for the US companies to disclose workforce demographics, such as race, ethnicity, gender, in line with the US equal opportunity employment. These are some of the changes and challenges that can be addressed. And it's also noted that for human capital management, critical factors in fostering an inclusive, diverse, and engaged workforce contributes to business continuity and innovation for long-term value creation. So the pressure is really coming from the investors. For example, the UK's largest investment companies, Legal and General, has warned it will vote against any FTSE 100 company that still has an all-white board by 2022. That's this year, right? So pushing for ESG disclosure is gaining momentum. And the likelihood the rulemaking by SEC will be in connection with the human capital disclosure will also increase. So with that, similarly, FCA is pushing for diversity disclosure by all listed companies and has proposed a mandated level of diversity on listed company boards for women and ethnic minorities in UK. So the work is going on, and essentially more pressure will be put on disclosing. With that, I just want to say that generally complex assessment coverage of broad topics are all difficult parts for the social. It's a little different for the governance and environment in this case, basically because there is no consistent regulatory standards. Unlike, for example, environment, there is a net zero agreement, and there is also many companies are also lacking uniform reporting framework.
Yeah.
And for social opportunities, for example, Moody's has the Moody's Sustainable Goods and Services provides services in in-depth assessment, proportion of commercial activities that links to the United Nations. So these are kind of the things that we are able to support for Moody's from our perspective. And with that, I would also like to hand over the floor back to Dato Sri Dr. Muhammad, and hope to be taking care together with the rest of my panelists in the fireside discussion. Thank you.
Thank you for your very detailed in terms of the importance of the data for the because if we can see the current investor are looking towards the data, because when they wanted to invest, they must have something like, you know, to make sure the decision they are making based on certain you know, very accurate data. So this is very important. But you mentioned about the challenges also. I think that part, people, I mean, during the current trend, I can see that it has been pushing towards to make sure that the sustainability agenda in terms of the data will be available for investors to invest in any company, especially the big company, because, you know, for them, for the company itself, it's a pleasure for them, because new investors are looking, believe that, you know, this company that implement ESG, then, you know, the profitability of the company will be increased further and further. Thanks, Komi, for your detailed explanation on the data itself. So now we go to round two now. We go back to Mr. Sharil on the question for you, Sharil. Would you say the social issue are more or less important than climate to people in Asia? How does this differ between finance professional and the general public? To you, Sharil.
Thank you, Dato' Sri. It's a bit difficult to answer that, because in many ways they are also interrelated. Many of the impact of climate change and social issues are interrelated. It is said that we live in a world of 3 C's today: conflict, COVID, and climate change. It is said that we live in the world of 3 C's. I like to say that there is a 4th C, complicity. If we don't do anything, then we are complicit to the issues of conflict, climate change, and COVID. So minimal 3C, I say 4C. But so if you ask which issues are more important well, between social or climate in ASEAN, I would like to give you some evidence to my answer on that. So there is a very recent survey report conducted by ASEAN through the ASEAN Secretariat, and it's called the 2021 Survey Report on the State of Southeast Asia. And they looked at the top 10 challenges facing people in ASEAN. And this was a huge survey undertaken by ASEAN amongst ordinary people throughout all the 10 ASEAN member states. Yeah. So the top concern among the peoples of ASEAN is, number one, the threat to health from COVID-19 pandemic. That's the biggest concern. And it differs country to country. The strongest anxiety is felt in Laos at 90%. Second is Myanmar at 87%. And third is Indonesia at 84%. Whilst the lower ones are Singapore at 63%, Thailand at 64%, and Brunei at 69%, which I guess reflect the health infrastructure and capabilities of those countries. Yeah, so the first concern is a threat from COVID-19 pandemic. The second concern from the survey that they found was actually economic recession and the issue of unemployment. And that was a big factor among all the ASEAN peoples that were surveyed. The third biggest concern is the widening socio-economic gaps and rising income disparity. And this is a big thing because within ASEAN, the gap between the richest and the poorest is 40 times. So that's a big concern. Now, climate change came in at number 4. So if you ask me, which is more important within this region, I'll give you the survey results. Yeah, so climate change is ranked as number 4. Health and social issues are the top 3 things on the minds of peoples within this region, and with good reason. So in the Asia Pacific region alone, more than 820 million workers in the informal economy and over 70 million children in low-income households have been hit hard by COVID's economic impacts. And in last year, 2021 alone, if I recall, an additional 85 million people were pushed into extreme poverty. So that's huge, and I think that is on people's mind more than the impacts of climate change, although there is direct correlation, although not immediate. We all know the potential effects of climate change. If we do not do anything today, the world will experience an average increase in global temperatures by 3.4 degrees by the year 2100. I think everybody knows that, and hence all the net zero actions that has been put in place. Yeah, so trying to keep the temperature rise below 1.5 degrees and so on. But that sometimes seems far away from the thoughts of the people here in terms of the issues of climate and what needs to be done, knowing very well that carbon in the atmosphere today were not emitted in recent times, but go back as far as the Industrial Revolution. So the impact of which has brought about economic growth to developed countries at the expense of the environment. And we in ASEAN are at different stages of progress, and especially in relation to climate policies. We're paying the price for economic development in the more advanced countries. So for me, if you ask me which is more important, definitely I would place a lot of emphasis on the social issues, but we need to address the issue of climate change because it will exacerbate the social problems. Rising temperatures will lead to rising waters, floods, putting cities like Jakarta, Bangkok underwater throughout the region. So what we at Maybank are doing to make sure that in terms of preparing for sustainable finance and so on, we need to ensure a fair and just transition. So we need to strike a balance between environment and social imperatives as we're facing different challenges from those in the developed world. So we should be given the opportunity to progress. We should be given the opportunity to enable social development whilst addressing the climate issues in the world today. Thank you, Dr.
Thanks, Mr. Sharil. In actual fact, I agree with you because we can see from the data that you've given, right? Since that the climate change is number 4 concerned by the Asian country, I think, but in Malaysia, I think we are moving towards to make sure the climate change is one of the agenda of some of the financial institutions, whereby we wanted to lend it to make sure that all these, the company that wanted to to doing their business or expand their business, not should consider in terms of the protecting the environment, which is will save the agenda of the climate change there. Moving forward, then you are a banker. There is another question that I wanted to ask you. How are banks in Malaysia and throughout the region tackling financial inclusion? And what impact has the pandemic had on financial inclusion? To you, Mr. Shari.
Okay. Getting your money's worth. Okay.
Yeah. I agree.
Well, a lot of things in Malaysia, at least for banking, which is a highly regulated industry, are driven by the regulators, as you know. Even the issue of climate change, before we talk about financial inclusion, the Securities Commission, Bank Negara Malaysia, Bursa Malaysia have all come up with various guidelines, various exposure drafts. There's a joint committee on climate change, co-chaired by Bank Negara and Securities Commission. So it's all being addressed. We have the climate change and principle-based taxonomy being put in place right now. So whilst those are new, we are addressing that. But the issue of financial inclusion, at least in Malaysia, you're asking me about the banks in Malaysia, it's been there a while. It's been there a while. It's just that with technology, banks need to pivot, need to change the approach. So the biggest thing that we're doing, at least in Maybank, in terms of tackling financial inclusion, and this is a huge global opportunity, is going digital and the issue of digital finance. And even at the G20, this has been reaffirmed, following its commitment to implement the G20 high-level principles of digital financial inclusion. So we've already put this in our new Maybank corporate strategy called M25, which is our strategy from 2020 to 2025, in which one of the 3 key pillars is being pervasively digital. And this means enhancing financial access and inclusion, and also addressing the S in ESG at the same time. And we see this as a big enabler, particularly in countries like Indonesia and the Philippines, big countries across its thousands of islands. We see that going digital does provide better access to financial services, given that there are not many physical banks in many of the 7,700 islands across the Philippines and so on. But in Malaysia itself, one of the things that we do in terms of financial inclusion, and when we talk about financial inclusion, it's not just about ordinary people on the street. We're talking about financial inclusion for SMEs as well. We don't forget. So one of the things that has been quite successful in Malaysia is our SME digital financing. So we've come up with an end-to-end solution for SMEs, providing straight-through processing from application, approval, up to disbursement. We offer quick, hassle-free financing solutions at the convenience. We launched this in September 2020, and we've already disbursed financing to 11,000 micro enterprises, totaling about 1.3 billion ringgit. So that's for SME. Make it easy, provide easy access for them. We've also have a specialized program called SME Business Financing. We come up with a Maybank to You business app, also to provide secure mobile banking services to assist SMEs in their day-to-day operations. And since the launch in October 2021, we have more than 18,000 companies, SMEs, signing up, generating more than 110,000 transactions, coming up to nearly 500 million ringgit. We've another measure of our pivot to digital is that we support local businesses, small stall holders, particularly food vendors and so on, by coming up with a program called Sama Local. It's a zero commission online marketplace to help empower these merchants stay afloat, especially in the last 2 years during the COVID pandemic, by providing them opportunity to digitize their businesses and to gain greater access to customers. So it is big. Digital is something that we're going big on, but at the same time, we also do various social impact investments on the ground. to empower our people. And this is done primarily through our Maybank Foundation, which runs programs in all the 10 ASEAN countries. Programs like empowering and giving mentoring to disabled people, PWDs, for economic empowerment and financial inclusion. We've trained more than 13,000 disabled people to become successful business people across 4 or 5 countries throughout ASEAN. We also have a program called Maybank Women Eco Weavers. We build centers for capacity building in weaving. We have 8 of them in countries across ASEAN, Laos, Cambodia, Malaysia, Indonesia, for example, to ensure that people still are able to generate income. But at the same time, in this program called Maybank Women Eco Weavers, continue and maintain the culture and heritage. Various things that we're doing, from going digital to social impact investments on the ground itself.
Yeah. Thanks, Ms. Shari. I think it's good whereby Maybank have been done this initiative. I think based on the Malaysian financial institution, other banks also starting doing this, because SMEs sector is very big. You know, is part of the supporting the Malaysian economy itself. So well done to Maybank that you know going towards digital, then hopefully you know other financial institutions, especially in Malaysia, will follow through. So now we go towards to the Tan Sri Azman on the question that does all Islamic finance have a responsibility to address social issues such as addiction, immorality, etc., that are prohibited for Islamic finance, or should this be the primary focus for Islamic institution? Over to you, Tasrit.
Yeah, how much time do we have left? I'm afraid Maybank has crowded us out, Cheryl.
Okay.
There was a sign that says 5 minutes left. That was 1 minute ago.
Okay.
So I'm 4 minutes. I'm time too. So,
okay.
So I'm just gonna to say that I think between the trade-off between people and planet, I think it's a bit of a false binary. Both are important, and Cheryl made the point they're both interrelated. Jadi the people side actually is more difficult to measure. I think for me, you quoted the Paribas punya study, which is very relevant. It's difficult to measure, difficult to define. But the bottom line to me is as follows. What are we really talking about when we talk about S? Especially in the context of ASEAN, number one is about labor rights. The issue of modern slavery, for example, is very topical. Whether it's Top Glove, whether it's plantation companies, and so on. The second is about worker and staff rights and worker and staff development, which may include or will include DEI, diversity, equality, and inclusion issues, whether gender, whether race, ethnicity, sexual orientation, etc. Of course, these are culturally bound issues, so we need to take that in mind. And thirdly, then, it's about society itself. We talk about poverty, human rights, addiction, etc. So I would like to end on my side to say that perhaps what is useful to me is the call to action, because to measure to this, you know, the taxonomy, the alphabet soup is a long story. So I would like to highlight four quick principles. Number one, before we do good, do no harm first. So we should look and see, for example, if there are bad labor practices, remove that, whether migrant labor or local labor or harassment and things like that, you know, or exploitation of delivery, you know, of workers. Secondly, do good begins at home. So think about workers' development. Just like charity needs to begin at home. What are we doing about our own staff, etc. Number three, this is the external situation. I think there are limits. If the question is about finance punya role in society, finance and business is important, but that it's not everything. You cannot solve everything. We can't and shouldn't be expected, even if we operate in a stakeholder economy. There are limits. What is that limit? That's a long question about the role of business, Milton Friedman, etc. But we know and we subscribe the ESG movement is something that society needs to deliver. And finally, I would say, At the end of the day, we go back and ask whether religious or ethical values. I would like to pose the question, one way to overcome greenwashing is to ask, how green is your love? Are we really serious that no matter how much standards and measurement and rating that we do, you and I know, at the end of the day, it's personal agency and institutional agency to see whether we are serious. We know, don't do harm and then do good. Thank you.
Yeah, thanks, Tan Sri. A very brief one. Building from the your comment on the religious value, my next question is, how does the process of incorporating religious value work in diverse, pluralistic society? What can be done to bring people together in this case? Yeah.
You're asking me. I don't have anything more to say already. Sorry, I dah summarize. To give time for me.
Okay.
Thank you.
So, okay, thank you, Tan Sri. So now we move to the Komi. Yeah. Is it often hard to quantify social issue? How have Moody's and other overcome these challenges? Over to you, Komi.
Thank you for that question. So yes, definitely, as we earlier find out, as well as I spoke to you, that quantifying S is difficult and a big challenge. I would like to look at it from two different buckets. One from the disclosure and social taxonomy, empowering investors to better assess social risk to avoid the social washing. And earlier, Tan Sri Azman mentioned repeatedly again, DNSH, right? Do no significant harm. So those kind of taxonomies should include all of those, and it will be critical to categorize such activities, whichever is socially harmful. Just totally remove that first, right? That's the high priority and almost mandatory to do that. The second way, from the taxonomy disclosure perspective, the way to quantify and empower investors will be to look at corporate sustainability reporting directives to include social issues. We also recently saw that Climate Disclosure Standards Board merged with the ISSB to fill the gap in social disclosures. So this is one bucket, disclosures and social taxonomy. Another one is from the investor practices itself. What should investors do? Disclosure and reporting, performances of social topics. So for example, positive or negative screening, engagement in voting, including labor issues, diversity, inclusion, such kind of data criteria, health and safety issues. Then again, for customer related issues, product safety, fair marketing. And one more other step I would like to take from the investor perspective is that social and sustainability bonds and sustainability linked bonds today are really important to achieve the social targets that are set. And for this, leading standards like ICMA, principles of social principles and sustainability principles are guidelines to follow for investors. That's one of the key criteria that I would say that is useful to look at to avoid this social washing. And other things that Moody's has done, for example, we have services like Moody's ESG scores that takes into account all aspects of ESG. Social is one of them. In our categories, we are using actually international standards, reference text, UN, OECD, ILO, for example. And we're looking at this from 40 different sectors, the specific, and we look at 30 distinct ESG criteria. Out of that 38 criteria that we look at, half of them are actually social considerations and social focus. So this really helps companies to become socially focused and using socially focused metrics. And they are able to benchmark themselves against their peers using this kind of ESG metrics. One of our approaches, which is really recognized by the market and our clients, is our double materiality lens that we use. So we're not only looking at the ESG issues that affect the company's enterprise value or financial returns or cost of capital, we're also looking at how it affects the society and environment and how the company really operates, right? Doing good. And lastly, one of the other services that we offer is sustainability ratings. In this case, we are looking at the impact and value creations. So this essentially will help the company to look at the resultant risk and opportunities. The main areas here are the impact analysis to create long-term value and proper behavior, generate value in terms of a sustainable way. Again, also readdressing Tan Sri Asman's is a way of living, right? The creation and distribution of value among shareholders and collaborations, but never forgetting the society and the overall value that it brings from social aspects. The society needs to go along with the sustainable journey.
Yeah. So to add further on your explanation, right? My question to you is: the data challenge more pressing in Asia than it is for European and North American institutions?
Yeah, data challenge is actually a common challenge for all regions, but the key differentiator here is in Europe, in particularly European Union, they already have put in place aggressive legislative roadmap that drive better and more standardized as disclosures. And also in talks and in under development right now is the social taxonomy, one regulation that is going to be very useful as well. So there are also other regulations that are coming up, supply chain due diligence for large companies covering social issues.
Yeah, all right. Thanks for me on that. So I think we don't have much time on this. So I will asking a final question to each of the speaker, whereby you have, I give about 1 or 2 minutes. I give the priority to Tan Sri Asman first to answer this question. Considering all the important issues facing the world, climate, conflict, corruption, where will the S in ESG rank in importance for finance over the coming years? And where should it rank? Tan Sri.
Yeah, I think very briefly, I think of course it ranks very importantly, but I just want to bring back the S in ESG, but also the S in ASEAN to try and link it together, Doctor. Jadi, basically, I think ASEAN, to relate back to that mega trends, let's not forget we are a relatively bright spot in a quite a quickly darkening world. But bersyarat, there are conditions to that. One of it is to make sure that we overcome the issues around E, S, and G, right? The E part is obviously a lot of focus on climate, but sometimes we forget about nature and biodiversity, which actually ASEAN in particular is particularly blessed with. The S, as I mentioned, do no harm first, especially look at labor practices. There's a lot of migrant labor in Malaysia and many countries. I think we need to do better there, because the chickens have come home to roost, whether in actual, you can actually measure this in terms of market cap drop, etc. Thirdly, is really the do good part. As I said, workers' rights. I think the role of business, culturally, we are attuned to live and work and create value while protecting and upholding values, as you know. So it's a stakeholder economy. And finally, I think no amount of standards and taxonomies can do the job, or measurement for that matter. They are necessary, but it's not sufficient. What is really sufficient is the bit about the human governance, that we have to be serious. And I think we can. Thank you.
Okay, thanks, Tan Sri. So, Mr. Shahril, 1 or 2 minutes.
Yeah, thank you. So my final point, we're talking about the S in ESG, or even when we talk about sustainability, considering all the important issues in the world. I think that it's ultimately about people, right? And this is taking further what Tan Sri Asman said. It's ultimately about people. It is the overarching component, the intersection of all the elements. And at the end of the day, if we as a nation, if we as a people get the S right in ESG, all the other important issues facing the world today, be it climate, conflict, even to a certain extent, whatever abuses would be addressed. So, I think it's about that. It's about that. It's when we talk about addressing all the other issues, It's about saves us as a humanity, and it's about the people.
Okay, thanks, Mr. Shahril. So for me, last word.
Yeah, thank you. Our hope from Moody's perspective and my personal hope is that from financial markets mature, they begin to understand the deep interconnectivity between all the three factors and work towards more systematic approach to tackling both the ESG and other kinds of risks as well. So for example, if ASEAN, look at the focus is on energy transition, it's always been, and for that, the challenges from the environmental perspective. But we cannot forget and miss out that the huge social challenges are linked to the transition as well. For example, what happens to the workers that are going to either lose their job or have to be reskilled? So it's overall a deep interconnectivity, and also everybody has got to take a stakeholder approach in this aspect. Thank you.
I think just to summarize, I think in terms of the sustainable finance, provide a better return, right? As well of helping the planet and making society fairer and more inclusive. Evidence is mounting that sustainable business actually offer higher return for investors. I think based on the Global Commission of Economy and Climate, the transition of the low carbon sustainable economy could lead the economic boost of US dollar about 26 trillion by 2030, which is good, which are creating more than 65 million jobs. Sustainable finance has been an area of this particular growth. And with that, I would like to thanks again to our panel, Tan Sri Azman, Mr. Shahril Jamin, and also Kwame Rajan for your sharing knowledge on the topic, the emergence on the S in SG. Thank you very much. I pass and hand over back to you, Shireen. Thank you.
Thank you, Datuk Sri Dr. Zabidi and the esteemed panel. It is clear that there are risks and opportunities associated with the social aspect of sustainable investing. There will be a social consequence with every business decision made, and the role of finance in facilitating the convergence of business and social interests is key. And I particularly liked the statement about before we do good, do no harm first. Still on the topic of ESG, we now bring the focus to the issue of ESG data and the challenges faced in harnessing its potential to enhance the role of green finance in the region. In our efforts to create a more sustainable and equitable world, it is crucial to have quality, consistent, and transparent data, especially in the area of ESG investing, to enable the implementation of sound investments that align with the industry's ESG aspirations. Our moderator for this session is none other than Ian Cochrane, Program Director of the Masters in Climate Change Finance and Investment from the University of Edinburgh and Senior Advisor at the Institute of Climate Economics, contributing to the coordination of the public interest think tank work on investment, governance, and climate-related decision-making. Ian has worked in the area of climate and environmental policy for close to a decade, focusing his expertise on the mainstream of climate change-related issues into decision-making and institutional governance. He currently supports the team's work on a broad range of investment-related issues, including the role of public financial institutions in the low-carbon transition, the environmental integrity of financial products, climate risk perception by financial actors, international and national climate-related financial flows, and the alignment of development finance and long-term climate change objectives. With that, over to you, Ian.
Thank you you so much, Shireen, and good day to everybody that's joining us for this fireside discussion. Very much looking forward to it, as we're going to be looking at a very important topic around the issue of ESG, which of course is the data challenge. My name is Ian Cochrane, and I am a lecturer at the University of Edinburgh Business School, a member of the Centre for Business, Climate Change and Sustainability, as well as the program director of our MSc on Climate Change, Finance and Investment. And today I will be moderating this fireside discussion that will really be diving into this question of ESG data and treating these issues, particularly in the ASEAN region, of availability, accuracy, and how do we begin to access and use the data we need on both the E, the S, and the G. And so over the next 30 minutes, we'll be hearing from three panelists that are joining us for this chat today, where we'll be hearing first a set of remarks around a question that I have prepared for each one of them, and then we'll be following that up with a open discussion within the panelists, closing again in about 30 minutes time. So before I ask this first round of questions, I just want to introduce our panelists very briefly. Firstly, we're joined by Najmuddin Mohd Lutfi, who is the Chief Executive Officer and Executive Director of BIMB Investment Management Berhad. We're also joined today by Zakia Mad Esa, the Head of Sustainability and Strategic Management of SME Bank Malaysia. And finally, also joined by Dr. Alexis Moyer, who is the Head of ESG and Spatial Finance at the Edinburgh-based Space Intelligence. So I'm going to start with you, Najmuddin. And as a leading investment management company, what role does ESG data play at BIMB Investment to help deliver risk-adjusted returns for investors?
Thank you, Ian, for the introduction. We started the ESG journey back in 2015. And so it's been 7 years for us. And we have integrated ESG into our investment process when we construct our Sharia investment portfolios. And this is possible also because of our strategic partnership with Arabest. And I think the ESG framework that Arabest has, the Arabest S-Ray, that provide a quantitative measurement of ESG scores and ratings for companies, actually have provided a much more, I guess, transparent and much more clarity on how we are able to integrate non-financial information, which is the ESG information, with the financial information. So it has been our investment approach for all our Sharia investment funds, Sharia investment portfolios since 2015. And from there on, we'll be able to deliver and offer varieties of Sharia ESG investment asset classes to the Malaysian investors. So ESG has been the integral investment process, for us since 2015.
Great, thank you so much, Najmuddin. I'd now like to turn to Zakia and learn a little bit more about the experience of SME Bank. So, again, as a leading development finance institution, how is SME Bank using ESG data to support government policy and drive economic growth through the financing of SMEs?
Good afternoon from Malaysia. Thank you, Mr. Ian, for the introduction and for the question. First of all, let me share a brief background of SME Bank Malaysia. SME Bank is one of the developmental financial institutions in Malaysia, fully owned by the Ministry of Finance and supervised by the Ministry of Entrepreneur Development and Cooperatives. Being a GEFI, our mandate is to provide financing and advisory services to SMEs involved in manufacturing, services, and construction sectors. Sustainability-wise, we have developed a 3-year sustainability roadmap last year based on 3 pillars: responsible banking, responsible business practices, and creating social impact. As compared to BIMP just now, as mentioned by Mr. Najmuddin, actually we just started our sustainability last year, and based on our 3-year roadmap, we have 3 phases. Being the first phase is ESG initiation and streamlining business focus, of which happened last year. The second phase, ESG implementation and streamlining non-business focus, i.e. non-financing, is this year, and next year will be ESG adoption and continuous improvements towards sustainability. Talking about ESG data, basically the bank has already started collecting the relevant ESG data in relation to financing activities upon establishment of our sustainability sukuk framework and our issuance of our maiden sustainability sukuk of 500 million last year. Under the framework, we are required to prepare and publish our sustainability sukuk report on our website annually and on a timely basis in case of material developments. In addition to the above, the ESG data that we collected will be reported to the Central Bank, Bank Negara Malaysia, under the performance measurement framework requirement. We also have regular engagement with our key stakeholders, i.e. our shareholder, the Ministry of Finance, as well as our supervising ministry, the Ministry of Entrepreneur Development and Cooperatives, where we share our ESG data and our ESG progress. We believe the ESG data that we provide shall be one of the relevant ingredients to the government in formulating and fine-tuning the relevant policies and guidelines that will contribute towards driving the economic growth of SMEs through the financing programs offered. I believe this shall answer the question of how does SME Bank use ESG data to support government policy and drive economic growth through the financing of SMEs. Thank you.
Great. Many thanks, Zeki, and very interesting to hear about this 3-phased approach that you are implementing at the bank, and of course this connection back with how that links with the government support policy around SMEs, and looking forward to learning a little bit more later in discussion. But before we get to that, I'd like now turn to Alexis and learn a little bit about the work from Space Intelligence, and of course from a data perspective, what are the opportunities and challenges relating to the provision of accurate, trusted, and consistent, 3 big asks often in the ESG data space today, information for ESG reporting in the ASEAN region, particularly around climate and nature?
Hi, Ian. Yes, great. Thanks for the good question and the introduction today. So focusing down really on that E of ESG, looking at data for climate, nature, and in addition, I'd like to add biodiversity to that. So in particular, things like looking at water quality, maybe species diversity, the condition of the habitat in a location, the carbon emissions, anything really having to do with the environment and nature is data that needs to be collected, as you say, transparent, reliable data. And this type of data is typically collected on site. So people go out into the field, they take field surveys, they have different equipment. They might be taking environmental DNA, which is relatively new, where you take soil samples or water samples and find trace elements from different species to look at biodiversity. This might be using camera traps to look at different species coming in and out of environment. As you can imagine, it's all quite labor intensive and restricted really to a small scale, a site level really, due to the complexity, the high costs, and the time consuming nature of collecting this sort of environmental data for ESG reporting. Particularly in this region, there are challenging conditions. It's a tropical area. Imagine being in the field all day collecting data. And in addition, it's quite difficult to do ongoing monitoring. So a lot of corporations and financial institutions need quarterly and annual data, up-to-date data for reporting, and doing ongoing in-field monitoring is quite costly and time ineffective. So this is really where the opportunity for satellite data, what Space Intelligence provides, comes into play. So satellite data can be used to scale up some of these measurements across larger areas, for example, entire regions of a country, and even country scale, because Earth observation sensors provide data at quite a large scale and with frequent revisit time. So the satellites are flying over, sometimes on a daily basis, a weekly basis, to provide that information with high frequency. And one of the challenges, again, because it's a tropical region, is that it's harder to acquire cloud-free imagery, especially during the rainy season. But luckily, the frequent passes of the satellite means you're able to get multiple clear images a year for analysis. In addition, there's different types of satellite imagery that can collect environmental data. For example, radar imagery, which uses an active sensor. So that means it emits radiation down towards the Earth, and then it's reflected back. So we can see through clouds to provide data during this data dry period in the rainy season, particularly relating to surface roughness, for example, and vegetation degradation. So again, information that could be used for that E of ESG reporting. So really the opportunity from satellite data is that it's able to provide transparent and unbiased insight on what's happening on the ground associated with various sector activities. So for example, looking at the impact of a mine, for example, or a palm oil plantation on the surrounding environment in terms of deforestation, forest degradation, other changes in the environment, such as flooding and water stress. For example, if a tailings mine burst, for example, a tailings pile, what the impact would that be on the environment, as well as carbon emissions and historical biodiversity loss. So really all of the big environmental stressors and implications of that E of ESG, there really is an opportunity for satellite data to provide an unbiased view of that information.
Great, thank you so much, Alexis. And I think here the key point here is how do you get this transparent and this, this data that we can trust and then use for investment. And again, the satellite solution being a way of, particularly on a lot of the environmental side of things, digging into really what's going on the ground and collecting that data. So thank you for that overview. I'll come back to you in a little bit later with a couple of questions to learn more. But I'd like now to turn back to Najmuddin. And I think we've heard from Alexis a little bit about the environmental, the E side of ESG on the measurable, but it'd be great perhaps to hear from you a little bit about the challenges we might be having today around the S and the G on the social and the governance side, and how do we begin to link these different pieces together for a holistic ESG management approach?
Yes, I think at the end of the day, I think what we're discussing is, how do we have the data, how do we collect the data, and how transparent this data and how we deposit this data. I think as a fund manager, I mean, we like something that's more transparent, that's more objective, that we can quantify, something that is real time, and we can make the assessment quite quickly. As you know, for investment, we need to be looking at the financial and also now with the non-financial. So I think for the S and G, I think the disclosure is very important. In our case, we're investing in companies, across industries. So it's very important that they are able to disclose on the the social aspect of their operations or their activities, as well on the governance. So given the so I just like to draw our experience with Arabesque, and because we think that Arabesque is quite advanced in terms of managing and facilitating on the on ESG data transparency, and also importantly having a non-biased data that's much more objective. And they have developed, initially it was an Arabesque S-ray, which like I mentioned earlier, you have all the companies inside Arabesque S-ray, and there are more than 400 ESG metrics indicators for the E, S, and G. It's all about disclosures from all these companies, and now they have rebrand Arabesque S-ray to ESG Book. Just like Facebook, it's much user friendly. Actually, it's free to all companies, any companies in the world, to actually go into ESG Book. The key thing here is for ESG Book is companies or institutions or even governments, they will be able to, they will be in the driving seat on managing their own ESG data. And it's a platform where you as an entity or organization, be able to disclose information of your companies that will cover the E, S, and the G, and you would know your status, where you stand when it comes to your S or G, and you can actually also apply any of the global standards. If you want to know where you stand in terms of GRI, where you stand on TCFD, where are you on track on your net zero commitment. So everything is in this ESG book. I think it's great. I mean, finally we have something that is easier for the issuers or for companies to disclose their information. It could be SMEs, it could be listed companies, it could be government, it could be institutions. And as for the investors, for us, like the asset managers, we'll be able to go to ESG book and look at the I guess the disclosure and also their scoring or their rating, and we can customize it, or we can apply specific standards, whether it's GRI or whether it's SSB and so forth. So we do not have to go to many places or to talk to many people to get the information. So I think this is I think to me, at the end of the day, when it comes to the S and the G, the disclosure is very important for the companies. But I think for Malaysia, when it comes to S and G, particularly in the S, I mean the regulators already provide framework that supporting the industries to encourage more social impact investing. For example, the Wakaf framework, where we'll be able to launch a Wakaf funds. It's like an endowment, where then we're able from the investment returns, then we'll be able to channel it directly to the poor, and we'll be able to see the real impact. I mean, those are more of the application when it comes to the the social impact. I guess at least from the financial industry or the capital market. But I think when it comes to disclosure, I think this what we have seen, the ESG book was just launched December last year. I think it will address a lot of this issue on transparency.
Great, thank you, Najmuddin. And I think again that the theme I'm hearing come out from all this is this importance of transparency, and probably of course that also meaning the quality of the data as well. I'd like now to turn to you, Zakia, and ask this question about what are some of these challenges for sustainability data and collecting that data from SMEs that you've encountered, and I guess here I'd really ask that question of how are you attempting to overcome some of the challenges we see as to ensuring that quality and making sure as you enter this into your decision-making process, that data is both transparent and trustworthy.
Thank you, Mr. Ian. Okay, basically collecting data from SMEs is very challenging. As I mentioned earlier, the bank, for SME bank, we have already started collecting the relevant ESG data when we have our when we establish our sustainability sukuk framework and we issue our sukuk. Case in point for SMEs, for SME bank per se, we having 99% of our customer base is MSME, micro, small and medium enterprise, whom they are mainly unserved and underserved. The asymmetrical data issue is unavoidable. Some of them are still struggling in capturing, recording and reporting the financial data. What more on ESG data, which sounds quite alien to most of them, especially in micro enterprise space. At present, MSMEs are mainly focused on the business survival, of which cash flow is the key, while other non-business matter, which is not for near-term benefits, is neglected. Collecting and reporting ESG data may not be in their priority list, or even may not be in the list at all. So it is quite challenging for us to capture the data from the SMEs. The data of which it must be reliable, and it must be something that we can use in order for us to report it as they are our customers. So again, some of key challenges that we face is actually there is no global baseline on sustainability related disclosures, and so when we collect the data, we have to disclose. In this case, the standard of disclosure estimated is about 600 ESG reporting standards globally. So one, we have to collect the data. The data must be sufficient, reliable, and again, when we want to disclose, it has to be aligned with the standards. And again, the other challenges that we face is the disconnection between ESG reporting and mainstream financial information. Again, if we were to look from the SME space, it's very challenging, and there is a lack of subject matter expert in the organization, be it in the bank or be it in the SMEs itself. And there is also lack of real-time information. So when we collect data, we have to ensure that again it's reliable, it's quantifiable, it's something that we can change the data into information and will be benefit to the stakeholders.
Thank you so much, Zaki. I think that definitely lays out that challenge, particularly in the SME space, where we are often, the companies don't necessarily have the ability to keep staff on, or experts on their staff to be able to respond to these requests and disclosure requirements, and really making sure. I think that's a great point on real time and quantifiable as well. And I think that's a great segue now to the question I wanted to ask Alexis. Perhaps if it is challenging to go company by company to ask for that disclosure, are we able to use some of the satellite-based approaches, these more, macro level data collection to overcome some of these challenges? And how do we begin to then link that back to the type of decisions in long-term investments investors might be making, where they will need these inputs? And I guess kind of that challenge of moving from a satellite big picture down to understanding at the granularity of an individual client or investment.
Yeah, great. Thanks, Ian. So as you say, satellite data can be used to provide some of this insight on some more of the challenging things to collect, data to collect from, example, SMEs on sustainability, particularly in regards, again, to the environmental component of that ESG. And in particular for looking at long-term sustainable investment decisions. So, for example, if you're trying to decide, or a financial institution is trying to decide between investing in two separate options, satellite data can be used to look at, for example, what the impact might be on the supply chain. So if you're looking to invest in a large corporation that has a large supply chain, for example, an agricultural corporation that has a lot of different plantations, a lot of different cropland areas globally or in the region, satellite data can be used to look at the environmental impact specifically of those supply chain elements to help you make a more nature positive investment decision. So that could be information in terms of potential carbon emissions from those facilities, from those plantations. That could be, again, looking at things like water stress in the region, as well as deforestation, again, and forest degradation. So what did the landscape look like before, for example, that those crops were planted? What did the landscape look like before the plantation was established? And that information is important in terms of making a sustainable long-term investment decision, because a lot of shareholders, a lot of different stakeholders want to be seeing sustainable investments and decisions going forward. They're really keyed up and turned on to looking at what they want to put their money into these days, and they want to make sure that they're investing in something that is not nature negative. And that's something that satellite data can help with, as long as we have the location information. So one of the key challenges is, for example, supply chain tracing. And you hear that a lot in terms of ESG, in terms of sustainability, is actually tracing a product from start to finish through the supply chain. And that's where one of the main challenges is, because we often don't have that specific location information. A lot of financial institutions and large corporations don't know exactly where their plantations are, for example. So that's kind of one of the key missing links. And that information needs to be provided so we can use the satellites to show specifically on a plot level what is happening. And that information is very hard to come by. But as you say, the great benefit of using satellite data is that independent view. an ability to assess investment decisions, both on large scale, looking at an entire country, for example, or on a small scale as well. Because the resolution options of satellite data, you can look at things, as I say, across the country, or you can look at things down to centimeter level accuracy. So it is really quite a widespread capability here for satellite data.
Great. Thank you so much, Alexis. And I think that's raising that those, definitely pointing to where satellite data can be useful, but of course, understanding that, we also will, it can't be a replacement for other sources of data, particularly that you are needing these locational supply chain tracing information to be able to make those connections between the two. And I think another interesting point you mentioned is, again, thinking about the potential emissions and how satellite data not only helps you track what's happened perhaps in the past, but can give you a little bit of a forward-looking approach. We're now in about the last 4 or 5 minutes of our chat for today. And how I would like to propose that we close things is maybe I'll just go around to each panelist and ask you in about a minute to talk about one of the challenges that we identified kind of in the run-up to today's discussion. So perhaps actually not a challenge, but maybe one of these new forward-looking topics. So with Najmuddin, I wanted to ask you perhaps just briefly to say a few words about how you see today this link between AI-driven research and analyst-driven research in the ASEAN region. And yeah, perhaps if you have any other closing remarks as well, please don't hesitate to add them in.
Yeah, I think, two things. One, on the AI versus analyst, obviously, if you look at least in the investment fraternity, there's a lot of data, there's a lot of market events, meaning that it's a lot of data that need to be processed, need to be digest, and that we need to conclude. So huge data. So I think it's very challenging for for individuals to be able to try to, to make an attempt to try to process all this data. So artificial intelligence, machine learning, big data technology, certainly will be very helpful in the investment decision-making process. Secondly, just sort of my last point, I think when it comes to these challenges on the ESG, I think it's getting much easier now because there is an integration with technology. For example, ESG book, for example, and then it's an example how it'll be able to facilitate any companies, whether you're big or small, to be able to start the journey. So the very least is, you know where you stand. You can start, of course, there are so many questions, depending on the standards and the frameworks, but at least you can go to a very friendly sort of dashboard, to start the journey instead of trying to invest, a lot of money with consultants, for example. Because in the ESG, for example, it has all the main standards or the main framework, and in fact, you'll be able to customize your own standards and frameworks into the ESG book. So, if anything, I think there's not much awareness about how an institution be able to disclose that information, because for them, they understand the ESG concept is very important. There's a lot of communication about it, but I think for them to start, I think this is where there need to be a lot more engagement, because there are tools out there like ESG to be able to make it easier for them to disclose information. And I don't think they should worry about it. And I think for the SMEs, for example, eventually, at least for Malaysia, by next year, the financial institutions need to be able to assess climate-related risk. Yeah. So if you don't have that information, how are you going to get financing? How are you going to get funding? How are you going to get investors? So the SMEs has really no choice. For you to grow and to expand your business, you have to have not just your financial information, but also your non-financial information. So, so they have to start the journey, and I think tools like ESG will be able to assist them, because yes, it's like a black box, but with tools like ESG, it's no longer a black box. I mean, and to be able to make it easier for many to, to start the journey. But importantly is to take that first step and don't delay. That's all I'm saying. Because at the end of the day, if you are a business, moving forward, you will be judged not just on your financial, which is historical, but it's also on your non-financial information.
Great, thanks so much, Najmuddin. I think that's a very good message, perhaps for some of our listeners to come away with, is that this is, again, something that's moving much more towards, a regulatory requirement in some areas, and that it is something that we need to find functional and effective solutions to make it accessible, particularly to SMEs and other types of clients and corporate actors. Zakia, now over to you. Perhaps the forward-looking topic that I'd ask you to say a few words on before we close is, how is this actually a way to incentivize sustainability? Not just about reporting, but really helping to ensure that this is a tool to help us achieve, the sustainable development objectives, national goals and plans around climate or biodiversity, as well as, of course, ensuring that we are supporting a just and sustainable transition.
Thank you, Ian. Okay, basically in SME Bank, even though we consider ourselves still at nascent stage, i.e. ESG, we have just formally started last year, but throughout the journey, we already issued our sustainability suku, the first sustainability suku issued by GEFI in Malaysia, and we won a few prestigious awards of it. And out of it, we have to innovate, we have to develop product or program that would incentivize the SMEs, because to the SMEs, the bottom line is very important to them. So if we want to get them to join the ESG journey, we have to incentivize them. So we are glad to share that in SME Bank, we have developed and launched 2 financing programs for MSMEs, where the incentive is for those customers that comply to ESG throughout the financing tenure, we are giving them profit rebate. So the intended objective here is the customer, they have to track their ESG journey, they have to ensure that they are on track, and they have to report to us in order for them to enjoy the rebate. The main intended objective here is not only to reward them with the rebate, but more importantly, to inculcate ESG awareness and discipline them throughout the ESG journey. So when we train them, when they are disciplined in capturing the ESG data, they provide to us. That data is useful for us to devise our strategic, and onwards, we will share that data with the ministry as well. So basically, this should not be the last one. We really have to innovate. We really have to find the best way to incentivize the SMEs so that it will be more interesting for them to join the sustainability journey, because they cannot be left behind, even though, let's say, they are not an exporter and they don't require that ESG that much, but from the supply chain, whereby if they are supplying to the, let's say, the big organization, the GLCs, they have to be ESG compliant so that they will be able to remain in that supply chain. So, like it or not, they have to start now, and it's not for them to walk, they have to run. That's all.
Great, thank you so much, Zakia. And I think that idea of running definitely does, of course, reflect as well the need for us collectively to move forward on the sustainability challenge, and of course finding those incentives that really help move everyone forward, SMEs included, is an important factor to take into account beyond the issues of data quality as we've discussed today. So now, Alexis, over to you for a few final words, and perhaps I would ask you to say a few more words on an issue that you raised about, again, this forward-looking aspect. And I know it goes perhaps a bit beyond the challenge of challenges around satellite data. But again, within the sustainability space, we are looking now about not just past, but future performance. And maybe if you might be able to say a few words about how you see that in the ESG space, and particularly again, how we can start to link that to some of the instruments or the type of analysis we need to conduct on these different issues.
Yeah, sure. Thanks for that. So looking at the difference between backwards looking data, as you say, and forwards looking data. So backwards looking data being what we would typically provide: baseline information, carbon stock information, things like that, looking at the environmental impact in the past. That's the backward looking data. Looking towards the future, as I already briefly mentioned, space data can be used to help provide insight on investment decisions. So looking at what impact might occur in the future if you convert a plot of land to a plantation, if you convert that to an agroforestry project, for example. And that sort of information can be used to link towards, for example, sustainability linked finance assets like green bonds, where you're investing or taking out a bond in a forest project, for example. So using that forward-looking information to decide where best to create that project, what that might look like in the future. And the last point I wanted to make about ESG data in general is that I think we need to, once the reporting has started, and I know a lot of organizations and corporations are just in taking their first steps in the ESG world. But once that information has been collected and reported, we need to really move beyond that and say, okay, so we have this ESG data. We're not just ticking a box to say this is what our performance is in these categories. We want to know how to improve that. So we need to provide insight, for example, on how to improve biodiversity, how to improve our environmental impact. So for example, if we have done an assessment that shows an area has been deforested and there used to be a really rare plant there, we can use that insight, use that data to go forward and say, okay, let's plant this native vegetation back here where it was and really improve going forward. So it's not just an exercise, it's really, why are we doing this? Why is this data being required to be collected? Because of the dual climate change and biodiversity crises, and how do we move forward as corporations, as individuals, and really taking that forward to improve our well-being just for the environment as well as for local communities.
Great, thank you, Alexis. I think that issue of being able to move from disclosure to action and really link this analysis we're corporate actors or different companies are doing to the steps taken either to make themselves more sustainable or have an impact, and contribution to resolving the sustainability challenges we're all faced with, is a really important part and a great point to finish on for today's fireside discussion. We've run a few minutes over, so I'll be very short in the summary, but first, virtual round of applause to our three panelists today. Thank you so much, Najmuddin, Zakai, and Alexis for joining us. And I think as takeaways, I don't think I can summarize a lot of everything we've said, but I think, a few key words have come out for me that speak to the challenge of ESG data in the ASEAN region. And I think really link up to the challenges we're facing globally on this topic, which is really getting that transparency that we need to have, that trust in the data that's both backward and forward looking, thinking about how we build this capacity both internally as financial institutions, but also within clients to collect, to develop the systems needed to report on these type of issues. And then of course, thinking about those incentives and the linking up of this data with the actual operational challenges that really allow us to contribute and overcome the sustainability challenge. And again, in this critical decade for climate, biodiversity, and of course, a socially and economically just transition, really making sure this is not just another reporting requirement, but a real tool to help us collectively solve these challenges. So again, many thanks to my three panelists for their time today. And now I will hand things back over to you, Shireen, as we move forward with today's agenda.
Thank you, Ian, and to the panel speakers. That was indeed another great session. As the saying goes, you can only manage what you can measure. And I think we can all agree that data has a huge role to play in the move towards greater sustainability. It was encouraging to hear some of the great work being done by SME Bank, Space Intelligence, and BIMB in this space. The next session is indeed going to be a very exciting conversation between business and finance. And for this, we have brought together Rafi Hanif, Chief Executive Officer, Group Transaction Banking and Group Chief Sustainability Officer of CIMB Bank Berhad, and Rashid Reza Anwaruddin, Chief Sustainability Officer of Sime Darby Corporation, leading one of the biggest banks and one of the biggest plantation companies in the region, respectively. Rafi and Rashid will be sharing their insights on how large corporations have been able to finance the protection of nature. I would now like to welcome Rafi Hanif to begin the session. Over to you, Rafi.
Thank you, Shireen. Rashid, you have been helming the sustainability practice at Sime Darby. Can you share with us some of the good work that Sime Darby has done to ensure that its palm oil operations are sustainable?
Thanks, Rafi, for the question, and thanks for inviting us to share some of our experiences and our approach to responsible agriculture. So just to give a bit of background on Sime Darby Plantation, right? We are the largest producer of sustainable palm oil globally. And with regards to our practices, right, we are in the agriculture sector. And when it comes to sustainability, you know, it's not a new thing for people operating in the agriculture sector. It's just previously it was called, you know, good environmental practices and good social practices. And it's evolved over the years into what people tend to coin as sustainability or ESG practices and so on and so forth. But for us, right, essentially the foundation of our operations is basically the certification and adoption of sustainability related standards. So in the palm oil sort of industry, there are a few sustainability standards which are adopted. And one of the key ones that we adopt is basically the Roundtable on Sustainable Palm Oil, the RSPO, where 100% of our global operations, which spans across Malaysia, Indonesia, Papua New Guinea, Solomon Islands, 100% of it is certified to the RSPO, and also other sort of certification standards like the national standards in Malaysia, the Malaysian Sustainable Palm Oil Standard. So that is essentially the base of our operations. But the approach that we take essentially, is that we try and go above and beyond certification, and that's where our whole sustainability program looks into three key areas. Number one, we try to contribute to a better society. So this is by implementing fair labor practices, enhancing our safety and health systems, and also working with communities surrounding our operations as well. The second one is basically, how we look to how we can have a positive impact on the environment. So that is essentially, looking at how we can contribute to climate action, how we can further enhance and implement our efforts around conservation and biodiversity, and also, looking into how we can adopt a circular approach when it comes to our operations as well. And the third sort of key thrust that we have around sustainability is our approach for delivering sustainable development. And what that means is basically going beyond our boundaries. So in looking at how we can get our supply chain, smallholders and suppliers to also adopt similar practices that we have, and also how we also work and participate in multi-stakeholder platforms and all these standard developments to further improve the standards that are already out there. So that's the typical, the basic, the approach that we take when it comes to sustainability, and it's all articulated in various charters and policies and practices, which are then translated to the ground. So I guess that's a brief introduction on our approach to sustainability. And Rafi, on your side, right? I mean, you've been involved in responsible banking and sustainable banking for quite a number of years. What have you seen that has changed in this past few years?
Thank you, Rashid. We have come a long way
if you look at CIMB's journey into sustainability, it all started with what we call value-based intermediation as part of the strategic pivot for Islamic banking back in 2016 and 17. And from there, we evolved into what we call the sustainability ambition for CIMB Group. We are a regional bank with footprints in ASEAN and headquartered in Malaysia. And it was an important strategic initiative for the group to drive this sustainability agenda across the group businesses. So as any new initiative, it goes through 4 stages in its life cycle. So the first stage was the forming or formative stage, which was quite, challenging, but it was a lot simpler than the next 3 stages, where we need to craft the strategy, the ambition for our sustainability targets, and get the buy-in from the senior management and build the team, create the policies, and so on. The next stage was what we call the storming stage. Once we have formed, there were lots of issues around what we mean by negative impact. Because if you look at the sustainability agenda, it revolves around identifying the impacts, both negative and positive, and have a clear plan to reduce negative impact and in tandem grow the positive impact across our business lines. So one of the areas we looked at is how do we define high risk or high negative impact businesses? So we then came up with high risk classification, where we looked at our portfolio of financing and then looked at the both direct and indirect impact, whether it's scope 1, scope 2, and scope 3. And then we narrowed down to a few high risk sectors. So the likes of coal, palm oil, mining, and so on. So there were a few sectors we categorized as high risk, and those high risk sectors would be where we would be focusing on reducing the negative impact. At the same time, there was a lot of discussion, storming issues around what are the positive impacts that we should focus on. So positive impact would be around promoting more green financing along renewables, low carbon intensive industries, regenerative agriculture, EVs, hybrid cars, and so on. So it took a while for us, although we have the clear strategy for sustainability, but it took us some time to really nail down the details. Now we are at a stage where we have normalized. We know what we mean by negative impact, which we call the footprints that we have created through our financing portfolio. And we have a clear plan in terms of how we're going to address and reduce the negative impact. And also we have a target in terms of building the positive impact. So we have a target to mobilize about 30 billion ringgit of our financing and our mobilization in terms of facilitating financing by 2024. That's a 30 billion target in terms of sustainable finance mobilization. And at the same time, we want to make sure that we have a net zero operational emission target, which is our own scope 1 and 2 by 2030, and net zero operational and finance emissions, which include scope 1, 2, and 3 by 2050. Now, at a macro level, we are also seeing the regulator playing a more active role. They have come out back in May 2021. They have issued a climate change and principle-based taxonomy, looking at principally physical risk, transition risk, and liability risk that the financial industry is facing from the climate change, and giving us 5 guiding principles in terms of how to categorize our various financing that we have given, in terms of whether it's climate supporting or transitioning, whether they should be watch listed, so that we can then take the necessary steps to address those issues and have a clear timeline in terms of how we will reach towards our net zero target by 2050. 2030 is operational emission, and 2050 is both operational and finance emissions. So looking back, we have come a long way, but looking forward, we see the journey is even longer and arduous. So it is definitely a challenging time to be. And Rashid, in terms of what Sime Darby has achieved, what could the finance industry improve on to help you to further meet your targets? Have there been times when pressure for quarterly earnings have made your transition towards sustainability look more difficult and complex?
Thanks, Rafi, for that question. I think like what you mentioned previously just now, right? What we've seen is there has been a significant increase in interest from the finance industry around ESG and how companies that they are financing are operating around this, right? And what we would like to see more is an increase in the sort of engagements and dialogues with the corporates with regards to whenever you sort of try and come up with the policies and the sort of decisions that you make, because with regards to engagements with the particular corporates, right? I mean, each and every industry would have their different sort of challenges, the different sort of nuances, which you can only get to know better if you have increased discussions and dialogue. Like what you mentioned just now, once you have identified the sort of high risk sort of industries, then a deep dive into those particular industries would be very, very useful, because then number one, you'd be able to then further understand what the challenges are that the corporates actually face. And also on the corporates as well, we can then further understand the expectations from the financial industry on how they expect corporates to sort of practice, right? So I guess that's one area, increase engagement and dialogue. Secondly is once you have identified the sort of key high risk areas that you want to understand and deep dive further, there needs to be also further involvement from the finance industries with all the multi-stakeholder platforms which are already available within those particular industries. So, for example, in the palm oil sector, we have the Roundtable on Sustainable Palm Oil, where where this is a platform where multi-stakeholders come together to chart the course on how sustainable palm oil should be produced. And this is something that on our side, we were founding member of the RSPO way back in 2004, and we have been constantly engaging throughout the process to work together with customers, with civil society organizations, to basically further refine and improve the standards. Number one, to improve the standards, and number two, to try and get more and more sort of stakeholders involved in the process as well. Because once you actually get involved in these platforms, you would then be able to really understand the challenges that are being faced by the industry, and also be involved in developing solutions on how practices can be improved on the ground, and also have a better understanding on how the finance industry could also participate in the development and implementation of these sort of solutions. And I guess the third area that I like to sort of also highlight is basically again with regards to the engagement of the of corporates from the finance industry as well. What we've seen is that that we've seen finance industry, players in the finance industry moving from a tick box approach to a more engagement with the industry approach, right? And this is quite key as well, and quite important as well, because for example, on our side with regards to our suppliers, whenever we have issues within our supply chain, we always try to engage with the suppliers as much as possible to try and influence them and work with them to improve their practices on the ground. Because we also understand that once we disengage with any particular supplier, although we are no longer associated with that particular supplier, but there's actually no change on the ground happening. So the key point here is that we want to effect change on the ground, and that cannot happen once we disengage with a particular supplier. And I guess that's something which the finance industry should also take note as well, because by disengaging with corporates, nothing changes on the ground, and at the end of the day, what everybody wants is basically to effect change on the ground. So I guess those are some of the key things that I probably wanted to highlight with regards to that. But when it comes to the finance industry, Rafi, I mean, like what you mentioned, right? most of the impacts associated with your business come from the companies that you finance, right? So like what you mentioned, your scope 1 and scope 2, that's your current focus, but your scope 3 is basically where the significant amount of impact is, right? So from your point of view, from the finance industry point of view, what sort of changes would you like to see from the corporates?
Excellent, Rashid. I think I'm really delighted to see the kind of initiatives that Sime Darby is going through in terms of making it easier for us from the financial side to really measure and understand the risks that you are exposed to. From, as you rightly pointed out, the scope 3 emissions, or what we call the finance emission, according to CDP, for the financial sector is 700 times greater than our own operational emissions. So our scope 1 and 2 is quite minuscule. And if you look at the challenges that we're facing in terms of measuring the finance emissions, a lot of companies don't have enough data. And even if they have, they may not be able to disclose, or they're not willing to disclose their scope 3 emissions. So if you look at most companies, for example, company A, let's take company A, they have, say, 100,000 CO2e emissions. Typically, they will show more coming from their scope 1 and 2, but not able to show their scope 3. Because if you look at many sectors, it varies. What is the ratio between scope 1 and 2 versus scope 3? Some companies, that Nestle has disclosed that their scope 1 and 2 emission is only 5%. 95% is coming from the supply chain, from the agricultural side all the way to midstream to downstream and so on. So for us to meet our net zero financial emission target by 2050, we need to have a better understanding of the scope 3 emission that's coming. Basically, we need to have better disclosure. And this is where I think corporates can help us in terms of coming up with better disclosure. As you highly pointed out, that will require you to understand your own supply chain. What are the emissions involved in every step of the supply chain? And that would be crucial for you to disclose the data, which we can then pick up and then complete our journey by saying our indirect exposure through the financing of, for example, primary agriculture sector is X amount of CO2 equivalent. Then we can have our what we call science-based target initiative. For example, SBTI has clearly has given certain what we call methodologies for us to measure and also to reduce over time. So this is where we think corporates can play a bigger role in terms of disclosing the scope 3 emissions. Another way to look at it is, if we are not able to get the data for individual companies, then we have to look at it on a portfolio basis. So there are reports available for primary agriculture, for power generation, oil and gas. At a portfolio level, what is a typical scope 3 emissions, for example? We can then translate that into our own portfolio exposure, and we can then identify if we have given, say, 50 million financing to this particular company, and this company has 50 million in equity and 50 million in debt, the total exposure for us would be whatever the GHG emission that is coming from that particular company based on a portfolio basis. We then take 50% of it because we have financed 50% of their funding. So this is one way for us to measure. And from there, we then create a timeline where we have to progressively reduce that exposure and in tandem build more capacity on renewables and other positive impact sectors so that we can transit from this medium to high carbon intensive sectors to lower carbon intensive sectors. So this is where I think corporates can really help us to better identify the scope 3, and we can then have a clear plan. And Rashid, if you look at in the finance industry, most of the impacts associated with your businesses come from companies that you finance. Sorry, from the organizational perspective, how has the organization been able to deal with challenges regarding sustainability or ethical concerns? did it impact upon ESG ratings? I'm sure you have certain ratings that you would like to track. And how did you deal with that, if there had been any impact to the ratings that you have been targeting?
Yeah, thanks for that question, Rafi. And just to also echo your point with regards to, when it comes to scope 3, that essentially is the big challenge which a lot of companies face. It is basically, although your focus and priority, at the immediate term is basically looking at your scope 1 and scope 2, but eventually further down the line, you definitely would then need to start looking at your scope 3 emissions and other sort of scope 3 impact as well, because then you'll be able to sort of have a holistic approach to the way that you do sustainability, right? So with regards to your question itself, right? When it comes to the sort of ESG or sustainability related concerns and ethical concerns, those sort of things, right? Sustainability and itself is evolving. So things which we practice 5 years ago, there has been developments where there are new standards, new expectations, and new sort of regulations which come into play. And these sort of things, on our side, we definitely don't pretend that we have all the answers to it, right? So that's why the way that we approach it again, is again, number one, first trying to really understand what these concerns are. And this is how we actually take a very comprehensive approach to engaging with our stakeholders. Again, the same sort of word, right? Engagement, where we engage with a wide range of stakeholders, our customers, civil society organizations, even the financial sector as well, to try and understand what exactly the concerns are and what the basic, what exactly the issues are that we need to sort of rectify. And once we sort of really have a good grasp on what the concern and issue is, and then we basically get to work to basically resolve these issues. And the approach that we take is, we always take a collaborative approach where we work with multiple stakeholders like customers, civil society organizations, to basically work together with them to co-create solutions for this for these issues, because we understand that we can't do everything by ourselves, and we need partners to sort of work together with us to solve some of the key challenges. So things like where monitoring of our supply chain, for example, we actually work with third-party partners to utilize satellite monitoring technology to monitor deforestation within our supply chain. Or we work with for example, some of our customers, Nestle, and a third-party solutions provider to sort of develop grievance mechanisms which are available to our workers in Malaysia, which are available in the different languages. So by working with multiple stakeholders and multiple partners, we feel that we can have a more comprehensive solution to sort of respond to the concerns and challenges that we have. And one thing that we also do is, once we have started implementing changes on the ground, we also go back to our stakeholders to engage with them, to basically, number one, try to get our stakeholders to really understand the sort of work that we're trying to do on the ground, what challenges that we face, and the sort of progress that we are making in rectifying or resolving some of these challenges. And what we've seen is we're getting a positive response from our stakeholders around the sort of disclosures that we do, and also the sort of engagements that we do with our stakeholders. And we spend quite a lot of time as well with the finance sector as well, our investors, our shareholders, our banks, to try and explain these are the sort of initiatives and the sort of challenges that we face. So I guess when it comes to the finance sector, right, Rafi, on your side, on your side, if your side would have some concern about a client that you have, how would you approach that, right? Would you look into ratings, or what's the decision? How do you go about making a decision whether to stop or not doing business with that particular customer? And what's the approach that you take around there?
Sure, that's a great question, Rashid. If you look at the process that we are following now, as I highlighted to you, one of the first challenges with it is in terms of identifying the high-risk sectors. So I mentioned 3 earlier. So the total high-risk sectors we are currently focusing on is palm, forestry, oil and gas, mining, construction, and power. And these sectors, we don't have much exposure, thankfully. Given the size of our portfolio, the exposure to palm oil is around or less than 3%, and power and particularly coal is less than 1%. So when we look at these high-risk sectors, whenever there is a request for new financing, we typically would do what we call an enhanced sustainability due diligence to better understand the risks involved. So in 2021 alone, we had done about more than 400 ESDDs in related to various financing across our network. And typically, we recommend if there are certain concerns, as you pointed out, what would we do if there are certain risks that we want to clearly identify and mitigate. We will work with the company, we'll identify the action plans, particularly the ENS, Environment and Social Action Plans. And if you look at the ESDD that we have done last year, around 13% had action plans, that our financing is subject to these action plans being completed. And we have seen, based on our empirical data, about 90% of the clients actually complete those action plans to our satisfaction. So the ESDD helps us to identify and come up with a plan. They're all time bound, and this must be met in order for us to continue with the financing request. Since most of them are complying with the action plans in line with our high-risk sector guides, we are confident that this ESDD process is working. And in relation to what happens if they're not able to meet, given that these action plans are time-bound, we will either work with them to identify the remedial steps, or clearly we may have to decide not to continue with the financing. So these are the options available to us. And as I pointed out earlier, we have gone through the 3 stages: forming, then we have the storming period where we had to identify all the various conflicting ideas and interests. And we are now at the norming stage where we have a plan, we have a governance, we have this due diligence process that seems to be working, but we are now reaching a stage where we have to perform. The performing stage is the most difficult stage. We have clear targets, 30 billion in terms of fund or financing mobilization, and net zero operational target by 2030, and net zero, what we call operational and finance emission by 2050. We now have to really perform in terms of measuring the scope 3 and taking some hard decisions on certain high-risk sectors. A classic example is coal. We were one of the first banks in ASEAN to exit coal sector. No more new financing or new funds going into the coal sector. And we will probably cease from all exposure to coal by a certain timeline. We were hoping, we will be able to complete that. So in a nutshell, we want to engage with the industry to make sure that we have a plan to transit to a low carbon economy. But if there are customers who are not able to complete, despite giving them time-bound targets, then we may have to exit. And that we have made very clear to our clients and to our stakeholders. Now, finally, given the time given to us is coming to an end, 2 minutes, Rashid, on how you think the finance and corporate world could cooperate and work together to further promote the sustainability agenda.
Thanks, Rafi. So I guess, probably, just repeating myself again. I guess the key thing here is basically engagement, dialogue, and collaboration, right? Because at the end of the day, engagement is key because, both parties would need to really understand the expectations. One is basically on the expectations from the finance industry. And number 2, basically for the finance industry to also really understand the sort of challenges and nuances, of a particular corporate and within the specific industry that they work in. And number 2, I think the point that you raised just now, right, with from the last question that we had just now was around collaboration, right? Working together to sort of develop solutions on the ground and to basically see progress being made. and this sort of active participation in collaborating with each other. And just one key point to highlight is basically, this engagement, I feel, should always be the last resort, because in the event that because we want to try and engage with customers or stakeholders as much as possible, because at the end of the day, what everybody wants is changes on the ground, and you can't effect change on the ground once you disengage from a particular stakeholder. So I guess those are some of the key points that I'd like to just summarize. Thanks.
Thank you, Rashid.
So
I
maybe
think you've
on your
summarized
side,
it quite well.
Yeah.
I think you have summarized all the key points. The only one point I want to add is that when we talk about these high-risk sectors, if we can work with you and others within the high-risk sectors to clearly identify, to the extent possible, the scope 3 emissions, and to make sure that there's no double counting. And we then look at the country's commitment under the NDCCs. So under the Paris Agreement, Malaysia has certain commitments. By 2030, we have to deliver. So if we can look at the national inventory of the GHG emission that we have to reduce, and then we dovetail towards the industry-specific targets, so that not only we are reducing our own emissions according to our own targets, but we need to make sure that we are aligned with government's own commitments under the Paris Agreement. So I think given that, palm is within one of the high-risk sectors, and that would have certain impact to our own commitments under the NDCCs, I think it's good we, from the finance side, can work with you on the corporate side to make sure that we are aligned with the government initiatives, so that we can not only reduce at the sector level, but jointly contribute towards the government's commitments under the NDCCs. It's been a great pleasure to have this dialogue with you, Rashid. I definitely would like to see Sime Darby succeed in its ambitions under your stewardship, and we are here as CIMB to help you to achieve your ambitions.
Thanks, Rafi, and likewise as well. I mean, we are always ever willing to engage and support any actions which are needed.
Excellent. Thank you.
Thank you.
A fantastic penultimate session for this summit indeed. It's great to know how finance and corporates can collaborate and work productively to create a low carbon economy and greater sustainability. Ladies and gentlemen, to sum up the enlightening discussions we have had throughout the day is our keynote speaker, Dr. Mahmoud Mohildin, who is the United Nations Special Envoy on financing the 2030 Agenda for Sustainable Development. Dr. Mohildin was Minister of Investment of Egypt from 2004 to 2010, and most recently served as the World Bank Group Senior Vice President for the 2030 Development Agenda, United Nations Relations and Partnerships. He also served on several boards of directors in the Central Bank of Egypt and the corporate sector. His professional experience extends into the academic arena as a professor of economics and finance at the Faculty of Economics and Political Science, Cairo University, and as a visiting professor at several renowned universities in Egypt, Korea, the UAE, the UK, and the US. With over 3 decades of experience in international finance and development, and having held leading positions in national, regional, and international research centers and associations, Dr. Mohildin is well placed to provide a global view on ethical and sustainable finance today. Please join me in welcoming Dr. Mohildin.
Thank you so much, Shireen, for your very nice and generous introduction. I'm very pleased to join you today through this recording to share some thoughts and reflections on ethical finance. And let me congratulate you for picking and choosing this important topic very timely ESG in a volatile world, profit, purpose, or politics. The particular focus on the ASEAN region is important as well. In different regions around the world, we look to the ASEAN for the great developments since the 1960s and how the good collaboration between the member countries enhanced trade, investment, and knowledge sharing in good partnership spirit. Having said that, and as perhaps many speakers before me emphasized, we live in a kind of a long-term perfect storm affecting us all. It's started with the COVID-19 and its impact on lives and livelihoods, the impact on jobs, growth, the deterioration on standard of living, the increased numbers of those who are suffering from extreme poverty had increased roughly by 100 million. Those who have been suffering from malnutrition increased by 250 million. And then we see the impact that some of the cures to the crisis of COVID had contributed to increased inflation through the stimulus packages. Of course, we know as well about the problems that the supply chain had been suffering from through disruption. So more of prolonged inflation that is going to stay with us for quite some time, lower than expected growth. So stagflationary fears are very legitimate. And this all was before the crisis in the Ukraine, with the war there that had, of course, devastating impact on the people, with casualties of and loss of innocent lives. But again, there is an impact on food, on energy, and many countries are facing financial challenges. Some recent figures are telling us that 107 developing economies, home to 1.7 billion people around the world, are severely exposed to at least one of the three global transmission channels of the crisis: the food, energy, and finance. And 70 countries, home of 1.2 billion people, are severely exposed to all three channels or shocks at once. This is the kind of world that we are confronting today. Great deal of polarization, lack of trust, and great deal of economic uncertainty, which is not helpful to any kind of investments, including ethical investments, including ESG asset classes, and any kind of long-term finance as well should factor in all of these challenges. I'm saying that while I would say that the ASEAN region has been less directly affected than other regions, especially in terms of the impact on grain imports, but the impacts are nevertheless severe if you put into consideration the impact on the rest of the world and the impact on some of the major regions as trading partners with the ASEAN, and some of the areas of growth and sustainable development in the ASEAN countries is very much as open economies dependent on higher growth rates around the world, higher trade volumes, and higher flows of investments. So dealing with these disruptions and shocks is very much warranted. I like to put my comments in the context of the fact that Egypt, my home country, is hosting the COP27 this year in November. And we are now considering the main deliverables that should be expected
from this COP? And in what way a COP hosted in a developing economy, an African economy, an Arab economy, and a Mediterranean economy with excellent relations around the world, including with the ASEAN countries, should be different from other COPs. I think it's fair to say that there is a great deal of building on the outcomes and the results of previous conferences of the UN FCCC and the recent COP in Glasgow. In addition, of course, monitoring the progress and performance vis-a-vis the commitments related to the Paris Agreement of 2015. But in addition to this deliverable, which I consider the bread and butter of any COP, that you need really to consider what happened in the previous years, I would really outline 5 areas for your attention. The first, especially in times of crisis, it's important really to have a kind of a holistic approach in dealing with the climate agenda. Any kind of a reductionist angle to sustainability to mean only climate change, and for climate change to mean only efforts towards mitigation and decarbonization, and having a kind of a price to carbon, it's very much going not to deliver on what we are going to expect from this COP. I'm not undermining the importance of mitigation. I'm not undermining the importance of having a price on carbon, but a holistic approach. By that, I mean all aspects related to mitigation, all issues related to adaptation, and dealing with the controversial file related to loss and damage, and of course, finance need to be all included. Perhaps we need to put that in the context of achieving the Sustainable Development Goals, especially with the kind of challenges that our world are facing. You cannot talk about climate action without being mindful to the eventual impact on poverty or on unemployment or food security or access to energy or in better water management. The good thing is that the technological solutions and best practices are giving us good approaches if they are coordinated better with good data and good adequate finance. We can really achieve these goals and targets together. So we put the SDGs with emphasis on SDG 13 if you are after a kind of a more holistic approach, but the critical minimum is to deal with climate action as a mix of efforts with very good coordination to deal with mitigation, adaptation, loss and damage, and the issues related to finance. The second part is about promotion of stronger focus on implementation. We have heard for many years good pledges, good phrases of love and affection to the planet and the people and how we should protect them. But when it comes to implementation and delivery, we leave a lot to be desired collectively. So it could be fair to say it's about time then, given that we have seen great deal of commitments and pledges, it's to see some of the deliverables and good projects in the field. And with these projects, we can see better investments and better job opportunities. The third aspect and of relevance to the ASEAN that this COP is emphasizing, in addition to the global perspective of climate, the regional approach. And there is going to be 5 regional roundtables about the opportunities of investments, getting the GFANs or the Glasgow Alliance that had the top asset managers from around the world. They have assets under management of more than $130 trillion as announced back in November 2021, and they committed to the net zero efforts and the race to zero with priorities on mitigation and decarbonization. At the same time, we need really to have these funds matched with project pipeline, and hence comes the idea of having these regional roundtables to have alignments between the supply of investable and bankable projects with the promise of finance, either from the GFANs, the Glasgow Alliance, or from other sources of funding. And I think with the good examples demonstrated by the ASEAN and its model of collaboration, there could be very good opportunities. And as you know, the Regional Economic Commission of Asia is hosted in Thailand, one of the ASEAN countries, and we're going to be having our meeting there very soon with emphasis on public-private partnerships. But there will be other roundtables in Africa, Latin America, in the Arab world, and in the rest of the world in Geneva as well. The fourth aspect of emphasis is the localization of the efforts. Egypt as a host is adopting a kind of a bottom-up approach to the agenda of the climate action to make sure that local communities, municipalities, active members of the society at large would have their own say, in addition to the variety of projects that you would expect from the small to the biggest projects, including women-led projects and startups. My final point is on finance. Without finance and investment, all of the above will be compromised. It's about data, finance, and implementation that we can really get the climate action on track. And we know very well that we are not on track based on the recent IPCC report that had shown us deviation of around 60% of targets. Instead of reducing emissions by 45%, we are increasing the emissions by 14%. Again, issues related to finance, not just the famous $100 billion promised since Copenhagen, but investments that should really be coming from the private sector. I mentioned just now the GFANs, but there could be as well the different commitments from the business community, either domestic business community or from international finance. There is the important role in a world that is facing growing debt and accumulation of outstanding debt in unprecedented rates, is to adopt some debt reduction mechanism. And my plea for the G20, which is hosted in an ASEAN member country in Indonesia, is to consider the debt for climate investment and debt for nature investment as an option going forward. There is a need as well for international collaboration to establish carbon markets, and there could be good models on that. We know that Europe have done a great deal of work on establishing its emission trading system, and there is an active market there. But and they have been collaborating with the Southeast Asian countries, and of course with China. It could be as well a good partnership, South-South perhaps, on how to establish good carbon markets that are compatible with the priorities of the emerging markets and developing economies. In addition to that, I would expect that issues related to what we really mean by ESG, what we really mean by ethics when it comes to finance, that we need to avoid greenwashing. And there have been a great deal of interest in this about the metric, which metric that we're applying, how the different metric adopted by different agencies could be comparable. And I look forward to the work that is led by the former Minister of Climate and Environment of Canada, Minister McKenna, a committee that had been formed by the UN Secretary General to provide a kind of stock taking on our knowledge and what went right and what went wrong, what are the best practices, what are the best codes and procedures to be applied. However, nothing of that all will be done without starting from home, by having a budget of the state that is reflecting its priorities when it comes to sustainability, including SDGs and climate action. If you have that kind of SDG budgets, that would allow the private sector to get its signals right from it. It would allow some good accountability on the public finance and how it is aligned with the priorities of the SDGs. And then we can really enhance the mobilization of funds where it really matters, from public and private to domestic and external sources of finance, to achieve the ambitious goals of sustainable development, ESG and climate action, and all of them should be carefully tailored and aligned. Thank you so much. And it has been indeed a pleasure to speak to you. And I hope that I can welcome you all in Sharm el-Sheikh in November in Egypt.
Thank you, Dr. Muhyiddin, for your profound insights on the transformations and commitments that must take place in the way that banks, investors, capital markets, insurance operate in the future and get the climate action back on track. So, ladies and gentlemen, the financial industry has an enormous capacity to set the course for climate security, and it will play a pivotal part in delivering this vision of a net zero economy. Throughout the many discussions today, we heard about the crucial role that ASEAN plays in both the world economy and the global environment. And notably, we are reminded of Asia's far-reaching capacity in global decarbonization efforts, not just in terms of their role in the global supply chain, but through the incredible biodiversity available to us in the region, which can support the climate action needed to protect ASEAN economies from the devastating risks associated with climate change. To act on that, we need a finance sector empowered with quality data and a strong sense of purpose. The way ahead in the race to net zero is fraught with challenges and risks, but collectively, as an industry, there are no obstacle. I'm sure we've given you plenty of food of thought. And to continue the conversation on the topics discussed today, here's a friendly reminder to share your views on any of the sessions via social media using the hashtag EFASEAN22. We would love to hear your perspectives on the day's discussions, so do tag us as well. With this, we have come to the close of the Ethical Finance ASEAN Summit. On behalf of AICB and GEFI, I would like to thank all of you for attending today. I hope you've enjoyed the sessions as much as I have enjoyed hosting the event today. We hope the insights gained from this summit will inspire you on the journey of transformation to net zero. Thank you as well to all our esteemed speakers for taking the time to share your deep knowledge and experience with the audience today, and to the respective teams from AICB and GEFI for their contributions towards the summit. For more information on our upcoming events, do follow AICB on our social media page or visit AICB or the GEFI websites. Lastly, do participate in the survey, which you can access at the survey link as you scroll down the page. We will also send that around in an email to you. We welcome your feedback, which will go a long way towards helping us improve on the delivery of these sessions. So do complete the survey. And for AICB members in particular, you will be entitled for the CPD hours. With this, ladies and gentlemen, thank you once again for joining us, and enjoy the rest of your day. Thank you.